so as to speak. There's a fair bit of Indian specific single stock news flow, which we'll get to in just a bit, but just want to tie up the levels. Nifty, the resistance is 24,300 and the support stands at about 23,800. We, of course, were kind of flat by the time we left off on Friday, on Wednesday. So we just pick up from there. GIFT Nifty gives you a quick sense of how we are starting, and then we will take it up. So 120 lower on the GIFT Nifty this morning. Nigel has walked across the wall with the data and the positioning. Nigel, take it away.
Well, let's start off with the flows first. On Wednesday's trading session, the institutions, you put the data together, they were net buyers. The FI net sell number, by the way, it was the lowest, one of the lowest we've seen of late. So that's good. A smaller FI net sell number is heartening to see. And in fact, the trend has been quite good. We're wondering when they'll turn buyers, but for the time being, what we need to, be happy about is that the net sell flows are actually coming down from around 1 lakh crore in March. It came down to around 60,000 crores and now we're around 34,000 crores in March. Thank God for small mercies, I think. So the FI outflows are slowing down, which is good news. But in the F&O markets, well, they're fairly cautious in terms of their stance because they added short positions both on index futures as well as on stock futures. Quite a few shorts were added, particularly on index futures, while on stock futures as well, there were some shorts. And they went ahead and they wrote more calls than puts. A Weibo, but more than 1 lakh contracts on the call side were written. That's telling you that higher levels, the bears want to come in there and fight. And what are the contracts that they were writing? 24,000 call, close to 28 lakh shares getting added there. Premium at around 130 rupees. 23,900 call as well. 20 lakh shares getting added 180 rupees or thereabouts. So just plugging in these numbers and looking at the recent high that we saw in May, that 24,250 mark, that becomes the first level of resistance. On the downside, that 50 DMA becomes important. Remember, we're closer to around the 20 DMA. So that's the mark on the reference point on the downside. I think, if we protect this level, you'll still fancy your chances that this market actually wants to go ahead and test the resistance mark. One of the indices to track, I think, are the IT index. Globally, there's been a lot of news flow on the tech space itself, and that's been one of those rank underperformers. So at around 29,000 odd, risk reward could be favoring you as well, and this could be one of the indices to watch for today. So we'll keep an eye out on that one. One positive is the last couple of trading sessions, the Nifty has been a little wibbly-wobbly. In fact, it ended mildly lower, but the India VIX, that's breached the 15 mark on the downside. For me, this is a significant trigger. The India VIX cools off and stays below this 15-odd mark. That's giving you a pulse of the market. The volatility index cooling off is very, very good news. From a high of around 29-odd just a month and a half ago, it's come down to sub-15. Good news out there. But irrespective of what the headline index does, we're in a bit of a range out there. But take a look at the broader markets. Beautiful looking screen yet again. On a day that the markets don't do much, that's the headline index doesn't do much, you still have your share of winners from the broader markets. And I think that's what's making portfolios feel very, very good. April was a good month. More number of stocks advancing and declining. And May as well has followed suit. So stock-specific action will continue.
Thank you. And I'm going to latch on to that Nifty IT bit because Wipro ADR was up 18.5% overnight and Infosys ADR was up 2.5%. But let's get back to the latest from the US-Iran peace negotiations. US Treasury Secretary Bessent said the president wants freedom of navigation in the Strait. Listen in.
I think the president wanted to punctuate freedom of navigation in the Strait. The teams have been going back and forth. And President Trump has made it very clear, he talked about it at the cabinet meeting, that he has several red lines. And Iran has to turn over their highly enriched uranium. They cannot pursue a nuclear weapon. And the Strait of Hormuz, back to your question on energy, has to free transit. Navigation of the seas has to be free and open as it was before. So he's not going to take a bad deal. He's going to make a great deal for the American people.
Awaiting that great deal. Meanwhile, in a Fox News interview recorded earlier and set to air over the weekend, President Donald Trump said any agreement with Iran would depend on securing a good deal. Listen in.
A deal that wasn't going to be good for us is the line, ultimately, because, I'm playing it out and we're going to see, and that's what I do. I negotiate, they negotiate. They're very good negotiators. They're crafty. But in the end, we have all the cards because we've defeated them militarily. Look, they have no Navy. Every ship, they have 159 ships. Every one of them are at the bottom of the sea. Every single one. We take pictures of them. We have people going down taking pictures of hundreds of ships. Their Navy is totally gone, 100%. Their Air Force is totally gone, 100%. Their military, we've sort of left it alone because we think that their military is somewhat moderate.
Okay, let's get in Stephen Englander, Managing Director, Global Head of G10 Forex Research and North American Macro Strategy at Standard Chartered Bank. Thank you very much for joining in. Sharp decline in crude prices. There's a 60-day ceasefire. Do you think this is going to be the final negotiation? Are we going to finally get a deal? What do you all believe based on the news flow that we've seen?
Well, we've had so many of these indications before, and nothing concrete's gone through. What's clear is that the market seems to believe that something is going to go through. We have West Texas at around 87. We have Brent around the low 90s. It's a very good sign. It doesn't mean that they're convinced it's going through, but what it suggests is that they certainly think that there's a high probability of some sort of deal being achieved.
High probability of a deal being achieved. But how much of that do you think is in the market? Because in the last 2 months, the S&P has rallied nearly 20%, the Nasdaq has moved up 30%, and overnight we did see yields, etc., cool off a tad bit.
Well, I think what's interesting, the war is not the only thing, not the only game in town. And if anything, in U.S. markets, it's probably in third place, that the optimism on equities driven by AI technology stocks, I think, is probably independent. And I think the run-up in bond yields because of the strength of the resilience of the economy and the strong investment is independent. And I think you see the vols, the market just isn't that worried right now about the war. So I'd say that there is significant tail risk if it turns out that this is a head fake. But I'd say overall, the market has kind of made its peace with the Middle East for now. And they're actually focused, or at least US markets are focused on other things. You look at Indian markets and where the rupee is trading, I think, it's still clear that there's room to go.
All right. Hi, Stephen. Good morning. Good to see you, Ben. Since you spoke about the rupee, do you think the rupee overshot itself on the downside at around 97 odd? If you could give us a brief idea on the currency space out there. What about the dollar index? That is still well behaved. From an India market perspective, a weaker dollar normally is better for emerging market flows, and we still hope that they return. So your take on that?
Well, I'll talk about the dollar overall because that's my area of expertise.
Yes.
I think what's interesting is how resilient the dollar is, despite the moves that we're seeing in oil prices. At the beginning of the war, dollar went up when oil prices went up, and dollar went down when oil prices went down. Now, what you're sort of seeing is that the market's keeping an eye on oil, but that's not really the closest trading driver. The market's paying attention to bond yields and the fact that both real and nominal yields, the spreads are going up and favoring the dollar. And even though normally strong equities are dollar negative as kind of an indicator of risk appetite, I think that the fact that this optimism is so concentrated in the U.S. and in the tech sector is actually more dollar positive than dollar negative because it's idiosyncratic to the U.S. in large part.
Stephen, just one quick thing. Have you looked at how much of what's the percentage of capex which AI companies have announced in the U.S. Is coming through their own internal accruals, and how much is via borrowing through bond markets?
Well, they're borrowing a lot through bond markets, but I think that's by choice. I think that the cash flows are large enough. I think that they could finance a lot of it internally. I think it's a finance decision. What's interesting is that profits, when you look at earnings season, this has been the case for 3 or 4 years now. Profits keep surprising on the upside. So, everybody worries that this is a bubble and it's going to fall apart. And yet when you see, productivity growth so robust in the U.S. and being matched independently because the profits numbers are from completely different sources, it tells you that this might actually be for real, which would mean that, yes, there's a lot of capital investment and it's pushing up yields and raising borrowing demand, but it could be justified by the rates of return that these firms are going to experience.
Okay. we'll leave it there. Thank you very much, Stephen, for joining us. It's good speaking with you. And thank you for being here with us today. We'll take a quick break. We'll come back with, of course, the top 10 list of stocks on the program. But let me just run you through the interactions which are lined up. So 8:35, we have the management of the OneMe Technology. Ranveer Singh is going to be joining us to just talk about their fourth quarter numbers. 9 o'clock, we have Manoj Gori of Equity Securities to focus on the EMS sector. PG Electro Plus earnings also, of course, came through, so we'll talk about both with Manoj. Amish Shah of BofA Global Research is our market master of the day. 9:35, the management of Physics Wala will discuss their fourth quarter earnings. And towards the end of the program, as oil prices dip, Lada speaks with Bank of America's global economist on whether funds will now start sort of, coming into basically countries and markets which have been hit by high oil. Okay, we'll take a quick commercial break. Our list of top stocks to watch out for with our research team in just a bit.
Welcome back. You're watching Bazaar Morning Call. It's a Friday morning. It's time to talk stocks with our entire research team. This is CNBC TV 18 list of top stocks for the day. Hi guys, happy Friday. Sudarshan, let me begin with you. Last day of the earnings season. Today we've only got, I think, Asian Paints and Interglobe Aviation in the Nifty pack. But talk to us about Ashok Leyland.
Good morning. So, was confused with the what color exactly to be given for Ashok Leyland, but finally I'm going with green on the back of two or three main reasons. First, if you talk about the earnings were largely in line to a slight beat, and also the outlook that company has given for Q1 and Q2 is not looking that bad, especially for domestic business. So first, talk about the numbers. Revenue has increased by 19%, EBITDA has seen a surge of 15%, and margin has come largely in line at 14.6% versus 15% in the same quarter, but our expectation too was around 14.6%. Now, going forward for Q1 and Q2, company is expecting moderation in domestic business outlook, but that moderation will not happen YOY. That moderation will happen from the huge growth that industry saw in Q3 and Q4. In Q4, the industry growth was in the range of 15 to 20%. From that level, there can be some moderation. The bad part is export. Till 9-month FY26, export growth was 30%. So there was an expectation that company will outperform its guidance of 20 to 25%. But Q4 was extremely bad and company managed to report a growth of just 18.5% for FY26. So on the back of healthy earnings, on the back of healthy outlook for domestic business, I'm going with light green.
Very much for that. Light green is the color. Upasana now joins in with PG Electroplast. Upasana.
Well, the street was already anticipating a weak quarter this time around, but if I look at the numbers, they are weaker than what the street was estimating as well. Now, overall revenue is largely in line, mostly on the lower end of it. PAT and EBITDA is missed the street estimates. Now, revenue has declined by 10% versus the estimates of a decline of 7%. And the key drag comes from the company's RAC business, which is nearly 86% of the company's product business. And if I talk about overall revenue, it forms nearly 70% of the total sales. Within product category, the key category RAC, as mentioned earlier, has seen a decline of 12%. Washing machine has seen an uptick of 70%. And coolers have seen a downtick of nearly about 1% on year-on-year basis. Now, company says that the overall disruption, including LPG crisis and truck availability, has led to a revenue loss of nearly about 420 crore in Q4. EBITDA margins are also under pressure, down about 420 bips at 6.9%, and this is mainly due to the cost inflation, higher commodity prices, and even negative operating leverage. If I talk about the gross margins also, they have taken a downtick from 18.5% to 15.7% as the company was unable to pass on the price inflation. Now, coming to the PAT, it's seen a downtick of 55% at 65 crores. Now, overall, if I talk about the full year basis, FY26 revenue stands at just about 9%, and the company has missed its FY26 guidance of 17 to 19% growth. It has also missed its PAT guidance as the PAT is down at 32% versus the guidance of 3 to 7%. Now, company held its con call yesterday, and company expects off-season demand in June to September 26 to remain relatively stronger as compared to historical trends if El Nino weather continues to intensify as forecasted. Well, overall, in terms of outlook, it remains cautious for FY27 and expects the industry conditions to improve.
Thank you very much for that. Vinny now joins in to tell us more about Siemens.
Hi, morning. So for Siemens, we are looking at the con call highlights that have come in. What the company has highlighted, they're not seeing a slowdown yet in public or private capex. Rupee depreciation and volatility in commodity prices, yes, that's surely coming in as an impact, and maybe that could be a near-term challenge. But other than that, private capex, that started seeing a pickup in the last few months as well. Key growth drivers for the company, roads, highways, railways, all of them have a strong pipeline. Data centers obviously leading the charts over there. They've also won an OSAT plant order in Gujarat as well for power distribution, facility management and automation. So that is also a positive for the company. Now, in their two different segments, that's the digital industry segment and smart infra segment. Short-term duration orders are what they focus mainly on, and they do not have long-term contracts. So short-term duration means faster execution of orders is something that will continue. The company said that, obviously in terms of electrification, they're one of the strongest players there, and they can manage that entire electricity setup for data centers. So currently 12 to 15% of their backlog mix is data centers. Smart infra side of the power and utility side of the program as well, they're seeing high growth, especially in commercial building side. Apart from that, steel and cement, they highlighted that in the last couple of months, that's seen a bit of a slowdown. This is for smart infra side. Government ordering in power utilities as well as railways, that is there. But there is a slight bit of a slippage that they have seen, but that is not a structural slowdown. So again, nothing to worry on that front. Apart from that, they believe that export orders that are starting to see a pickup as well, and over time they'll further see an increase coming in, and import costs for the company have started going down and will reduce further as well. So we'll see some bit of a green again here for Siemens today.
All right. Thanks very much, Vinny, for that. Well, GMR Airports is the next one, and Vivek has got details here. Vivek, morning.
Well, good morning. You know, the biggest headline as far as GMR Airports is concerned is that the company has turned profitable for FY26, and this is almost after a decade. Now, this is despite the fact that there was significant turbulence as far as the aviation sector was concerned. Operation Sindoor at the start of the year, the West Asia conflict, as well as airport capacity constraints that various airlines were facing. Now, looking at the numbers of Q4, you know, largely in line with what the street was anticipating. Revenues high by almost 36%, EBITDA up 38%, the calculated EBITDA margins at 38.3%, and the profitability of 400 crore versus a loss seen last time around. FY26, when you're looking at the numbers, a profit of over 470 crore versus a loss of over 800 crores. Traffic growth was quite muted for FY26 at just around 0.9%. Now, the key to watch out for will be the guidance that the management has shared exclusively with CNBC TV18. Our PAX growth for FY27 organically is expected at 4 to 5%. Two new airports at Nagpur as well as Bogavaram is something that is expected to launch soon. And what they say is that 9-month contribution will be seen from both of these airports. The other important thing to note is that H1 traffic growth is expected to be softer than H2. And the biggest takeaway as far as GMR Airports is concerned is that come Q1 FY27, the company will be starting a third segment of business that will be the monetization of the various land assets that they own, and that is something that the street will keep an eye out on.
Okay, all right. Thanks a lot for that, Vivek. Hopping across to Upasana. She's here to tell us about Physicswala as well as Apar. Morning, Upasana.
Good morning. First up, let me start with Apar Industries. The company has reported a strong revenue growth this time around, and it was mainly led by company's conductor segment, which saw a growth of nearly about 30%, and cable division, which saw a growth of about 35% on year-on-year basis. Now, if I talk about the overall domestic mix, it stands the revenue stands at 33%, and exports also grew quite significantly, double digit at 11.7% on year-on-year basis. Now, coming to the margin stands at 7.5% versus 8.3%, and PAT is nearly flat at 253 crores. Now, management has highlighted that H1 FY27 to remain subdued, weighed by various factors such as Middle East related disruptions, elevated commodity cost, and even labor constraints is what they have highlighted. Next up is Physicswala. Overall, the Q4 net loss has come down. It has narrowed down by 76%. The company's net losses have narrowed down from 289 crore to 69 crore. Now, if I talk about the revenue growth this time around, it stands at 51% on year-on-year basis, and there is a 15% sequential decline. FY26 full year basis, the revenue growth stands at 35% versus FY25, the company logged a growth of 48%. And if I talk about FY24, it has seen one of the highest growth years of 1.6 times the revenue growth. Company has also approved investment of 120 crore in its wholly owned subsidiary, that is Finzi Finance, as it expands further into its financial services segment. Now, company in its con call has highlighted and also guided for a 30% revenue growth for FY27, and has also given a 100% EBITDA growth expected over FY26 levels. And lastly, in terms of online contribution, the company targets to increase from 50% currently to 55% over the next 3 years.
Okay, thanks, Upasana, for that. Well, let's get in Sud. He is on the go today, covering a lot of stocks. Sud, tell us about PB Fintech and some other stocks in news.
So starting with PB Fintech, finally we understand from sources that block is launched in which Ashish Daya and Alok Bansal are likely to sell the stake, and the stake being sold is of 0.8% equity. The reason I'm going with red for PB Fintech is the floor price launched at a discount of almost 4%, and it's at 1720 rupees per share, and the stock too has been under pressure for the last few days, so I'm going with red. Next one is Bharat Dynamics. It was a completely hollow set of earnings that company has reported for Q4, especially if you talk about the profit part. It's dragged by the higher employee expenses, and that is increased to 22% of total revenue versus just 8% in the same quarter last year. Even other expenses too are higher, and it has increased to 29% versus 16% in the same quarter last year. So I'm going with red. Other two stocks that will be in the focus. First one is Zydus Life. Two news. First news that company has increased the buyback price, and earlier price was 1150 rupees per share. Now company has released increased to 1260 rupees per share, and also its arm, that is Zydus Therapeutics, received priority approval from US FDA for a new drug, that is sargoglisar, and that is used for PVC in adults. So I'm going with red for Zydus Life. Next one is Wockhardt, that has received an important approval from Indian drug regulator, and it has received the approval for Zynic, and that is for the import and marketing. So that it has been long pending. Now this approval also can be taken very positively. So green for Zydus, Wockhardt, and red for Bharat Dynamics.
All right, so thank you very much for that. Well, that is a bunch of stocks, and so doing the heavy lifting there this morning. Well, just a quick recap of some of the top stocks that we've put out. So Ashok Leyland, Siemens, GMR Airports, Physics Wala, Apar Industries, Zydus, and Wockhardt are stocks with some positive and some green color there. And PG Electroplast, Bharat Dynamics, and PB Fintech are stocks on the other side. We'll take a break. We are back and we connect with the management of Kisht, which is on EMI Technology, to discuss their fourth quarter numbers and outlook.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC TV 18. On EMI Technologies, that's the first management on the show. FY26 was the company's first full year as a listed entity, as it got listed in May. The AUM crossed 7,000 crores for the first time, with a 73% growth. To help us out with what's the way ahead, we have with us Mr. Ranveer Singh, the Chairman and Chief Executive Officer at the company, who joins us on the show. Hi, Ranveer. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Well, I wanted some clarity with regard to the guidance that you've given. You're talking about 40% AUM growth, despite tightening industry regulations. What's giving you this confidence of growing well without compromising on credit quality? And give us some color as well. This 40% will come how? From existing customers, or you'll be going for new borrowers?
Absolutely. First of all, thank you for having me here. Yes, we have given a guidance of growth rate of 40%. If you look at the history of our company, there hasn't been a single year where the growth rate has been less than 60%. But that is also a testament to the proposition that we have built for our customers. Despite in the environment where we need to be very cautious, yet we are saying we can grow at 40%. It is primarily because of our large base of existing customers that we have. As we speak, we serve close to around 11.76 million customers. So a large part of the growth is coming on the back of these customers continuing to bank with us. They are very, very high quality customers, which gives the immense level of comfort on the way we see the risk playing out. Not only that, as a measure to what is happening in the economy, we have done some, taken some measures to reduce our disbursement. Despite that, our view is that we should be able to achieve 40% over and above what we have delivered in FY26.
Ranveer, hi, morning. You have two segments, right? Prashant here. You have the personal loan segment, you have LAP. So give us where you're seeing this growth coming in. And, just a quick question. And you obviously have been in financial services, a long time. And you've grown the book to where it is now, which is over 7,000 crores. But growing the book, you can grow it very fast. But I mean, to ensure that, giving money is easy, as they say, but you got to get it back. So where and we hear it all the time that maybe, that incrementally, even on the retail side, lenders are turning a little bit cautious. So just give us a sense on that. First, the split, and second, this question.
Oh, absolutely, Prashant. Let me first give you the split, and also one of the most cardinal question, which I think everybody is asking, where this growth, in a market like this, you need to exercise prudence, why we are growing at this rate. First and foremost, the large part of the growth, is coming on account of both our personal loan and LAP book. But it would be primarily driven by our personal loan. The reason being, almost 93% of our business is personal loan today. The LAP is still 7%, 7.3 odd percent. It is only going to grow at some rate. There is no way this is going to contributing to become a significant share of the market. So the large part of the growth, by definition, by starting point, will be a personal
and
loan.
In personal loans, Ranveer, sorry to interrupt. Personal loans, only about 48% is salaried, right? The rest is non-salaried.
Absolutely. So the way I put this is, it's a 50% salaried, 50% self-employed. Given the huge expanse of Indian market, if you want to be relevant to a larger customer base, you have to cater to a large base of both salaried and self-employed. So you're absolutely right. 48% is salaried, 52% is self-employed. But let me come to the most important question that you have asked, right? We have grown at this rate. The market is, there is a degree of trepidation in the market. See, I should say one thing. If you look at our performance, everybody talks about growth, everybody talks about profitability. But one of the most salient factor, perhaps, is this growth has come on the back of we having a very strong asset quality. What used to be a 2.9% NPA when we started the year has come down to 2.12%, almost a 78 basis point drop in the NPA. The point I'm making is this is coming at the back of high quality credit that we have been able to bestow. And let me say it has come at a cost. When I say it has come at a cost, we have followed a strategy where we have intentionally reduced our margins. So if you look at my margins today compared to last year, it has come down. But it's a very conscious, concerted, deliberate strategy from our side to go after customers who are high quality. And these customers come at a much better, risk thing as against, the ones where the rates may be higher. So, yeah.
Sorry. So just on that point about margins, your borrowing costs are very high, 14% plus. So that's pretty high for a stable rated NBFC like yours. Are you looking at a rating upgrade, any measures to bring down your cost of borrowing? What's the number you're targeting for next year?
Absolutely. It is high, but it is also high because we have recently means February 13, 2026, we have been rated as A- by CRISIL. And as you know, in this market, once you go from triple B to triple B plus, you see some improvement, but not so much. But the moment you go from triple B plus to A minus, you see quite a significant improvement in the cost of funds, because the entire PSU banks and a lot of listed entities and the subscription of that opens up. So this is going to come down. We are already seeing a reduction of close to around 100 to 150 or 200 basis point in the fresh loans that we are doing. But this number is also high because this has happened more recently, and the past debt continues to come at a high cost of fund.
Got that. And you also started the interview by saying that based on what we're seeing in the market right now, you have moderated your disbursements, which is why your AUM growth target is 40% for the coming year. Could you tell us a little bit more based on what you're seeing in the market? Is there stress? Is there stress coming in on the salaried class? Is it on the self-employed side? What exactly are you seeing right now? And is it on account of the war, high inflation? What have you picked up?
First of all, yes, it is true. We have reduced our disbursement to some extent. And when I say some extent, I'm comparing between January of this month versus the April. It's a very, very cautionary measure. The reason it's a cautionary measure because, as you know, risk in India is extraordinarily heterogeneous. So there is no one single factor, but a combination of factors: global supply chain, having after effect in Indian market, behavioral subsegment, sometimes neighborhood level stress. All things are coming together. It's very, very difficult to pinpoint. But let me tell you what we have done as a cautionary measure. We have reduced our disbursement to the extent of around 7%. Yet we are growing because, as you know, our natural growth on a month-on-month level is a positive one. But more importantly, we have also paused disbursement in close to around 450 odd pin codes. And these are pin codes where we see a potential, risk building up in future. Very, very cautionary measure. We will continue. We do this. It's not a reactionary measure to what is happening in the economy, but the way our underwriting model works, it actually throws signals that there are these areas where we are already seeing a difference in the population distribution and some of the early indicators on risk. So it's a response to that, which is very, very part and parcel of what we do literally every day. If it was not this crisis, it may be some other situation which had made us reduce some disbursement, perhaps not to this extent, but to some extent.
Okay, Ranveer, we'll wish you all the best. Thank you very much for joining us. And, we'll of course, continue to speak. Thank you for being here. I think just a quick word on the GIFT Nifty. Take a quick look at where we are starting. So about 20 minutes away from the pre-open session. And we are down about 94 points, 95 points or so. But I think we have Amnish Agarwal with us, guys.
We do have Amnish Agarwal, Director of Institutional Research, PL Capital, now joining in on the show. Amnish, thank you very much for joining in. You want to quickly comment on what Kisht had to say as a broader indication of what's happening in the NBFC side in terms of growth? Now, they're a small company. Their market capitalization is 7,000 crores. So it's not a reflection necessarily of the entire economy, but they are talking about pausing disbursements to 450 pin codes and bringing down their disbursement outlook by 7% compared to what it was in January. Is this something you've picked up about stress in the economy?
Hi. See, as of now, the stress factors are not visible. However, having said that, we have seen now increase in the petrol and diesel prices by roughly around, say, 8 to 9 rupees in multiple tranches. If you look at, say, past 6 months or so, we are now witnessing rising inflation. We are witnessing crude prices moving up. And when it results in higher prices of not only input, but the petrol and diesel, then these are having always a ripple effect on the economy. Because particularly diesel, fuel oil, these are kind of things when the prices go up, you will feel the impact, which is very deep down under. So if the oil prices stay where they are, or even if they soften, they are unlikely to go back to the earlier level. So in this kind of a scenario, I believe there is every possibility that given the fact that we are having El Nino, given the fact that inflation has bottomed out, then there might be overall some slowdown in the credit growth in the coming quarters. As of now, are the signs visible? The answer is no. But yes, there is a probability of some slowdown happening in the credit growth from the current levels.
Do you look at BDL, Bharat Dynamics? Very disappointing set of numbers, and the company says it's on account of some external vendors not giving them the required components which led to execution delays for the missiles, Astra missiles, etc. And I was looking at your competitor Motilal Oswal. They've cut the FY27, FY28 earnings by a massive 25-28%. And their target price stands at 1,150, which is based still on 42 times FY28 PE, because currently the stock is trading at about, nearly 50 times when you look at forward FY28 multiples. So pretty high multiples. Any view on BDL?
You see, no specific view on BDL because we are not covering this name. But having said that, for any investor who is looking at the defense stocks, 2 to 3 things we need to look at. First of all, the business will remain lumpy. There will be phases when the growth rates will be very high and there will be phases when the growth rates will be slow. Secondly, for all the electronic related or other defense equipment, a lot of these chips, components, etc., they come from some of the markets where today, due to a supply chain disruption, due to some raw material supply chains or the vendors being disrupted, there could be, you can say, delays here and there. And because of the 2 big wars which have been, you can say, going on in tandem, there is a shortage of material and components. So these kinds of, I would say, the intermittent slowdown in the sales growth of many of the defense companies can't be ruled out. But yes, in the longer term, many of these defense companies, their order books are full. And given the fact that there's a need for indigenous, you can say, the development of many of these missiles or other armaments, the long-term growth will remain intact for many of these companies.
Got it. All right. Hi, Amnish. Good to see you in, Amnish. What about Coal India? Today, retail audience get a chance to give it a crack with regard to that OFS. What would your take be on the stock? It was at around 458 approximately. The floor price was at around 412. I think the cutoff price is 447 odd. So today, retail audience gets a chance to subscribe. You'd recommend them to go in?
You see, the prices at which the stock is being offered are definitely on the attractive side if you take a slightly longer term viewpoint. That is one. The second is that the overall demand for coal in the economy that will go up, and earlier there was a feeling that there will be big time discouragement for setting up thermal power plants. But now today in the change scenario globally, there is even a thought process which is being given for coal gasification and even the fertilizer plants incrementally in future using more of the, you can say, coal, which is to quite a good extent being, you can say, mined in the domestic market. So that is something which is, I think, positive for Coal India. The current summer months where the demand will be very high because of the acute heat. So that is also positive. But I think it is not at the bottom. The stock has done well over the last 1 year. But yes, given the fact that there's a reasonable level of discount at which it is available, so there is some definitely some room for the investors to make money in the stock.
So you're saying at this price, you would recommend them go in and try in the OFS, right?
Yeah, one can try.
Got it. Okay, Amnish, requesting you to stay with us for the time being. We'll go into a short break, come back. We'll continue our chat with Amnish. We'll also get in our technical experts. Stay tuned.
Welcome back. Let's talk about stocks. Hormis now joins in with the big movers from Wednesday, which saw heavy volumes, action, momentum, price. They had it all.
Morning, Rima. They did, and Z Entertainment was one such name. Had everything in during Wednesday's trading session. The stock was up around 9 to 10%. It's the biggest single-day gain and volume since June of last year for the stock. It's gained 4 out of the last 5 trading sessions, but more on the volumes front. Over 12 crore shares were traded on Wednesday for Z Entertainment. The 20-day average is just around 1.5 crore. And you take a look at the delivery front, 14% of those shares were marked for delivery. So around about 1.5 crore shares for delivery. The 20-day average is close to 50 lakh shares, and despite this move, the stock is still down around 40% from its 52-week highs of 150. But the move on Wednesday ensured that it recovered all the losses that it has made in the month of May so far. Of course, at one point the stock traded around 400, 450. The one name that's making headlines over the last couple of days has been Exide. The third straight day of gains on Wednesday, up 16% now in the last 3 sessions. The biggest single-day gain that the stock saw since June of 2024 on Wednesday. And if you take a look at the volumes as well over the last 5 sessions, there has been a consistent increase in the volumes that Exide is seeing from around 11 lakh shares on the 21st. It ended Wednesday's session with volumes of around 2.5 crore shares, and those were the highest since August of 2025, well above the 20-day average, which is close to around 40 lakh shares. 17% of those were marked for delivery, so around about 40 lakh shares there, and that too is almost 2.5 times its 20-day average. And from the March 30 low that the stock had made of around 287, the stock has recovered almost 40% from those levels. Another underperforming name that saw some sharp up moves on Wednesday was Swiggy, and as the biggest single-day gain in 3 months. Volumes were the highest in nearly 4 months. Around 3 crore shares were traded. That's around 3x its 20-day average. 40% of those for delivery, so just over 1 crore shares for delivery as well. 20-day average of around 40 odd lakh shares. And from its issue price, the stock is down already 30%, and well, from its post-listing high, which is well over 600 rupees, the stock is down almost 60%.
Thank you very much for that. Happiest Minds also came out with their numbers, and it's an okay set of numbers. For the full year, the company's clocked in a revenue growth of about 9.5%, and the company has reiterated their guidance of 12.5% for FY27 and 15% for next year. If you look at the Q4 numbers, it's about a 0.5% quarter-on-quarter revenue growth. Year-on-year, it's 6.5%. Margins have contracted slightly, but as I said, the company's ended with 9.2% for FY26 and guiding for 12.5% for FY27. And the aspirational guidance is 15% for FY28. But globally, what we are seeing on Wall Street is a comeback of the software names, while the performance of the Magnificent Seven they're trending higher, but not at that explosive pace. And interestingly, we had Wipro ADR up nearly 18.5% yesterday. Amnish, any view on IT stocks after the recent kind of underperformance? Do you see any sort of a correlation where software stocks like ServiceNow was higher yesterday? When these companies do well, do you see the rub-off impact coming through on Indian IT companies also?
As of now, the linkage of some of these AI-related companies doing well in the developed markets and the Indian markets, it is not going in the same direction, because the growth rate of Indian companies is under pressure. That is one. And secondly, there could be a lot of, you can say, uncertain period ahead till the time the business models, they adjust to the new reality. And where will the margins be? How will your P&L shape? So these are some of the factors in which there is an uncertainty. So do IT stocks, based on the recent earnings, do they offer value at the current price, given the kind of multiples they are trading at? The answer could be yes. But are they an absolute buy at the current price? I think it is, you can say, not a very easy answer to give, because usually these kinds of realignments or uncertainties, so they could take quite a bit of time.
Let's just put up a few names, right? And maybe Amnish will have a view. So let's just have these intradays up. And this is all, of course, the pre-open is not started. But so what you'll see is, of course, how these stocks traded on Friday. On Wednesday, I keep saying Friday because, we're coming out of a holiday. But today is a Friday. Well, Hitachi, let's just put that name up. Big move, right? And I think ended about 4% higher. It's been a big mover, and of course another 4% on Wednesday. Cummins India was, of course, on the back of numbers, super strong numbers. Cummins India was up over 10%, I think, by close, 11% there. Look at CG Power. which should come up again. I mean, a big mover on Wednesday. Look at GE Vernova. That is CG. I mean, the low was, I think, 500 something on, this is in 2026, in March or early April. And from there, it's basically almost double. GE Vernova is another one. Siemens India, I think we put that up earlier. JSW Energy is another one. There's ABB, there's Apar Industries. So these are all, the common thread through all of these, of course, is power. And that's been one of the strongest themes globally. And of course, it shows up in a limited way here in India. Not in a limited way. I mean, the group of stocks, of course, is limited. But it shows up in a strong way on these limited number of stocks that we have. Amnish, I don't know, across these names, do you have exposure? Should one get exposure now? How to think about this?
Prashant, all these names of the segment has been doing well from the past few years. And the reason for is the expectations that the global power demand will go up, Indian power demand will also go up, and India as such is the demand for power is growing at least 2 to 2.5 times the global demand. But now the incremental demand is coming from the new fields like your data centers, AI, and all these new concepts. So given the fact that many of these companies, they are directly related to supplying equipment, they are directly related to the development of the transmission networks. Many of them are into transformers. Many of them are doing, I would say, your HVDC lines, for example, company like GE, Vernova, and Hitachi. So the visibility of order book and growth in many of the companies, it looks pretty strong over the next at least 2 to 3 years. And that is why the stocks have been, I would say, moving up. Their order books are swelling and the outlook remains quite good. On any particular stock, you see, many of these stocks today, if I look at even say FY28, so many of these stocks will be trading anywhere between say at least 60 to 70 times 2-year forward earnings. So in terms of PE, re-rating, the chances are less, but till the time your order books continue growing, these stocks will remain in some sort of, I would say, market attention. So there is a probability that from these levels, will you immediately make an absolute gains? It is very difficult to say. But yes, given the kind of outlook is there, and if the orders books continue to remain strong, the performance remains, I would say, pretty good over the next few quarters, one will see them even going to higher levels. So one actually needs to, you can say, look at many of these stocks on minor corrections, or else one needs to take a 2 to 3 year kind of a view in many of these stocks. But all of them, I would say, the driver is the same and they are in the same bracket.
Yeah. I mean, there are no minor corrections in these stocks, right? That's the thing. They only correct big time when there is fear and panic which grips, right? Look, Liberation Day, I think Hitachi fell to, 10,000 or something. That was 2020, March 2025. And of course, in February, this Iran thing, I mean, we had large corrections, but they all, of course, have come up very, very strongly from there. I mean, it's just two completely unrelated names, but only the common factor that they are MNCs. Oracle Financial Services is one. It's in the IT space, but I guess different. It's come off, underperformed for a long time, starting to come up a little bit. And the other is Gillette, which I think is in a similar kind of, has found itself underperforming for a long time, starting to appear a little strong. I don't know if you have views on one or both.
You see, actually, I don't have any firm view on both the names. Oracle is more on the product side, but how the growth rates have been there, you see, I won't be able to give you any clear, you can say, guess on that. And the similar is the case with Gillette, where I would say the company has I think off late from the last maybe 1 or 2 quarters, they have started showing a little bit of growth. Which is higher than their, you can say, traditional numbers. But Gillette historically also has been quite an expensive stock. And if the stock has corrected maybe 20-30% from the peak and numbers look good, and then usually the stocks will go up from these levels. So beyond that, I think very difficult for me to give you any concrete outlook on both.
Got it. Thanks very much, Amnish. No problem. Appreciate you joining us and running us through some of that commentary and views as well. We'll take a break. We're back. Manoj Gori of Equirus Securities joins in. The focus is on the EMS space and PG Electroplast's fourth quarter numbers coming up. Okay, welcome back. There's a minute to go for the pre-open session to kick off. We'll have rates come up as soon as we get the first ones. Dollar rupee also will come up on your screen shortly. Srikanth Chauhan is with us. It's a Friday morning, so Srikanth on Fridays, and Sudeep Shah is with us as well. Sudeep and Srikanth, thanks very much, both of you, for joining in. Srikanth, you go first. What's your sense? I think the indicative open was slightly lower. And this was true on Wednesday as well. Oil kept falling through the trading session, but the market did not really recover in a significant way or anything. And I think this morning also, the indicated start is lower. So what do you do?
Good morning, Prashant. Good morning, everyone. So I think the way global macros have turned, I am of the view that despite GIFT Nifty is indicating us that we may see lower opening, I am of the view that we may open maybe 50-60 points lower as compared to the current overall GIFT Nifty's level. While looking at the important center point, that is crude, when it is quoting below 93 levels, that means something it is really which is going to come positive for the market. That's my view. Again, if we consider the technical levels of the market, then 23,700 is acting as major support for the market since last almost 3 days. So market is sustaining above the breakout levels. 23,700 is the next level to watch out for. I think that should be the final stop loss for holding any long position. Today, if there is any lower opening, then we should look for adding some long positions with a stop loss close to 23,700. And again, we can expect upward activity towards 24,000, 24,100 sort of levels. That's the overall view.
Okay, got it. Srikanth, you're sounding reasonably optimistic. Sudeep, what about you? You're in the same camp. We'll actually start off with a 100-point downtick. And for starters, at least the rupee has shown some signs of stability yet again, which is good. What would your trade be, Sudeep? Buy the dip?
Absolutely. First of all, good morning, Nigel. Nigel, see, I feel a lot of negative things have already been discounted, and the daily news flow regarding this war now. I feel the markets are now trying to move beyond that, and that is the reason. The best part is that the markets are trading in this range between 23,600, 23,700, and 24,200 on the upside. So closer to lower end of the dip, 23,800, 23,850. I feel it is a decent buy. 23,700 will be my stop loss too, because last Friday's closing was 23,720, and I feel unless and until these levels are not breached on a closing basis, today being a weekly close, there would be a buy on dip sentiment. And if you see Bank Nifty, capital goods, a lot of sectoral moves are coming towards positive momentum, and even today the IT news is positive regarding Wipro, and that might have a rub-off effect on IT index. So I feel overall it could be a buy on dip sentiment. 23,700 will be my stop loss.
23,700 would be your stop loss. Gentlemen, good morning. Thank you for joining in. So Srikanth, what stocks would you go with?
Yeah, good morning, Rima. So while looking at the broader market, I think there we can get a lot of opportunities to trade for, because it is becoming extremely difficult to trade in large cap companies. One day they are like following to market. I mean to say broadly they are following to the overall volatility of the market, and that's why it is very difficult to trade in large cap companies. But if we consider broader markets, there we are seeing sustained trend. And from that particular segment, if we have to consider any specific stock idea, then there we like APL Apollo, which is forming some double bottom sort of formation close to 1850, 1900 sort of level. Again, the stock can move towards the levels of 2000, 2050. That's the overall view based on its technical formation. So it's a buy at current levels with a stop loss close to 1830. The other stock on which we are bullish is Titagar Wagon. There also we are seeing V-shaped sort of rally in the market, V-shaped sort of rally for the stock. And currently the stock is above its important crucial resistance level of 840, 845. So from here, Titagar Wagon can move towards the levels of maybe 870, 875. We should look for creating long positions with a stop loss at 830 on the downside.
Okay, all right, got that, Srikanth. Sudeep, what about you? What are the picks you have for us?
Nigel, two stocks, one from the power space and one from the metal space. The one from the power space is CG Power. Now, CG Power has given a strong breakout on Wednesday, and I feel here there could be a continuation pattern on the upside. strong volume, strong breakout. 910 will now be the stop loss, and 975 could be the targets which could come in the coming week. The second stock is from the metal space, that is National Aluminium, NALCO. We've seen aluminium prices globally going through the roof and strong traction over there. So the rub-off effect, I feel, will be on NALCO, Hindalco, and between both of them, I feel the risk reward is better tilted towards NALCO. So trading above its 20-day exponential moving average and has broken its consolidation, which it was in the last 1.5 months. So from here on, I feel 428 will act as a stop loss, and the targets on the upside would be 453 and 460.
Okay. Thank you very much for joining in. Let's move on and talk about PG Electroplast. It was a weak set of numbers in Q4. Revenues were in line with estimates, but margins and profits came in below expectations. And the company said that this was one of the toughest, most challenging years for the room air conditioning business. FY26, they had started off the year with expectation of a double-digit revenue growth, and that didn't play out. Manoj Gauri, Associate Director, Equities at Equirus Securities, is now joining in. Manoj, morning. Thank you very much for joining in. Let's begin with PG Electroplast. A quick view. We have the numbers, but where does it go from here, and how does it compare with the others, its peers?
Yeah, good morning, everyone. Thank you for having me on the show. Yes, so if you look at Q4, definitely was a challenging quarter, especially for the third-party manufacturers. Even brands, if you look at, relatively the growth has been posted, which is on a softer note even for the brands. And similarly, if you look at the impact is likely to be higher for the third-party manufacturers. And accordingly, that is clearly visible into numbers of both PG as well as Amba. Now, if you look at the encouraging part is that the positive commentary we are finally seeing from the brands as well as from the third-party manufacturers. So if you look at today, on the call also, PG highlighted that thermal inventory as well as the brand inventories have normalized, which was one of the concern area for last 8 to 9 months, especially the range that we saw during 1Q of FY26. So things are turning favorable for the industry probably from the negative performance that we have seen during FY26.
Hi Manoj, good to see you in. And from the pack, if things are turning around, what's your preference?
If you look at probably today, what we are seeing is strong growth in April, which has continued the momentum in May. We believe brands are likely to do better during the current quarter, as well as for the rest of the year. There might be some uncertainty on the margins given the RM and rupee volatility. But if you look at probably, we believe like brands like Blue Star and LG, they are relatively better placed to capitalize on the growth opportunities that's coming into this room AC category.
Okay, you want to give us stock names?
So Blue Star and LG is something we believe like should capitalize on this growth opportunities which we are witnessing currently.
Okay, all right. Blue Star as well as LG. In fact, LG, after those numbers look quite weak, that dip has got bought into. The other one you track, I think, is IFB Industries, if I remember correctly. That one went through a period of underperformance. But a couple of sessions ago, it came out with a set of numbers and the street took it with both hands. Your view on that name?
See, I think when you look at IFB, company has been taking number of initiatives to improve on the margin side. That has been one of the pain area for the company for a number of years now. Now, if you look at in this quarter, I believe like margins for IFB in the home appliance segment has always been under pressure. If you look at the improvement seems to be significantly or optically much higher. But when you look at the margins itself are just at around 1.7% for home appliances. Now, what we believe is that the major pain of the current RM cycle that we are likely to see will be in 1Q. I think if they are able to manage that 1Q margins and probably are able to even show slight improvement in terms of the efforts that they have taken, probably then IFB remains one of the attractive opportunity. But as of now, it will be too early to say because the major headwinds based on the input cost will be more visible in 1Q for IFB.
Sorry, I missed it in case you did share. In April and May, what has been the pickup? So the companies we spoke to were all very hopeful that April and May and June is going to be much, much better. And they were looking at growth numbers. I mean, I'm going back to the room air conditioning bid, but they were going back to numbers of, say, 15, 20, very confident about that. Has that played out? What is the feedback now for Q1?
See, at secondary level, when you look at April, after the second week, things improve materially. Somewhere we believe, like in the last 15 days, there was a significant recovery in demand, and April would have posted close to around 20% volume growth for the industry. And this was largely driven from your West market and your South market. South market, if you recollect, did not participate into any demand during the March month. Now coming into May, I think, keeping aside East market, South has been a growth driver. West, if you look at both Maharashtra as well as Gujarat, have been posting very strong growth rates. Keeping aside Kerala, if you look at Tamil Nadu, AP, Telangana, Karnataka, all have posted very strong results. Somewhere we believe MTD growth rate for the month of May should be around 5 to 40% in volume terms on YOY basis.
Yeah. Just run us through, Manoj, your coverage universe. I mean, what are the stocks you have under active coverage?
We cover almost the entire consumer durable space. And we believe, like, at the current juncture, room AC definitely seems to be attractively placed, given that the underlying demand trends continues to remain very intact. It's obviously a lot dependent on the weather, and that's the comforting part, that the underlying demand trends continue to remain very intact. Second, we believe wires and cables is one category that has continued to perform very strong performance for last 3.5, 4 years. And we like names like Polycab and RR Cover. So especially if you look at among the large cap names and among the small cap, we continue to prefer Polycab and RR.
Always a pleasure hearing your thoughts. Manoj, thanks for stopping by early this morning. Wishing you a good remainder of the day, and we look forward to your thoughts on the channel rather soon. Well, time to go across to Sudarshan. He's joining us to tell us about the brokerage call of the day. Sudarshan?
So there are few brokerage downgrades for Siemens after the Q4 earnings and the call. So first one is Jefferies. It has downgraded the stock to hold, but increases the target price to 4,000 from earlier target price of 3,800 rupees per share. It says EBIT ex LBM has missed estimates by 32%, as margin has seen a sharp drop of more than 310 basis points. And the concern basically it has highlighted is of rising commodity cost and currency depreciation that company has failed to pass through. Order inflow though was up 33%, but due to margin pressure, it has cut EPS estimates by for FY 26-27 in the range of 23 to 24%, and believes that there could be scope for downgrades if price hikes are insufficient. Next one is MCX. The stock has seen a huge run over the last few months, but now UBS has downgraded the stock mainly because of the valuation front, and also it believes that peak earnings are now behind. It says peak earnings momentum is likely behind. Strong volume run rate is already priced in the stock, and healthy Q1 FY 27 to date volumes. It's normalized from Q4 levels. Stock is trading at 50 times 1 year forward P ratio, which is 10% higher than the historical average. Last one, HSBC has written a note on Tenneco. It maintains buy call with a target price of 700 rupees per share. It said Indian passenger vehicles are entering suspension premiumization cycle, which can be very supportive for stock like Tenneco. And M&M's superior ride quality positioning could accelerate industry-wide adoption of passive plus suspension, and also the feedback that has got from the industry, which indicates customers pay premiums for better comfort and driving experience. And these are some of the factors that why HSBC is positive on Tenneco.
Yeah. Thanks very much, Sud, for that. So that's an interesting list there. Just a quick run through of all the stocks that we've touched upon since the morning. We've had Ashok Leyland, which is up on your screen, 1.25% higher. Siemens, which is down about 0.5. GMR Airports is up 4%. I mean, as Vivek tells us, this is going to be a year where they've turned a net profit as compared to a loss. and the stock is up on the back of it. Physics Vala is the other one. Apar Industries, Zyrus Life, Walcott, PG Electroplast, Bharat Dynamics, PB Fintech are some of the others which are coming up on your screen for now. So that's the picture with regards to where we are starting. Bharat Dynamics is down about 6% or so. Well, we'll have the first rates come up as we kick off things. And we'll just sort of look at the Nifty Bank, etc. Then we'll get to individual stocks, and the broader markets will come up after that. What do we have? The first rates in just a bit from now. It's going to be a higher start. I think about 0.27% higher, 0.3% higher. And this is more like it, right? I mean, in the morning, the indicative start was down, which made no sense because we have, through the day on Wednesday, oil prices fell. This morning, prices are down another $1 or so from Wednesday's, sort of close. So you're picking up at lower levels from 90, 9-ish levels, which is on Wednesday morning, to about 93 this morning. And the market's now reflecting a little bit of that. So 23,950. The Nifty Bank is down about a quarter, 55,000. And the midcap index is up about 200 points, 62,770 or so. 1,050 stocks are up and about 650 stocks are lower. The Nifty heat map will tell you how the 50 stocks are starting. And then we'll pick it up from there. First up on the positive side is Wipro, as Rima was telling us. Wipro on the ADR front was up big time. Infi, HCL Tech, TCS are some of the others which are starting. So it's a positive tech day. And Reliance is up as well. On the other side, Reliance, of course, has announced their AGM date. 19th of June, I think, is the AGM for RIL. Bajaj Auto is down. ONGC is down a little bit as oil's cooled off. Eternal and Adani Ports are some of the others which are starting lower. So it's a 40-point, non-committal kind of a start, but it's positive for what it's worth. 23,940 on the index. Rima.
Well, it's IT, as you said, all the way. The Nifty IT index opens with a gain of 2.5%. Wipro leading from the front and now inching towards a 4% gain. But the top 5 Nifty gainers today are all IT names. You've got Wipro, Infosys, TCS, HCL Tech, Tech Mahindra. We've also seen a comeback of many of the software names in the US. Numbers have been very strong, guidance has been upbeat, and that is providing some confidence in the IT names after being beaten down. So if you strip out the top 5 gainers, which are the IT heavyweights, you've got Reliance Industries below that with a gain of 1%. Go lower down the line, you see buying in auto names, Maruti Suzuki, M&M up and about. L&T is also hopeful that perhaps we're closer to the end of the West Asia crisis, so L&T sees some buying. And let's just pull up if the decline in crude prices is providing some wings to the Asian Paints and Interglobe Aviation. Well, actually, both of them are. Asian Paints is now back in the green. I think it had opened slightly lower, but flat. Numbers are later today. And the other one is Interglobe Aviation. The quarter gone by, at least especially March, has been a tough one for the entire aviation space. So Interglobe Aviation will also be tracked very closely. A quick word on the stocks which are under pressure today. Well, Bajaj Auto, ONGC, BEL, Bharti Airtel, ITC, Coal India, Nigel, that's also down nearly about 0.5%.
Well, that's right. A few stocks actually that are calling for special attention. HBL Engineering, pull up that stock. They've got an LOA for the Kavach project worth around 1,700 crores. So that's the bombastic mover of the morning. That's up and about. I think it's up close to around 8%. Let's get that up for you. 6% on rather large volumes. The stock on the downside, though, that's getting smacked is Delta Corp. The Supreme Court, they upheld the retrospective levy of 28% GST on online gaming companies. So, she is reading that negatively for that particular stock. Well, Mazagon Dock, that stock should be in focus. Reports indicate that the Finance Ministry has cleared a 70,000 crore submarine deal. So, for the time being, the stock is more or less flattish, but we keep an eye out on that one if there is, some meat, because this would be the first P-75I submarine to be delivered to the Navy 7 years after it was signed. So, we'll continue to keep an eye out on that one. ONGC, the stock is lower because crude oil prices have corrected. While over the weekend, we'll be getting, the numbers coming in on the auto sales front. And the stock in focus is Ola Electric. As Sudarshan has been telling us, the Vahan data has been looking up actually. And probably on a month-to-month basis, there could be an improvement. Though on a year-on-year basis, still, there's a big miss out there. Other stocks that are in focus, Bank of India, that one's down close to 3%, highlighting it because it's falling on rather large volumes. So Bank of India is a stock out there. But otherwise, if you want to look at winners, plenty of there. Coffee, you have Coffee Day, up 15%. Badilal is up close to around 15%. Supriya Life, we'll have the management joining us during the course of the day. That's up 10%. And Aditya Infotech is up 10%. They have upgraded their guidance. So that explains why that stock as well is doing quite well. Let's pull some of these up for you.
Wockhardt is another one that's 10% higher today. They've received a marketing authorization from the Indian drug regulator for the antibiotic Xenic. So that's gotten the street excited. And on the way down, as we were highlighting, BDL, Bharat Dynamics, is clearly under severe pressure, 7.5% down.
Lots of stuff, right? And coming through at this point in time. And you know, lots to take stock of as well. The Nifty is now settling about 50 odd points, higher. And this is, I mean, a good outcome after what the GIFT Nifty was indicating for the bulk of the time after 8 o'clock. So not bad at all. The Adani Group stocks, by the way, are flying once again, right? So Adani Total is like a rocket ship. I think 20th of May stock was at about 600, and it's now, as we close this month out, so in about 10 sessions, not even 10 days, I think about 6 odd trading sessions, it's at about 850 from 600 odd levels. So there's a fair bit of action which is coming. Oracle Financial, I was talking about earlier, it's up about 2.25%. You know, Adani Energy Solutions is up about 1 3/4. Aether, I think there is one brokerage note. I'm inclined to think CLSA maybe, but 2%. We'll check. 3% higher on Aether this morning. Persistent is up 2.6. Thermax is up 3. So yeah, I mean there is a lot of action across the board as far as single stocks are concerned. Well, it's conference season, and one of the most attended, sort of sought after conferences is the BofA India Conference, the flagship annual investor conference. This is, of course, 26th edition, which is going to kick off. And as always, we have the top man from BofA joining us to sort of raise the curtain, so as to speak, as far as the conference is concerned. Amish Shah is head of India Research at Bank of America Global Research. Amish, great to have you with us here. Thank you very much for joining us.
Pleasure's all mine.
So what do you expect? Just tell us a little bit about the conference, how this one is set up, and what are you aiming to get to investors who are going to be there? What's the message that you... I mean, of course, there are going to be company meetings, etc., but is there an overarching kind of theme that you've sort of set?
So, Prashant, the theme is new frontiers of growth, because as we know, we know that because of the West Asia conflict, the historical models that were working or themes that were working maybe have peaked out. Maybe there is need for new avenues of growth. We talk about energy security, AI, data centers, shipbuilding. So all of these we think are the new areas where there will be growth driving India. So the focus is on new frontiers of growth. Well-attended conference. It's a week-long event. So we are doing first 3 days in Mumbai, right here, and then we have 6 different field trips across different sectors like internet consumption. There's a policy tour where you meet the policymakers, etc. So it's a week-long event, and we hope that there will be a lot to absorb and learn and understand what will drive growth going forward.
And you want to tell us a little bit about the new frontiers of growth? What will drive India from here on?
So, Rima, as of now, this is expectation, from our side in terms of research. Policies are yet to come out. But I'm sure you would have heard about energy security, some of the... We
spoke about it last time as well as a policy imperative.
Absolutely. But within the energy security, if you drill down, there are 6 different themes, right? There is coal gasification, there is biofuels, there is electrification, deep water exploration, so on and so forth. And within each one of these themes, there are sub-themes. Like, let's say, within electrification, how much comes from nuclear power, how much is coal, how much is batteries, and so on and so forth. So it's a pretty well-encompassing thing. And over and above that, we think that, things like shipbuilding. So I personally believe that shipbuilding is where you had EMS sector, let's say 7 years back. EMS was not a sector in India. It got created on the back of government push and policies and PLI scheme, etc. Same is already replicating now in the case of shipbuilding, because 90+% market share of shipbuilding globally is China, Korea, and Japan. And this is a very labor-intensive sector. Population is aging in these three countries. It's a matter of time that the market share moves somewhere else. And India is trying to say that, we have a plenty of labor. If the market share dislocation happens, why not us? So that's one of the reasons. There are other factors at play, but policy action has already started. There is a PLI scheme that has come in. There is a capex subsidy scheme. There is an interest rate subvention scheme. There's a new fund that they are creating to finance shipbuilding sector and so on and so forth. So we think it can become like a multi-decade theme going forward.
Oh, interesting. If shipbuilding is going to be at the juncture that the EMS companies were 6-7 years ago, then interesting times ahead. Note that. What about cap goods? We've got a few earnings that have come in the last few days. Some of them numbers not that great, but commentary has been fairly positive. How are you feeling about that theme?
So two things I will say, Nigel. So first of all, across the board, a trend that we are seeing is that because of higher inflation or higher commodity prices, order flows and top line growths are a beat.
Yeah.
But because margins are also taking an impact because of commodity. So earnings are not necessarily a beat, right? So headline is a positive, but the bottom line is not a positive. This is by and large just generalizing for the sector. But within the cap goods space, we think that there are some sub-segments of capex that will do very well. Again, the likes of data centers, shipbuilding, defense, cables, transformers, so that as an ecosystem or any company linked to that ecosystem will do very well. But in general, anything that was linked to state government capex, state governments, as we know, have gone more populist and at the cost of capex, therefore. So, so state government capex is primarily in water, irrigation, metros, those kind of things we think will take a knockdown in terms of capex.
Do you have some hard numbers to talk about why you believe shipbuilding is where it was, where EMS was 7 years ago in terms of valuation, in terms of size, and what it can become going forward? Because already shipbuilding is a discovered theme. Unlike, say, EMS, 7-8 years back, it was a very small industry.
Sure. So, Rima, first stat, as I said, 90+% market share is 3 countries globally. It's a labor-intensive sector. Labor in those 3 countries is aging. As a matter of fact, as a result, over time, this market share will move somewhere in the world. If it is labor-intensive, India can at least have
That's India's right to win.
So that's the first point. The second, I would say, is that India, by volumes, is 6% of the global seaborne trade. Not by value, but by volumes. But again, 90+% of Indian cargo moves on foreign flagships. So in times like these, like a West Asia conflict, it's not our war. It's somebody else's war. But let's say if a ship does not sail from there, it becomes your supply chain problem. So from a self-sufficiency or self-reliance perspective, also we need to have some of our own ships. If you think about it, India has very few ships of its own. And there are very few companies that have ships of their own, right? So can you have more ship owners? And if you have to have ship owners, can you also have ship builders? And if you have ship builders, then can you have a value chain around that? Is basically the way you have to think about it. Now, in terms of policy action, you already have a PLI scheme that has come through. You have a capex subsidy scheme that has come through. You have an interest rate subvention scheme. They have classified ships now as an infrastructure category, so it gets into a priority sector lending. And they are trying to create a fund, which can then give out loans to ship builders and ship owners. So right now, it is more in the policy action stage. Over a period of time, if it bulks up and if there is, if India finds success, then you will find many more countries many more companies wanting to enter in this space as owners or builders.
So right now, how do you play it, shipbuilding?
So right now, you guys are right. There are handful of companies which are listed.
Cochin, Mazgaon, Garden Reach, all these companies basically.
Handful of companies which are listed.
But
I think that sector will expand.
But these are stocks you'd be. I mean, I'm just asking you for publish nothing, which is. These are good stocks to buy even after what they've done valuation wise.
So Prashant, I would say that if you really believe that this is going to become a sector of prominence, then I think there is a long runway for growth. But obviously, if the question is more from the perspective of 2026, can I make money? Possibly not.
Okay. The other 2 areas you mentioned, which is transformers and cables, right? Which is, again, capex sectors that you like. This is related to it's like a AI kind of allied kind of story? Because that's the pack which is doing exceptionally well, right? Across the board.
Absolutely, yes. So AI as of now But again, if there is a policy action in terms of power distribution reforms, energy security, then there will be another leg of growth that gets added to this theme. So let's say if these companies are already doing 15 to 20% growth, can they become sustainably 20+% growth companies? And therefore, can the premium valuation sustain? Is a debate, and that debate is dependent on a binary equation of whether energy security becomes a policy framework. But we do think that going by the logic of it and the economics of it, government should definitely announce it.
In India, if you want to look at that, you said data centers is another area where you think there's money, you like that space, right? So direct data center companies, I mean, there are a few, but very few, right, in India. So you have to play it through the allied kind of space.
Through the value chain players.
Cables and wires, perhaps, is a strong enough.
Absolutely. So I think that, given the valuations also in context, transformers in our view are now very expensive stocks. We prefer more of engines, cables and wires, power generators, power transmitters, and power financing companies. And if you have to extend that, then I would say that the companies in the energy value chain, which is coal and gas utilities. So those are companies where we find value. Transformers, while is obviously beneficiary of the theme, is very expensive as a sector, like 70p multiple sector now. It's not something that we are pushing.
So you said cables. What do you mean engines?
The companies that make engines that in turn goes into backup power gensets.
Cummins, etc. I mean, those kind of things, basically.
That sector.
What else there? Cables, engines, I think you mentioned a few other areas.
Power financing companies.
Power financing.
Power generators, power transmission companies, but the regulated ones, with the guaranteed ROEs. We are not that much positive on the renewable plays. Renewable developers, we mean, because these companies have a lot of growth, but their returns are not great. So they all make less, single-digit returns. So it's not a very return-generating sector, even though there is a lot of growth in that space.
Amish, so the sectors that you've highlighted, the themes we've spoken about, are all structural themes, and they will do well in the next 5 to 7 years. But for many of them, you said that perhaps 2026 or the near term may not be the year where you make money. Okay. So if you just had to look at the next 9 months, 12 months, where do you think money can be made in India?
So, Rima, look, this is a tough year for India, or it's a continuation of a tough year from the last year as well. So, if you look at our year-ahead views, we think that from where we are in the markets currently, Nifty can possibly give you a 10% rupee returns from now.
This is best case.
No, this is our base case. So 10% rupee returns from where we are trading right now. But if you're sitting in December of this year, and when you look at the year as a whole, even with a 10% upside from current levels, we are talking about 0% returns or flat returns in rupee terms. So in dollar terms, obviously, because rupee has depreciated, from a foreign investor perspective, your dollar returns are going to be negative for the year as a whole.
Yes.
And therefore, India definitely continues to underperform emerging markets this year. Right. So by and large, you are right. This is not a great year to make money in India. And therefore, it's going to be bottom-up themes. There are about 15, 16 stocks that we are excited about within our coverage, which is high conviction, and they all fall into the themes that we are discussing.
And just one more question. When we last spoke, you had brought down your GDP estimates. We were discussing that, how it was 14%. You brought down your earnings growth expectations from 14% to 8.5%. Now, Q4 was fine. Have you revised the earnings expectations for this year?
We haven't. So first of all, you would recollect that we took our earnings down in March itself. West Asia conflict, you will remember, exactly started on 28th of Feb. So we were anticipatory, we were proactive, we cut the earnings. West Asia conflict, unfortunately, as we speak, is still going on. And as a result, and we had, when we had taken these estimates, the assumption was that the conflict gets over at the end of June. So if it does not get over before the end of June, there is no reason to upgrade our estimates. Now, coming to earnings itself, now I know there is a general belief that the earnings season in the fourth quarter was good. I would say yes and no. Let me explain that. So let's say Nifty, 48 out of 50 companies have reported. At the headline, 2/3 of the companies that have reported have had a beat. Okay, and that's good news. But when you look at the absolute growth number, Nifty has delivered only 4.6% earnings growth, which is not very exciting. Point one. Point two, 1/3 of this 4.6% growth, 45% of these 4.6% growth is explained by commodity rally. So steel, aluminum kind of companies is equal to bulk of your profits. Generally, this is cyclical earnings, and investors don't pay a higher valuation multiple for commodity-driven earnings growth, right? So that's the second point. If you make it broader and look at NSE 200 companies, growth has only been 9%. So again, very muted growth for a mid-cap, small-cap kind of universe.
This is NSE 500.
200.
200, 9.6.
9% growth. 9% growth. 1/3 of that 9% is again commodities. And out there, 80% of the companies have actually missed earnings. Only 20 have delivered a beat. So, you can really swing the earnings data both ways. If you're an optimist, you will focus on Nifty and say that 2/3 are a beat. And you will skip the point that, the growth, there is a beat, but the beat is actually very small numbers. And then final point I will make is that whether you look at Nifty or NSE 200, the beats were in very specific sectors, which is financials, IT, utilities. Variety of other sectors, the beat was nothing meaningful to talk about. So again, from that perspective, in June quarter, because of the West Asia conflict, we know is going to be a stressful quarter. So we are not yet in the camp of looking at upside triggers. Final point I will make, there is a debate going on whether India needs to hike interest rates or not. We as a house have taken a view that there is a 50 basis points of hike in F27. So one this year and one in March of next year. If that comes, that is also a growth impact to Nifty or NSE 200 earnings.
Okay, final question then before we let you go, Amnish. What about the AI trade? Now T has become the new B. Everyone's talking about trillion. Where are you all at? Do you think it's getting into a bit of a bubble territory? Or
as Prashant said, T has become the new B. I'm just joking, go on.
As Prashant said, and the discussion that we had earlier. So where are you all on that one?
So look, here let me bring in our global views. So if I look at the research from my global strategist, he's arguing clearly that the rally has gone overboard. His views are, okay, some stats. So, if we look at the BofA private wealth, it's about $4.5 trillion that we manage. Within that, the allocation to equities is at a historical high at around 66%. The allocation to cash is at a historic low at around 9%. Okay. We worry that the inflation in the US is going to go beyond 4%, and therefore the policy rates in the US will get a hike. And the trade in the US, as we know, is crowded in AI or tech stocks. And his views are that there will be he also does a bull bear indicator. His indicator is currently suggesting that it's an extreme bullishness, and therefore market should have a pullback on a tactical basis. So we are talking about a near-term correction in the US as a result.
And what about our tech names? Big underperformers. The fear was AI is eating into everyone. At these valuations, with regard to the yields, cash flow yields, the PEs in comparison to historic averages as well, and the kind of underperformance, do you think there's a chance that this one's actually bottoming out?
Bottoming out, more likely. Would we go to still bottom fish yet? Not really. So we were underweight. We are not as bearish as we were before because the stocks have come off. But there is still lack of positive triggers in that sector. And the valuation gap between, let's say, foreign listed software companies or IT firms, they trade at 9 to 10 times P multiple. Large caps in India is 15, 16 P multiple. So we still think that the valuation gap is still large enough. So basically, can the stocks flatline from here? More likely, but will they give you like a meaningful return? Unlikely.
One speaker you're really looking forward to listening to from in the conference, Amish?
Well, there are a few, but I would say that we have some, we have speakers coming from the Prime Minister's office. Since we spoke a lot about policy, that's going to be important. We have some state ministers presenting on why data centers in their respective states. Again, a thematic sector, so will be very interesting to hear.
And your personal opinion on this evergreen question of whether we will see capital gains tax on equities being brought down. It's like a huge debate out there. Your own view.
So Prashant, clearly has taxation lopsided allocations of retail savings towards equities? Completely yes. Has the capital gains discouraged foreign investors, especially when rupee is hurting, especially when earnings growth is low, valuations for India are high? So therefore, is India out of my radar as a foreign investor? The answer is yes. and given that large part of the rupee problem right now is also lack of capital flows, I think it makes sense for us to do it. So the answer that I'm trying to give is that, logically, if you think about it, we must do it. Whether we will do it is completely anybody's guess.
We'll get a signal at the conference from some of the people there. Thank you very much, Amish, and good luck with the conference and wishing you all the best. And I think it's a great title for a new report. T is the new B. Trillion is the new billion. If I may say so myself. But thank you again.
And since it's a Friday, I think beer could be the new tea. Kidding.
All right. Great chatting with you. Thank you very much for coming down to the studio. We look forward to speaking with you once your conference is done.
Thank you.
Let's get the management of Physics Wala on the show now. The company's Q4 net losses narrowed 76%. So from 289 crore, it's down to 69 crore on a year-on-year basis. And the management is guiding for a 30% revenue growth in FY27. Prateek Maheshwari, co-founder at Physics Wala, is now joining in. Prateek, thank you very much for joining in. This is Rima here. So let's talk about your guidance. 30% top-line growth, 100% EBITDA growth. What about at the bottom line? Because you've narrowed your losses considerably. You're like 1 or 2 good quarters away from reporting full-year profits. Will we get to will FY27 on the whole at the bottom line be a profitable year? And tell us how you've arrived at your guidance on revenues and margins.
So FY27 full year profitability is a no-brainer for us. Like we would have delivered this year full year profitability as well, but because of the labor law changes and couple of capitalization changes by our auditor, we couldn't have delivered full year PAT profitability. Next year, what we are guiding market is 100% uptick in our EBITDA, upwards of 100% EBITDA, as well as 30% revenue will be improved. This growth is coming primarily from higher enrollment rates and a bit improvement in ARPUs of our courses. And specifically, our K-12 segment, the online K-12 segment, be it state boards, Curious Junior, have outperformed. We have seen 400% growth in these segments, and as well as the early exam categories, IIT, JEE, NEET, continues to show higher enrollment and ARPU growth.
Prateek, hi, morning. Thanks for joining in. Competitive exams and how they're being conducted, and there's a huge debate about that itself, but that's another story, another conversation. Just a quick word on the announcement that you're going to be putting money into your NBFC arm, right?
Yeah.
What was the need to do it? Because you were already doing it through external NBFCs, and I'm assuming most of these loans which will be given out are to students who want to sort of enroll with Physics Wala, right? So it's like, there's a loan and then the money comes, but does it raise risks, underwriting risks?
So we have been doing this initiative from past 2 years, and with the external partner, we could able to lower our NPA as less than 1%, and the loan are essentially less than 1 year duration in nature. Since we teach below poverty line or below middle class students, that is the majority of our students, and we stand for affordability, we have to give them inclusion and as well as empowering with the small ticket size loans. As well as the vision behind this initiative is we wanted to underwrite students on academic ability. So we have the maximum academic data of the country, and by using this data, we have designed the ML model to underwrite students. So that is the vision, and 2/3 of the loans is for PW students and 1/3 is for outside PW students. Having said that, it's just a new initiative. There will not be any meaningful capital allocation from here we will do in this segment, and we will continue to prove less than 1% NPAs, and this will enable our online business, our offline business, as well as standalone. This fintech business will also remain profitable.
All right. Hi, Prateek. Good morning. Good to see you in. Nigel on this side. A quick word with regard to your profitability, because I think offline business is still negative. That's expected to move into the green. Could you give us some clarity on that front? And also, from the time an offline center is opened, how many years does it take to turn around? 2-3 years? If you could help us out with some clarity on that front.
Yep. So I'll quickly touch upon the offline centers profitability. First year of operations, offline centers, it does around -6% of EBITDA. Second year of operations is turns positive and does 5% of EBITDA. And third year is where the return of investment capital happens, where we reach around 12 to 15% of EBITDA. 60% of our Vidyapeeth, which is IIT JEE and NEET examination offline sectors, are already have been clocking profits, and the remaining 40% centers will become profitable in upcoming years. If you see from FY25 to 26, at a group level, the entire offline have improved by 9% in terms of profitability. FY25 it was -19%, and FY26 we have reported -10%. We have already demonstrated a 9% delta, and this year what we are aiming at a group level profitability in offline learning center. This is coming from the same center growth as well as by opening new centers. So we are very confident in the nature of the businesses. The first 3 months is where you get to see the entire year trend, and we are very confident. If you see our quarter 4 numbers alone, the revenue is up by 50%, which is a very healthy sign for the entire year. And this year also, the running quarter also is giving quite promising indicators.
Okay, got it. So good top line growth. You're talking about profitability as well, moving up from here on. So things are looking up for you, going by the guidance that you're giving us. Quick word, you're saying you're going to turn profitable in FY27. I'm looking at a note from Elara. It came out last month, and they had initiated coverage on your stock, and they were sounding quite optimistic on your prospects. But they are penciling in 670 crores of PAT in FY28. Gettable?
Yeah, very easily, very easily. That is, we will deliver much more than that is what we are aiming, and see, the students enroll for grade 9, grade 10th, and we have a retention number. We are on a path to becoming a lifelong learning partner. So it's a very predictable business. None of the macros, be it oil price or be it war, can affect this, because this is a non-discretionary spend of a household. And and by the NEET examination going online, it will open up a whole new set of possibilities. And NEET is our biggest exam categories as well. So that will again give us another push. As well as we have ventured into skilling exam, short-term AI skilling courses, and that is also we have 100,000 students have enrolled in just 1.5 months in short-term AI skilling courses.
Okay. So from a cost point of view, Prateek, not from your AI courses that you give to your students, how much are you investing in AI per se? What is it as a percentage of your overall expenses? How much has it gone up? And by any chance, because there is a lot of chatter about how the cost of AI itself is going up, will it at some point start hurting your margins? Or are you seeing that already?
Yeah, very good set of questions, Rima. See, we have been early adopters of AI technologies. Since 2023, we have been using this within our courses in terms of doubt solving, in terms of subjective answer sheets checking, in terms of motivation, revision, mentorship. See, our average ARPU for the student is 4,000 rupees. So I cannot just like that design a wrapper and consume tokens. So we implemented RAG. We had invested in small language models. We have created the world's most accurate STEM small language model. We have launched it on Hugging Face as well. We have called it Aryabhatta. Now Aryabhatta 2.0 is coming, which will be fine-tuned on 20 billion parameters. So overall at a company level, we spend total 250 crore rupees annually in terms of people and the cloud cost. The AI data scientist as well as the training cost is a part of this cost. This continue to remain same. But AI is a great opportunity in education. If you see history of education, the early preparation used to happen in a recorded learning format. We came up with the live learning format, and now we are AI-powered live learning format. And AI is really making education hyper-personalized. That's why we could see a higher engagement in our batches, higher paid-to-paid conversion in our batches. But the future of the education is a Socratic one-to-one tutor, a conversational AI. And we are committed to make the world's most engaging and affordable AI tutor. And this will be a big release this year, and the entire team is committed towards it. And it will skyrocket our engagements. Like, the course completion rates will go as big as 60 to 90%. This is what our commitment to the markets as well as.
And we look forward to it. Thank you very much for joining us there. And good luck. We look forward to another chat soon. Thank you. That's Physics Wala. Stocks up about 3% or so at this point. There is important news from the IMD. It's at the bottom of the screen and it's not looking good, which is the fact that from their earlier assessment that monsoon rains will be about 92% a long period average. I think we are now at 90%. So, of course, there is an error rate, plus minus, I think, 2-3%. But this is, so basically monsoon forecasts have been downgraded. It was expected to be a poor season, but, the assessment, for example, the monsoon rains were supposed to hit Kerala on the 26th of May, I believe, but then I think that was pushed out to later. So we'll try and have the IMD representative join us a little bit from now. Markets, I think, have taken a bit of a leg lower, but we're up about, we're flat from being up about 50, 60 odd points or so. That was the opening flourish, right to the word go. We made the day's high, and from there, we've sort of, cooled off since. So more on this, as I said, with hopefully the IMD person joining in. But there's some MSCI rejig and adjustments which will take place later today. Vivek is here with those. Vivek, morning again.
Well, good morning. You're absolutely right. So, there could be another reason as far as some sell flows that you could see today. Remember, on account of the revised capitalization and the float factor that MSCI is now looking at, this particular time, India will see net outflows of a little over $750 million that will happen in the second half of the trading session. In terms of, the key adjustments that will happen today, 4 additions. Remember, Federal Bank, over $400 million of inflows will be seen. MCX, over $300 million. NALCO, over $240 million, and Indian Bank, over $200 million. There are 4 deletions as well that will happen today. RVNL, over $140 million. Kalyan Jewellers, Jubilant Food, as well as Hyundai. Hyundai will see outflows of close to $300 million. Now, it's a net outflow event like we just mentioned. And along with that, remember, keep an eye out on the India Small Cap Index as well. That particular index will see 14 additions and 29 deletions. The higher number of deletions broadly due to the significant underperformance that India has seen compared to other emerging markets. Now, along with that, what's actually happening is the broader market universe in this particular quarter has actually seen their market capitalization fall below the minimum global market cap requirement. And like we've been highlighting, India's weightage as far as the MSCI EM index has now fallen to quite low at 11.2%. So that again continues to remain a problem. And like we mentioned, the new free float factor framework is something that will lead to a significant downweight in today's trading session itself.
All right. Thanks very much, Vivek, for that. That is the MSCI rejig story. So some sell flows there as well. Markets absolutely flat now. We'll just take a quick commercial break here. We'll come back and we'll get you an exclusive conversation with the management of GMR Airports on their fourth quarter numbers, the full year FY26 numbers as well, and more importantly, the outlook. That's the conversation with Saurav Chawla of GMR on the other side.
Well, GMR Airports delivered a solid set of results in the March quarter. In fact, the company has reported a profit for the very first time in over a decade. They reported a net profit for the quarter at around 400 crore rupees. That compares with a loss of around 250 crore rupees the same time last year. The company handled a total of 121.6 million passengers in FY26 and now eyes a 4 to 5% growth in this fiscal. My colleague Vivek had a chance to speak to Mr. Saurav Chawla, the executive director of the GMR Group, to put the quarter gone by into perspective and the road ahead. Let's hear him out.
First one, of course, you started off the year, you saw Operation Sindhu take place. In the middle of the year, you did see quite a bit of disruptions in terms of flight timings, flight schedules, aviation capacity. Two of India's largest carriers saw that, both Air India as well as Indigo. And you also, towards the end of the year, saw West Asia conflict that impacted air traffic across the world. Despite that, how did you manage to turn profitable? And going forward, do you feel that you've now set a very favorable base going into FY27?
So our planning always envisaged that we will be profitable during this fiscal year. And that was predicated on one aspect, which was the tariff of Delhi Airport. So as soon as that came, obviously our revenues went up sharply. And that was post the expansion of Delhi Airport to 100-odd million passenger base. So it was always there on cards. We never, give any guidance on revenues and profitability. So we just kept a positive perspective over there. From our perspective, we also plan for some of the black swan events. So whether it was the mishap in Ahmedabad or it was Operation Sindhu, due to which traffic came off, and then the Pakistan airspace has been shut. Because of that, we plan all those in our forecasting, and even today, as I speak, we are very confident that we will continue with this momentum going forward, despite these conditions still continuing in this current fiscal year.
You've said you're going to continue with the momentum, but I'm going to force you and I'm going to try and quantify some of the numbers going into FY27. FY26, you've set a favorable pace given the fact that because of so much disruption, PAX growth across quite a few of the airports was flat to marginally positive. Now with this base and going into FY27, and we also know that you have two very big airports coming up across the country, what kind of passenger growth are you targeting? If you could break it down in terms of the airport-wise, that will be great. But overall, what is the group targeting in terms of passenger growth?
So organically, I think we should grow by about 4 to 5%, despite the current conditions. The first half will be softer than the second half. First half is continually being negatively impacted because of the geopolitical issues. But we believe in the second half, things should come back. And in that context, I think about 4 to 5% organic growth will be there. We have two airports which are going to go live. Very immediately, the Brownfield Airport in Nagpur will come into our portfolio, which will grow our PAX universe there. And of course, the opening up of Bhogapuram or Vizag Airport, that will also.
A quick word on the capacity there and how much you all are expanding it by?
So in both these places, the PAX will be about 2.5 million odd each, is what should get added in the current year. And with respect to, and these will all come into play in Q2. So about a 9-month impact, positive impact will be there.
Okay, understood that. You also gave a very important update to the exchanges, to the investors during Q4, where your largest partner, Group ADP, was paring its stake to a level where both yourself as well as Group ADP will have very similar holding as far as the platform is concerned. Simplify that structure for us. Do they continue as partners? And how are you funding the stake buy from Group ADP?
So I think the press release by ADP is quite clear. They have categorically said that this is one-off transactions that they are taking, and by selling about 7.3% stake to the GMR family. The understanding with ADP has always been from day one is that at all points of time, GMR will be 1% higher in equity stakeholding, issued equity capital stakeholding. So that will continue. The Group ADP, in order to comply with this condition, had converted their equity into a convertible instrument called OCRPS. Right. And so by selling about 7.3% stake, they will be able to convert a part of their OCRPS to maintain that delta of 1% between the GMR and Group ADP.
So no change in operations. The shareholding remained as per what was the original agreement. And a quick word on how that particular stake buy will be funded.
So it's the promoters who have bought it, and they have their own, resources to purchase that stake.
So when we look at the airport business in India, I think we can now broadly categorize it into two key categories. One is the aero part of the business, which has a fixed return, and the other one is the non-aero part, which you've been very excited in past interactions with us. FY27, what kind of growth are you envisaging, especially with new airports coming in? And also a quick word, given that you have so much real estate across your various airports, any plans to monetize any of them?
So very clearly, I'll tell you, we are not too business-based. We are three business-based. Okay. One is the aero part, which is tariff-linked and gives a fixed, return on equity. And that's pretty much well understood. That's the utility part of our business. Right. The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business. Wow. Okay, so that gives you the consumer-facing consumer business that is there. The third business, which till date has been more as land monetization. So you basically offer land to third-party developers who develop commercial properties or hotels on that parcel of land, and we get land rentals. Now that is the lowest margin business for any person. Right. The real business is when you develop properties on those, and then either you monetize them or you earn rentals on it. So as we go forward, that is where our focus would be, is to how to create a platform play on the real estate side of it. How do we make a business model of it? How do we extract enough value so that our equity shareholders derive the benefits of this over a long period of time is what we are really working on. And I think in next few months, we will articulate it to the marketplace. Hopefully in the first quarter call itself of fiscal 27, okay, we'll be able to articulate as to how we are modifying our business model to create this third very valuable vertical.
It's a very interesting conversation with GMR Airports management, and it's a management you don't hear very often at all on television or media. So we will keep getting you excerpts of that conversation through the course of the day. And of course, the full interview will air a little later. Stocks, I think, at the day's high in a market which is not. Markets, I think, have flatlined on the Nifty. We'll take a break. We are back with Vinay Rajani on the other side of HDFC Securities for some technical trades coming up in just a bit.
Welcome back. Number of stocks advancing, still more than the number of stocks declining, which is good. The headline index as well, holding with the gain of around 40 points odd. That's the Nifty. But the Sensex is up close to around 200 points. But let's tell you what the data points are suggesting. Now, you've got the direction right because the Sensex is up 200 points, right? You pull up the 76,000 call. The premium out there is holding at around 629 odd. So directionally, you've got it correct. However, there is some writing being seen out there. Even if you look at the 76,100 call, out there as well, the premium is mildly lower. It's down by close to around 8% approximately, holding at around 570 rupees. While on the flip side, there is some put writing as well we've seen. 75,900 put, the premium holding around 500 rupees. So just plugging in these data points, there is writing being seen on both sides. It appears, the range is more or less 75,400 on the downside. On the upside, 76,600. I say this because the call writing is continuing. Though directionally the markets are moving up, the Sensex as well is up, but there is clear signs of writing so that 76,600 will be a crucial resistance mark. In terms of levels that you're looking at, that 50 and 20 DMA, that's a crucial support. We're holding a little bit higher above that, but that's a crucial support from a bullish perspective. And the bulls will want to actually drive home the advantage, continue to trade above these levels. So interesting times. Nifty as well as Sensex, both of them higher. But I think the options data suggesting that we continue to remain in around this 1,000 to around 1,100 point range. Well, let's go across to Vinay Rajani, Senior Technical as well as Derivative Analyst who joins us on the show. Hi, Vinay. Good morning. Good to see you in. The Nifty is holding up. Sensex as well a little bit higher. Do you think this market's got enough to go ahead and break out of this range?
Yeah, good morning. So Nifty has been consolidating in a narrow range for last 3 trading session, and Nifty is also hovering around its 50 days EM and not able to surpass that decisively. So that level is precisely placed around 24,000. So we are waiting a decisive close above 24,000. But the good thing is that broader market have been participating very well. The mid-cap index is trading at its all-time high. Small cap and micro cap 250 index is also performing very well. So that way it is very good. Advance declare ratio has been positive. So stock specific rotation, sector specific rotation is going on very well, and there is a good chance that market will remain like that, and broader market participation will continue to be like that. So 24,100 is a resistance for the Nifty, above which it will break out, and then we can expect a next target of 24,500. On the downside, we see a strong support coming in at 23,800, where the previous breakout was registered, and 20 days EMA is also placed there. So 23,800 should be kept as a stop loss on closing basis. But broader market participation is very well. Today, IT is performing. Yesterday, last session, metal and commodities were performing. So overall, benchmarks are consolidating while broader markets are doing very well.
Got it. Okay. All right. Individual stocks?
Yeah, so from individual stocks, we like IT. Nifty IT index has actually broken out from the inverted head and shoulder pattern on the daily chart, and looks like that the participation will increase from here, and it can take leadership from here. And we are expecting further 3 to 5% upside in the index. So from the IT index, we like Coforge, which is looking relatively better than the others. So Coforge is placed around 1434. One can trade long around here. One can keep a stop loss at 1410. On the upside, we are expecting a target of 1485. The second stock we like on the charts is the Vijaya Diagnostic. So entire this diagnostic segment has been performing very well, and out of that, Vijaya Diagnostic is looking good. It is breaking out from the consolidation pattern. So around 1302, one can go long. One can keep a trading stop loss at 1280. On the upside, we are expecting a target of 1350 for the short term. So these are the 2 trading picks from my side.
Got it. Okay. All right. Thanks a lot for that, Vinay. Well, by the way, keep your eye out on the bottom of your screen. We're getting some tepid comments coming in from the Cummins management. I think the con call is on, going by the flashes that we're seeing. I guess one of our colleagues are listening into that. Cummins, I think they were talking about moderate growth. And the other one is Solar Industries. Massive order win, I think so. Close to around 1,000 crore order win is what they have won. So that stock is perking up a little bit, while Cummins is moving to the low point of the day because of that commentary. Slip into the break. On the other side, we'll be focusing on oil because oil prices have dipped. Lata will be speaking to Bank of America's global economist, Claudia, on the other side.
Hello and welcome to It's the Economy. Global cues are clearly continuing to be tough from an Asian and Indian standpoint, despite the recent noises of success in peace talks. The Strait of Hormuz actually remains closed, even if crude prices are decently off the three-figure mark. They are not anywhere near comfort zone as far as India is concerned. Joining us to decode the state of the global macros is Claudio Irigoyen. He's the head of Global Economics Research at Bank of America Global Research. He's joining us all the way from the United States. Mr. Irigoyen, thank you very much indeed for staying up for us. Let me begin with the latest data from the US itself, which we have not at all discussed today. The PCE inflation data for April has come in at 3.8% and core inflation at 3.3%, way above the Fed's zone target of 2%. Should we pencil in a rate hike from the Fed in 2026?
I think it's too early to price in hikes. I know the market is moving in that direction. We don't have any hikes for the Fed for this year. And the way we think about it, and I think the way the Fed is thinking about it is the war represents a stagflationary shock for the world economy and for the US in particular. So it means higher inflation temporarily and lower growth. And temporarily is the key word here, because the decision to hike rates will have to do more with two things: the persistence of the inflation shock and the anchoring of inflation expectations. And we don't have enough evidence at this point that this shock will be persistent enough to justify Fed hikes. And we don't have any evidence yet that inflation expectations are the anchoring in a way that justify to move in that direction. We don't have evidence either that the stagflationary shock is impacting significantly on lower growth. So the natural thing to do is for the Fed is to gather more information, to remain on hold, and to understand how persistent this shock could be. Because again, we don't know where the war is going to end next week or 3 months from now. So I think the Fed will continue in a wait-and-see mode, probably with a hawkish bias, with a hawkish tone, but not necessarily ready to hike interest rates.
Okay, I take your point that we don't really know when the war will end. But can you tell us what are your tentative crude price assumptions? Are you assuming $90 average? Are you assuming 95? What would you say is a reasonable assumption?
Our current forecasts are around that, around $92, $93 for average Brent. A quick resolution can buy you $5 to $10 lower on the average, but an escalation can buy you another $10 higher or more, depending on what type of escalation or even delay in the opening of the Strait of Hormuz. Basically, the market is trading has been trading for a while as if there will be a quick resolution. And in the meantime, countries are eating up inventories. And nobody knows exactly what are the limits of those inventories and when the current prices can become, in a non-linear way, much higher. And the perception is that there will be a quick resolution of the war such that we're not going to get to the critical level of inventories that will push energy prices much higher from here. Maybe that's the right assumption. Maybe effectively we want to have a quick resolution. Maybe not. I don't want to necessarily say that I feel closer to one or the other because I am not part of the negotiations. But what we can see is that we have been close to a deal for several weeks, and we're still here.
No, I take your point about the deal being so elusive. Let me come to yields now. That's more important. We are seeing US yields still at close to 4.5%, 4.43 today. What is your sense? Do we spend the entire 2026 at these levels, 4.5%?
Look, the U.S. economy has proved way more resilient than most of what market participants thought. And in addition to that, the AI revolution is happening. It's real. It's impacting positively on the profits of companies. And it's creating a momentum in which the U.S. economy seems to be the best place to sink capital in the world. And we are seeing that with the stock market making new highs every week, etc. So in that environment, it's not a surprise, should not be a surprise that the real rates continue moving higher in the U.S. And if that's not enough, the deficit, the fiscal deficit of the U.S. is climbing higher. We're talking about a fiscal deficit of 6.5% of GDP, and therefore it's not surprising that the investors ask for higher risk premium to hold government bonds. So I would work under the assumption that rates will remain high, meaning at current levels or somewhat higher. And as long as inflation expectations remain an anchor, we're going to see most of the move driven by real rates.
Okay, fine. Let me now come to Asia. There is a triple whammy for countries like India. Higher current account deficit because of crude prices, which is not getting filled up. The current deficit not getting filled up with capital flows because the risk-free return from US bonds is so high. Do you see foreign flows, dollar flows returning to India, or do we have to write off 2026 altogether?
No, you should never write off 26. And obviously there is some valuation issues, in particular in India, and obviously the currency weakening improves risk-adjusted returns for foreigners, but there is a lot of focus on the current account deficit in India. And one interesting thing about the current account deficit in India is that it's not because private savings collapse and there is a consumption boom that is unsustainable. It's more that there has been also, despite an increase in savings, there has been a significant pickup in investment. And part of that investment has been sort of translated into higher imports. So the other side of the account is that investment is driven by imports of machinery, etc. That's a good thing in the sense that those imports will create higher growth down the road. You are not just using a cheap currency to finance a consumption boom that is not sustainable and eventually will create a crisis. So out of the worsening of current account deficits that you can have, the India one is not as problematic as it might seem. Although when you see the behavior of the currency, it looks a little bit under pressure. But in addition to that, obviously, you have a negative term of trade shock because the price of energy is higher and India imports energy, and therefore you have to deal with that. But I want to focus more on that as the source of the worsening and not so much of the source of the worsening of the current account deficit that has to do with a higher investment. Because that's a good, a healthy worsening of the current account deficit.
Yeah, I would agree with you that the quality of the current account deficit is not to worry, it's the capital flows. So would you say the capital flows will return if the war ends and if crude prices recede? Our worry is that it is this lack of capital flows which is pressuring the rupee lower.
I think that's true, and I think also there are a lot of questions that has not been answered on the impact of AI on the India model, and whether this is good or bad for India. Some people think that this could be bad for India. I think it's too early to conclude that. I think that it will be transformational for every country in the world and also for India. And India might have some comparative advantage in these dynamics and might benefit from AI. So I think it's too early. AI is creating a lot of fear. Everybody's talking about the jobs that AI will destroy, and nobody is talking about the jobs that AI will create. If you compare jobs today versus jobs in 1940, 60% of the jobs that we have today did not exist in 1940. And it's important, this is important because there is an asymmetric creativity. Everybody figures out very quickly what are the jobs that AI will destroy, but nobody's creative enough to figure out what are the jobs that AI will create. And there will be a lot of them. So I wouldn't be that pessimistic on that.
Okay, that's good to hear. It's actually very, very encouraging. Which brings me to your very interesting report that you wrote on AI. You're saying that AI can very smartly increase global productivity, but your forecast of global growth at the moment is only 3.1, I think, for the current year and rises to 3.5 next year. What are the chances that global growth picks up anytime soon because of higher AI productivity? A higher growth can lift all boats. It can even boost EM exports.
So as you read in the report, the range is big. AI might end up meaning 10 basis points of higher growth. So we'll go in a steady state from 3.5 to 3.6%, or it can mean a full percentage point. But in any case, that study assumes that this is going to be a transition of about 10 years, and not necessarily that growth will permanently grow to 4.5% for the next 50 years or so, unless there is another shock that justifies that. So I think we want to going to see incremental increases in productivity as adoption gets higher across most of the countries. At this point, adoption is very heterogeneous also across countries. You can compare US versus Europe. It's a very, very easy comparison, and you see that the dynamics of the AI revolution is completely different in those two regions. But I think over the next 5 years, it will have a meaningful impact, positive impact on global growth, which means that some countries will, emerging markets will benefit in general, and some countries will benefit more than others. Today, you can see that Taiwan and Korea are benefiting the most.
Yes.
It doesn't mean that there will be no leapfrogging from other countries on the road, and everybody will be better off.
Okay, well, thank you very much. You leave us at least with on an encouraging note, Claudio. Thank you very much indeed for joining us. Well, that's the word coming in from BofA on how AI might impact, but more importantly, how we still can't arrive at a firm average on crude prices given the geopolitics. Wrap up on Bazaar. On that note, Chartbusters coming up.
The IT sector is a top sectorial gainer today. Wipro extends its partnership with ServiceNow for agentic AI workflows. TCS also signs a deal with Mistral AI. Stock surge across the sector.
Central Drug Standard Control Organization greenlights Wakad's newly developed antibiotic Xenic in India. Stock perks up in early trade.
Execution-led weakness dents results of Bharat Dynamics. Lofty expenses drag profits. Brokerages, Goldman Sachs as well as Motilal Oswal downbeat on the counter, citing challenges in FY27.
Earnings-led strength on shares of GMR Airports. Our company turns profit-making for the first time in over a decade. Management sounds optimistic over continued momentum, tells CNBC TV 18 that they expect organic passenger growth for the fiscal to be in the range of 4 to 5%. That's a CNBC TV 18 exclusive.
Recently listed Aditya Infotech ups its FY27 top-line guidance to around 6,000 crores versus the projection of around 5,350 to around 5,550 earlier. Divergent moves on Alchem as well as Bata on account of Q4 results. Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Vinny. And it's a Friday morning. Vinny, you've got a few hours before you go out to party. But for the time being, the bulls are feeling quite good. The markets are holding with good gains. The breadth of the market is well pretty good. And you have individual stocks doing a thing of their own.
Absolutely, and last day of earnings season almost. So you have some of these earning movers in trade as well that are holding on to very good gains. So whether you look at an Aditya Infotech, that's managing to hold on to very good gains. So that's something we'll watch out for. Earnings season continues. GMR Airports, we spoke in their headlines as well. So that's something that's buzzing around. And IT continues to trend upward today. Top sectoral gainer is the Nifty. IT, PSU banks doing well. Pharma also managing to hold on to gains.
Well, that's right. There are, a few stocks in the broader markets that are really catching your attention. Rain Industries, it seems to be pouring for the time being. That stock has moved to the high point of the day. It's up close to around 6.5%. For this month itself, the week it's up 20%, and in the month it's up close to 49%. Remember, we here at CNBC TV 18 had explained it to you all that aluminium cycle is going to be strong, then CPC as well as CTP. Those are the key products that Rain Industries makes, and they have close to 40% of their revenue that's linked to aluminium. Just take a look at that. It wasn't a one-way run because the last quarter of the last calendar year wasn't very, very great. And then, in fact, had a bit of a dip. And from there, the stock has seen a big, big run. The numbers look quite good. Refinancing of the debt is going to be important, so keep an eye out on that. Another one is JG Chemical. Just pull up the intraday chart out there. That stock as well is bursting away as we speak. Big uptick is what we're seeing on that counter as well. But Vinny, let's get straight to a management.
Absolutely. For the first management for today, we do have Ashok Leyland as management who will join us. They reported largely inline set of numbers in Q4 FY26, although exports were hit due to the crisis in West Asia. Shenu Agarwal, the MD and CEO, is now joining us to speak to us about the outlook of the company going forward. Mr. Agarwal, good morning. Thank you so much for joining us on the show. Q4, good set of numbers that came in from the company, and last 2 months of Q1 also you have been seeing very good volumes as per the Vahan data that we have. But like everyone in the industry has been pointing out that over the last few months, the main concern is that the commodity cost is increasing. So have you been offsetting this impact, and what are the steps you've been taking or planning to take over the next few months as well?
Yeah, I would say commodity cost is definitely a challenge right now. We have seen all kinds of commodities going up, whether it is steel, aluminum, copper, even natural rubber, and all the precious metals. So it is definitely something that is pulling us down at the moment. But we are taking two different steps to try to neutralize the impact. The one is, of course, looking at how much we can pass onto the market. We have taken some price increase between our MHCV and LCV business, ranging between 1 to 2%. So that should help us to a large extent. But also, we are relooking at all our cost in a more deeper manner to see where we can cut our operational cost, whatever can be pushed out in Q2 or Q3. And finally, whatever squeeze we can put on various aspects of the cost. So I think, the discipline in Ashok Leyland around the cost is already of a very high order. But we are looking at it from a new lens now to see how much of this impact we can neutralize through price increases and through cost savings both.
All right, Mr. Agarwal, so in Q4, how much price hike have you taken? And in Q1, have you taken any price increase so far? And also on the input cost spike, how much of the impact on the margin was due to the high input cost? What impact do you see in Q1?
See, Q4, we had taken a small increase of roughly between 0.5 and 1.5%, depending on various models and categories. And in Q1, we have again taken a price increase of 1 to 2%. Now, it remains to be seen that how much of it we can sustain in the market. But at least the intent is to sustain all the price increases that we have taken. And, the other part is, like I said, on the cost savings. So we are looking at every bit of cost in the company, whether it is small or large. We are putting more stringent controls on the cost. So these are the two main drivers of neutralizing the commodity cost impact. Now, as far as the impact on the margin, it is difficult to say right now, or let me say it is too early, because all those negotiations with various suppliers are still ongoing. We would get to know only maybe about 3 to 4 weeks from now as to be able to give a very good estimate of what would be the impact. But like I said, we are trying to neutralize the impact to the maximum.
Sure, sir, point taken there. But now coming to volumes, FY26 was great for the entire industry and it was almost the same for you. And you made a great start to FY27. So for FY27 overall, how do you see the CV industry growth? Will Ashok Leyland outperform?
Yeah, listen, I am actually, personally, I'm a little bit more confident than many other people. And I base this confidence on two different aspects. One is that, when the GST rate cut happened, that was a straight away reduction of 10% of the prices of the trucks. Now, this really made the economics much more better for the fleet operators and even for retail buyers. And the TCO improved, there has been some steady increase, although small, in the freight rates also. So I think that whole economics of the logistics sector, especially the road transport logistics, increased quite a bit. And that actually triggered, the long pending replacement demand in the CV industry. We know that the aging of the fleet in the CV industry is at its all-time high. It has crossed even 10 years, which has never been the case before. Historically, if you see, the aging of the fleet has always been about 7 to 8 years. I think the industry was waiting for some trigger. And that is why you see, the GST impact resulted in a huge growth in the TIV. I mean, Q4 industry grew by anywhere between 15 to 22%, which was unimaginable. I mean, no one could imagine that such thing could happen. So what I'm saying is that there is a lot of resilience or fundamental strength in the demand. I think right now what is happening is, because of the fear of the oil price increase, there is a little bit of a hesitancy, which means that some moderation is likely to happen in demand. But I would take a bet and say that this moderation, whatever moderation happens, and moderation is not with respect to last year, I'm saying moderation is with respect to Q3 and Q4 industry growth trends. So that moderation could happen. But although I'm saying this, but at the same time, I feel that whatever moderation happen will turn into a pent-up demand for the CV industry. And the reason I say that, because the fundamentals are very strong. So if the fundamentals are strong and there is a temporary blip because of some reason, that demand doesn't go away permanently. That demand stays, gets pushed out a little bit, but it stays, right? So that's why I think that, in a more medium-term scenario, even if there is a blip, in demand in, at some point in time. But in the medium term scenario, that demand or that growth in the demand will come back.
So, Mr. Agarwal, in short, near double-digit growth for the industry is possible in the coming fiscal?
Like I said, I wouldn't put a number as of now. Just give us a few more weeks. Let this situation settle on, especially the war and the related impact on the oil prices. And once we have a little bit of a better handle on it, we can give you a very proper estimate as to how FY27 from a demand perspective should look like.
Okay, Mr. Agarwal, but so if I understand correctly, new supplies have not been happening and you are expecting the situation to improve in the next 1 2 months. So can we maintain that 20 to 25% growth outlook for exports in FY27?
Listen, one thing I can tell you that, we have been working very hard on our export numbers. I mean, if you look 3 years, 4 years ago, we were at roughly 8,000 units. Then we went up to 12,000. Then in FY25, we did about 15,000 units. And last year, we did more than 18,000. So there has been a steady demand from 8 to 18 in 3 years. You would agree that is a reasonable kind of growth that we have demonstrated in our exports. Now, our dream is 25,000 in the first leg, which we want to achieve in the next couple of years. But ultimately, that is not where we want to stop. We want to really grow much beyond that 25,000 number. And therefore, the kind of actions we are putting, the kind of steps we are taking, to really ensure that exports remain one of the largest growing segments in Ashok Leyland's business are really formidable. So I mean, this year we may have some challenges in Q1 and maybe some slippages in Q2. But I am very sure because our actions are very fundamental in nature. Our actions are long-term in nature. And therefore, I am very confident that we will achieve that 25,000 number in a couple of years.
All right, Mr. Agarwal, there's a push for EVs across the board from the government and regulatory agencies. So for that segment, how do you see FY27 panning out?
You're right. I mean, EV ecosystem is fast developing into India. I mean, there is a lot of government push. There is a lot of policy push, and I think the biggest factor is that the TCO, which is like the magical word in CV industry, the TCO of a EV vehicle is getting closer in parity to the TCO of a ICE vehicle or a diesel vehicle. So I think with all this, we see a huge shift in the EV penetration going forward. FY26 was a great year for us. In terms of electric buses, we grew more than 200%. In case of electric light commercial vehicles, we grew more than 50%. And while heavy-duty truck segment or medium-duty truck segment is still kind of developing as far as electrification is concerned, but we think that that segment will also show some promise going forward. So we are very optimistic, confident about FY27. I think we should be doing very well, posting very good growth in FY27 as well.
Okay, Mr. Agarwal, we'll wait out for the good growth coming in and hope to speak with you soon again. But thank you so much for joining us this morning on the show. On that note, we're going to slip into a very short break. After the break, Tata Motors has launched the all-new upgraded Tiago, a conversation with the MD and CEO Shailesh Chandra on the company's big hatchback and EV bet. Follow on the other side. Welcome back to Chartbusters on CNBC TV 18. Just look at the Nifty right now, 23,891 level. So again, it's come down below the 23,900 mark and moved to the red as well. Today, it's been a bit of that day that we've seen it go down below 23,900 and then come back up. As of now, a bit of a decline for the Nifty 50. IT continues to do well. Banks also managing to hold on to slight bit of a gain. But let's keep it going now. And like I mentioned before, right, Tata Motors has launched the facelifted Tiago with a pricing starting for the electric version starting at 7 lakh rupees. And with the launch, the company is betting on a revival of the hatchback segment by offering upgraded features. A renewed focus on affordability and sharper styling. On the sidelines of the launch of the event, we had my colleague Shivani, who actually spoke with Shailesh Chandra, the MD and CEO of Tata Motors, to learn more about the new offerings and also the company's plans in the flex fuel segment. Listen in.
Hatch is one category where it has been witnessing lack of updates. You know, unlike what you're seeing in SUVs, there's huge action on modern experiences, whether it is tech, whether it is infotainment, digitization, comfort and convenience within the cabin and all. This was a neglected segment in that sense, and therefore there is a chance that somebody wanted to buy hatch but ended up buying an SUV because it was not giving you that kind of modern feel. That is the idea behind the new generation Tiago, that bring this aspiration back in this segment.
So, you know, Tiago EV is also refreshed, it also got a facelift, but we are seeing globally and in India, it's become challenging. It's difficult time for EVs. How do you see that? Do you see that the penetration is going to probably slow down from here? What is your opinion?
Oh, it's on the contrary, it is exploding. You know, after the Middle East crisis started, I'll give you our data. Before Feb, if my bookings were X, today it is 2 to 2.5X. I have a supply problem. Because of the uncertainty around fuel prices, fuel availability, people feel that it is better to now move to EVs. Because EVs are now, there are more than 500,000 EVs on the road. People have confidence. They have seen neighbors using the car very practically, saving a lot of money. And now when you get a car like Tiago EV coming at such compelling price, and when you see the bus prices, it is actually equal to the price of an ex-showroom price of an entry model of a petrol manual transmission. If you do the on-road comparison, this will be even lower than that price. And then it is saving you significant money. I mean, you would be spending 10 rupees per kilometer in a petrol car. In a bus model, the ex-showroom price are same, and this is coming at 2.3 or 2.4 rupees per kilometer. Significant benefit. I mean, this car can start paying you back after 4 years after it has recovered the price. Every year you can save 1.4, 1.5 lakh rupees, and in 4 to 5 years' time you have recovered the full price of the car. This is unique. So it will explode. It is not going to go down.
But Mr. Chandra, 2 to 2.x spike you have already seen. Do you expect by the end of this year, because the uncertainty is still there?
Yes, I think it will grow more.
Okay.
And with these kind of products coming in very accessible segment, in less than 12 lakh category, you did not have compelling products. And 50% of the market is below 12 lakh.
Yeah.
So no, in fact, more, 60%. 30 lakh cars are sold below 12 lakh rupees. You had no EVs, so therefore, if you are bringing EVs now in this category, we have seen with Punch EV. My demand is exploding in Punch EV. It is no way I will be able to meet that demand. With this kind of a compelling proposition, this will also grow. So I think there is going to be a significant demand growth in less than 12 lakh category now, which was not there earlier.
On the hybrid front, do you think that these things are clashing? Would you say that EVs are growing more? But what do you think? What is your outlook on hybrids?
No, from Tata Motors perspective, we are very clear. There is an existing technology, there is a destination technology. Existing technology will require certain intervention for fuel efficiency improvement, etc., etc. Hybrid is one of the technologies supporting that. If I am already at a penetration level of 15%, and as I said, my bookings show that my booking penetration, even as of today, has gone to 30%, is only that I'm not able to supply. Why I would need hybrid in my portfolio till there is a significant traction that I see on the consumer side on this. Today, hybrid would be maybe 2.5% penetration level. as against now EVs would be trending 5.5%. I would not be surprised if by this year end EVs would start touching 7.5-8%. So I am not under pressure of hybrid. Technology wise, whether I'm ready or not, yes, I'm ready. And I'll be able to respond to a situation. But I don't see a need in my portfolio as Tata Motors, having gone so deep from a localization perspective, tech perspective, portfolio perspective, we have gone significantly ahead on EVs. So I don't see a compelling need to get into hybrids very soon.
But on that front, on the technology front, the government of India is trying to move more towards the ethanol blended products. There is talk about E85, E100, fully flex fuel vehicles are the buzzword these days. Tata was among the first to showcase the Punch FFV. What are the plans on that? Would we be able to see this year, by the end of this year, FFV
No,
from
I think,
Tata?
see, ethanol blend has always a discussion for a long period of time, and it's a what to say, concluded truth that it helps you on the issue of energy security, right? So there's no debate on that. The country wanted to first shift as per roadmap to E20 level by 2030. Collaborative working between the OMCs, government and OEM, it was made possible 5 years earlier. So I think higher blend of ethanol is not a big problem from an OEM perspective, I'm saying, because it is about agreeing on a certain roadmap and then start working towards that in a collaborative manner with the OMCs also, because OMCs have to also supply the higher mix. So FFVs particularly will require a lot of preparation. It will require a clear roadmap going forward in terms of also how the OMCs are going to make the fuel available and all. It will require us time to see how the customers are responding to that, because there will be some level of drop in fuel efficiency, and therefore what is done by the government also in terms of making the proposition stand strong, that also will have to be seen. As far as we are concerned, tech-wise we are ready. We said we had shown in the Auto Expo, by 2027, early 2027, we should be ready with the first product.
All right, interesting chat out there. For the timing, we slip into a short break. You come back, we'll get you more on the markets and stock-specific action. Welcome back. You're tuned in to Chartbusters here on CNBC TV 18. Well, the headline index is more or less flattish as we speak. But you keep an eye out on a few stocks actually from a broader markets. GMR Airports, that stock is holding with a gain of around 5% approximately. So good move is what we're seeing out there. A few more notable movers in trade today. Nitco is up close to around, I think, 5%. So good move out there. Mazagon Dock, I recall in the first few minutes itself, I'd highlighted that there were some reports that are suggesting that there could be an order that's actually going to see the light of day. That's what unconfirmed reports are suggesting. So that stock as well has moved up, as we speak. Relief for Reliance Industries. Supreme Court has squashed the SEBI order alleging fraudulent and manipulative trades. So that big boy, in fact, should be in focus as well. But we'll wrap up on this edition of Chartbusters. That's it from Vinny, myself, and the entire team that put the show together. You stay with us. Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me today, Rima Tendulkar. Rima, good morning. It's a very listless start to the trading session, and what could possibly be a listless end to this week and to this month as well for the markets.
Well, indeed. But so far as we speak for the week, we're up about 0.7% and the midcap index is up 1.8%. But the start was a lot better. In the first 15 minutes, the Nifty almost scaled that 2400 mark at open. But after that, things have gotten very, very quiet. And as you can see, from 10 to 11, markets have barely moved. We've moved in a very, very tight band. IT is doing well. That's the sectoral index which stands out today clearly, hands over fist. You've got all the big movers in IT, LTI Mindtree, Infosys, Wipro, HCL Tech. Midcap IT is flourishing today, but even banks are outperforming today. So the Nifty banking index has a little bit of an outperformance with ICICI Bank and Kotak Mahindra Bank. Along with that, Axis Bank inching towards a 0.5% rally. So that's the other pocket where you are seeing some strength. On the way down, Interglobe Aviation is subdued ahead of its numbers. But Hormuz has now walked over to the big wall and he's going to tell us all the big movers.
As Rima was highlighting, right, it's a very listless session, as has been the case over the last couple of days as well, be it on Tuesday, Wednesday, and even in today's trading session. We are coming back after a holiday. There are things on the global front that appear to be improving, especially because of the fact that crude oil prices are falling. Oil is set for its worst month since 2020. Brent has now slipped below the mark of $93 a barrel. Even today, the losses are extending, but the markets are not taking cognizance of that because we have our own issues to grapple with. And that is, of course, the subpar monsoon forecast that the IMD just issued. We are not falling, but we are not rising either. And also, we are heading into the weekend as well. So it'll be interesting to see how the global developments pan out there. But the one sector that's continuing to do well or continuing to recover is IT. And look at Infosys, Coforge, and that's coming after the activity that Wipro saw in its ADRs overnight. Wipro does not feature surprisingly among the top gainers in today's session. All of these names trading with gains of anywhere between 3 to 4%. You take a look at the earnings reactions. Aditya Infotech is locked in a 10% upper circuit. We'll talk more about that on the show. GMR Airports is doing well. We heard from the management earlier in the day. Alchem Labs has given up most of its gains but still holding on to some green. And Bharat Dynamics, possibly the negative earnings reaction of the day, 7% lower on the stock after the earnings miss and some downgrades that have come in as well. You take a look at the newsmakers. Wockhardt, after the CDSCO approval, is up 9% for its breakthrough drug. MCX, after the breakneck rally that the stock has seen, has seen a downgrade today coming in from UBS, 5% lower now on MCX. PB Fintech, after the block deal, and Cummins India has come sharply off the highs of the day after the management commentary in the earnings call. Some stocks that are moving in the small cap space and they are seeing some very healthy gains. You look at Coffee Day is up 20%, Supriya Life is up 18%, Bajel Projects is up 14% as well. Some strong movers within the small cap space, and stocks at 52-week highs in today's session. Thermax, the capital goods as a theme, continues to do well across some pockets. 8% higher now on Thermax. MV Photovoltaic, another day, another 52-week high for the stock. Same is the case for Adani Total Gas. That too is off the highs of the day. We're still holding on to some green, and LG Equipments too at a 52-week high in today's session, Rima.
Thank you very much for that. But we've got an action-packed trading hour in the next 1 hour. So let's straight away get to it. Praj Industries is the first company on our radar. Muted Q4. Profits in the March quarter have fallen 28%. There was an exceptional loss of 26 crore in FY26. Margins have contracted sharply. We have with us Ashish Gaikwad, Managing Director of Praj Industries, on the show now. Thank you very much, Mr. Gaikwad, for joining in. This is Rima here. Let me begin with your top line. Your revenues for the year have fallen by 1.8%, and this is the second consecutive year of decline. So after peaking in FY26, we've seen some moderation. Can you give us an indication of how FY27 is going to be? Any revenue margin guidance that you could share?
Absolutely, and good morning, Rima. Thanks for having me. Yes, FY26 was a challenging year for us. We experienced several headwinds, and many of those are external, and all of you are aware of it. So what's going to be different in FY27, as you asked me the question? One, we continue to work on our fundamentals in FY26, and therefore all the efforts that we have done in FY26, especially in the acquisition of customers and therefore increasing the utilization of our Praj GenX entity, that we expect to go up in FY27. Second, we are working on changing our international mix as far as the order book is concerned, and then that will convert into the revenues. And third, we have been working on technologies which are indigenously developed. As you know, Praj is a global company with indigenous technologies. Some of those are ready for commercialization. As an example, we have a bio-isobutanol molecule that can get blended as the biofuel for diesel, and therefore that is another area that we would be focusing on. So these are some of the things that we will be working on in FY27.
Since you mentioned all these points, let's get to them one by one. First up, what is going to be your realistic growth that you can project for FY27? You have had 2 consecutive years of top line decline at Praj, but what do you see for this year? And part 2, and can you couple that up with the margin factor as well? What is keeping it in this very tight band? What's dragging them down? And do you see this 5 to 6% range as a new normal when it comes to margins?
Well, certainly we would not like it to be. We would like to get into the double digits like anybody else. But let's unpack some of the questions that you asked me. The first one is on the bottom line. We did experience the headwinds, as I mentioned. So our cost of execution in FY26 went down, and it went up, and therefore the profits went down because of that. Second, we continue to invest into our GenX facility, which obviously therefore reflects into the profitability. That's because we really believe that in FY27, we will be able to utilize much more capacity in that facility of ours. And thirdly, as we increase the pie of our international mix, as I mentioned, and those are some of the orders. Once they get booked, we will convert those into the revenues. Again, that will be a good impact, positive impact on the profitability. But exactly the reverse happened in FY26, and we are going to focus on these 3 aspects and therefore make a positive impact as far as FY27 is concerned. One more thing I would like to bring to your notice for FY26 is there were a few one-timers. One of them is the wage code that came in, and that was an unexpected stuff. Whereas in FY25, the previous year, we had a positive one-timer, and therefore, the difference between the two impacted the bottom line.
Of course. Mr. Gaikwad, since the entire recovery hinges on this Gen X, can you just briefly tell us what exactly is this Gen X facility? And I believe right now it's a cost center for you. You've not managed to incur revenues which are offsetting the overall investment and costs. So tell us what is it, the financials, how much did it drag the overall profitability last year? What do you expect in FY27 in terms of growth, pipeline, top line contribution? And you have this long stated ambition, I think, of getting to 10,000 crore of a top line by FY30. Now you're approximately at 3,000 crore. We're looking at tripling from here on. Is that even possible in the next 4 years?
Well, we certainly hope so. And of course, hope is not a strategy, but we know that there was a slowdown in what we call as the ETCA type of projects, which is the short form of the energy transition and climate action type of projects. This is about the green hydrogen, this is about green ammonia, this is about electrolyzers. And the facility is equipped for serving these types of sectors. Now, in the last 18 months or so, those projects have been very few and far between. And so, we have pivoted to new areas now, and which is where the Gen X facility will be working on. One of them I can share with you is on data centers. We have the capability to provide the cooling solutions, especially the precision fabrication type of modular systems that can go into very large hyperscale data centers, and we have worked on making ourselves adept at it in FY26. We expect to see some of that effort come in to fruition in FY27. Gen X facility, by the way, is a very modern facility where we can provide equipment and modular solutions to the plants, both in green energy sector as well as in the conventional oil and gas, LNG, carbon capture type of industries.
Ashish, very quickly, what is the kind of order pipeline that you're seeing from the data center business currently? One, and two, since you mentioned about improving your international business mix, how much of it do you believe can change by FY27? What's the kind of ratio that you are working with?
Well, I will not be able to give you any futuristic numbers right now. I'm restricted by that. But the data center orders, they are not one-off. If we get the qualification of our facilities done, which is exactly what we have done in FY26, then these are repeat orders. As the data centers grow, you will get repeat orders every quarter going forward, right? And that's exactly what is one of our clear, segments of focus. And we expect to, show you some of that progress in the FY27.
One number, Gen X revenues in FY27?
We don't normally give revenues that are distributed in, different segments, but we would make a significant growth from our FY26 numbers to FY27 numbers.
Ashish, thank you for sparing time and joining us today. Wish you good luck for FY27 as well. The management of Praj Industries, the stock down around 5.5%. Take a short break. Back with more on the other side.
Welcome back. It's flat at the index level, so let's talk about stocks, the big movers. And Bharat Dynamics is clearly one. Very muted set of numbers. Brokerages are downgrading their assessment. Ria now joins in with the fine print and the brokerage verdict. And then we'll go across to Vinny for other stocks.
Well, yes, very weak quarter and folio performance for Bharat Dynamics as well. And this was led by very weak execution in this quarter and for the entire year. The revenue has declined by around 73%. EBITDA also down by 82% for quarter four, and margins contracting by over 500 basis points for the full year, and this profit for quarter four, in fact. And profitability has largely been dragged by higher employee expenses as well as other expenses for the company. And however, the material costs have come down substantially, just 38% of sales versus around 59% in Q4 of last year. If you look at the full year performance as well, that is also quite weak. Revenue down nearly 30%. EBITDA has halved to just 220 crores and margins down to just 9% in this year. And in terms of the order book, that remains undisclosed up until now. But by Q1 of FY26, the order book stood at roughly 23,300 crores. In terms of the brokerage updates on Bharat Dynamics, Goldman Sachs has a sell rating on the stock with a target price that has been cut to 1,260 rupees. They say that execution remains a big concern for the company. And in fact, the company has missed expectations on execution for the 7th year in a row. So it has been a very weak performance for Bharat Dynamics for the last several years. And their channel checks also suggest that the miss in FY26 was due to domestic supply chain issues as well as unavailability of a component from an overseas supplier. So that has what has been dragging the performance for Bharat Dynamics. The inventory has also surged by 75% compared to the previous year, mainly due to finished goods that are waiting for delivery. And the estimated order book as per Goldman Sachs for FY26 is around 25,700 crores, which is quite strong. But overall execution does remain a key concern for BDL.
Riya, thank you for that update there. You know, the last 12 to 18 months, we've not had any major IPOs that have been significant wealth creators, but one of them is Aditya Infotech that has bucked that trend. It's in an upper circuit today as well, following its fourth quarter results. They have also raised their FY27 top line and margin guidance as well. Vinny is joining in with more on this. Vinny.
Hi, absolutely. So obviously we're seeing the wealth creation continue today as well. Look at the revenue growth for the company in Q4 FY26. A 46% revenue growth there. Margins have seen a very sharp improvement. 16% is what the EBITDA margin stands at. Profits of the company also have seen an increase coming in. Now obviously strong traction that came in for the revenue growth came in from the CP Plus brand. What's aiding the margins, you wonder, right? We have the product mix that's becoming better. We have operational efficiencies that is working out well for the company. And like you said, we've seen the rise in guidance that they've given as well. So the revised guidance, what they've given now for FY27, for revenues is 6,000 to 6,500 crores is what they expect the FY27 revenue to come in at. Margins at 14 to 15%. And profit margin is expected at 8.5 to 9.5%. You can see the previous guidance that they've given as well. So sharp increase in terms of the guidance expectation that they themselves have raised for themselves for FY27. That indicates around a revenue growth of 40 to 50% in FY27 as well. EBITDA growth of around 45 to 65%, while profit growth of 50 to 65%. There are some expansion plans as well. So the current capacity is at around 2.5 million units per month. The Kadapa facility is expected to scale up by 2 times in the next 2 years. So apart from just the numbers that they're reporting, capacity will increase. That will lead to better revenues as well. And this is all going to be funded through internal accrual. They're evaluating another land parcel as well in North India to support the long-term growth story. So a couple of things that are happening. They have lens assembly line that is also in the trial phase as well. So they have big expansion plans as well. And already we are seeing a good growth coming in for the company, plus revised guidance.
Yeah, the market cap of the company has crossed 30,000 crore rupees. And this is one of the security and video surveillance companies in India. Strong numbers, guidance has been raised, and there is capacity expansion. Siemens India, Vinny, though, is sounding a bit cautious in their Q4 earnings call. Take us through what they said.
Hi, so first up, in terms of the con call, what they mentioned is that, you know, at least in terms of the public and private capex, they said that not much of a worry on that. So demand is there. But the concern comes in that we are seeing rupee depreciation. There's volatility in commodity prices. So that continues to impact most of the companies. And obviously that's a major impact that's coming for Siemens is what they've highlighted as well. They're saying that growth drivers, where do they see growth coming in from now? They're seeing roads, highways, that's doing well. Railways, that's seeing a stronger pipeline. Data centers, that will do well for the company. They've also won an OSAT facility plant order from in Gujarat. That's mainly for power distribution, facility management, as well as automation. Now, they've taken 2 price hikes in the segments that they have, that is digital industrials as well as smart infra side. In terms of data centers, what they said is data centers accounts to around 12 to 15% of their order backlog. They're a strong player in electrification, so they can easily set it up on their own is what they're saying. So they're quite confident and bullish on the data center side of the story. But they've highlighted that in the smart infra side, there's some concern coming in on steel and cement. They're seeing a bit of a slowdown there in the next 1-2 months. Last 1-2 months is what they've seen a slowdown in. Government ordering, they're saying that yes, there is some bit of a slippage that they're seeing as of now in some segments, but that is not a structural slowdown is what they've highlighted. But we have a note that's come in from Jefferies as well. Jefferies has downgraded the stock to a hold, so they've raised the target price to 4,000 rupees per share. They're saying the rising commodity cost, currency depreciation is something that could not be passed through completely, so that's a bit of a worry for them. Order inflow, that was up 33%, but due to margin pressure, they have cut the EPS estimates as well. They've lowered FY26, FY27 EPS by 23 to 34%, and there could be scope for downgrades if price hike is not sufficient, is what Jefferies is highlighting. So they're not too happy about it, and that's why Siemens also not too excited in trade today.
Well, not too much action in Siemens, but Vinny, thank you for that update. Back to Ria then, who's going to talk about another mover that's doing very well for itself, and that's Wockhardt, and that's another positive news coming in for the company, Ria.
Well, yes, Wockhardt has received a marketing authorization from the Indian drug regulator for its antibiotic, which is Zenec, and they have received approval for imports as well as marketing. Now, this is a key positive for the company, as the approvals for Zenec had been long pending, and the market size is also quite large for them. Earlier this year, the company had said that they are also expecting approval from the European authority for the drug by July and August, and the market size in Europe could be around $400 to $500 million. In total, they are expecting Zenec to do sales around $1 to $2 billion, with about 40% of that coming from the US. The US FDA approval is also pending for them. And India alone could generate about 150 crores in annual revenues for Zenec. So a key approval coming in from the Indian authority. And the stock is also resultantly higher by around 8% in trade today.
Priya, thank you for that update there. Almost 9% higher now on Wockhardt. It's done very well for itself over the last 12 months or so. Take a short break. Back with more on the markets on the other side. Dharmesh Shah of ICICI Securities joins in for a quick chart check and some trading ideas as well. Welcome back. Well, precious little that the market is doing, but a couple of names that are coming up on the radar. Indigo is one of them. That's at the lowest point of the day now, ahead of its results today. More than the results, of course, the forward-looking commentary will be something that will be very keenly watched out for from the management. So keep an eye out on Indigo, 2.5% lower currently. But Dharmesh Shah from ICICI Securities joins in for a quick chart check and some trading ideas as well. Dharmesh, good morning. Thank you for joining in. The Nifty, well, still hovering around that 23,800, 24,000 range. So what are the levels that you're watching out for, and your specific stock calls for the morning?
Yeah, so good morning, all of us. Absolutely, I think so. The way the Nifty today trading, I think it's more for muted trading, I would say, for the market. But if you look from the last few days angles, I think so. It looks like Nifty seems to be finding the support at 20-day exponential moving average, which is acting as a very strong support for the Nifty. So 23,800, 23,700 is something the price range which we expect a strong support for the Nifty, which we expect to hold in this current corrective phase. Eventually, we expect Nifty to head towards 24,400 is likely target for the Nifty in the coming week. Now, why we believe, I think so, 24,400, if you look at the market breadth, I think so, it's again a good indicator to understand the sentiment of the market. It's clearly showing the percentage of stocks which are trading above 50-day and 200-day going average has improved from 67% to 73%. So it's clearly showing this, the current level seems to be more for broad base. Also, the mid-cap index seems to be making a new high. Eventually, we believe the small cap index, which is still 8% away from the lifetime high, should also see a catch-up activity. And finally, I think so, we believe the way the crude oil is behaving at 90 to 91, almost broken down the last 1 month of a rising trend line, indicating, I think so, further acceleration of downward momentum is likely for the crude oil towards 87, 88. So yes, we believe, I think so, most of the things seems to be favoring for the market, and it looks like the way the technical setup seems to be forming from the weekly perspective, it looks like Nifty should close about 23,800, which was acting as a major resistance for last 1 month, and should be looking for a target of 24,400 in the coming weeks. So buy the dip should be the strategy, and a dip towards 23,800, 700 should be looked as a buying opportunity.
Got that? And stocks?
As far as stocks are concerned, we believe, I think so, the way that things are panning out for the market, medcap seems to be clearly outperforming. And inside the medcap space, we do like the auto ancillary space, where Sona BLW remains to be a topic now. If you look from the weekly perspective, the stock has witnessed a breakout from the short-term consolidation range and finally seems to be closing about 1615. If we believe the stocks to head towards 1660, keeping a stop loss of 580. So consolidation breakout likely to panning out for Sona BLW. Apart from auto ancillary space, metal as a space clearly outperforming even in this current corrective phase, where JSW still remains to be a top pick. Now, JSW still, if you look from the long-term perspective, I think so the stock always finding a support at the long-term rising trend line and supported by 52-week EMA. So we believe, I think so, the way the stock is spending on the weekly perspective, it looks for a target of around 1445, giving a stop loss of 1245. So Sona BLW and JSW still remains to be a top pick.
Dharmesh, thank you for sparing time and joining us with your views on the index and your trading ideas as well. Take a short break. Back with the management of Cummins India on the other side. Stay tuned.
Welcome back. Capital goods major Cummins India reported a solid beat in their March quarter. The company delivered a 20% growth coupled with a margin expansion, and the street really liked the operating performance. Exports in FY26, though, have only grown 12% and are down in Q4. We have with us Shweta Arya, the managing director of the company, on the show. Shweta, thank you very much for joining in. Let's just begin with the top line in the big picture. Last year, you ended with 17.5% growth. We were listening into the conference call, and you sort of indicated moderate growth in FY27. So are we looking at lower growth in FY27 versus FY26? Is it still going to be double digit?
Thanks for the question. We have good demand still in the market, in all our segments, in domestic market. Why we are cautious is two reasons. One, the larger macroeconomic environment, and we are watching, just like all other players in the country, how that will turn out to be. And then the second, given the fact that there is geopolitical issues around the world and also demand in some segments around the world, suppliers are definitely facing challenges, and we see those challenges in our and the industry's supply chain. So those are the two reasons why we are cautious, despite the demand that we see in the domestic market.
And what does that mean? If you could formalize that in terms of a range, are we still looking at double-digit revenue growth FY27, or you don't have the confidence based on the situation right now to even guide for that? And in all likelihood, will next year's growth be less than FY26?
Difficult to say at this point in time.
Even for double digit?
That is our endeavor, to get that kind of growth. That remains to be our endeavor, and we see this quarter progressing well. But how the next two quarters turn will determine how that growth looks like. So it'll be difficult to give a guidance today.
Shweta, is the cautious outlook also based on what you are currently observing on ground? We are 2 months down in the first quarter of this financial year as well. What is something that you are observing? Is this supply shortage still persisting from very many of your suppliers, and that is hampering your execution? What's the current status on ground right now?
On the ground, like you rightly said, 2 months down in the quarter. For now, it is shaping up well. The supply challenges are definitely there. There are labor shortages in the supply chain. Commodity prices are increasing. Fuel prices are increasing. So those remain to be seen. Although this quarter is progressing well, that's what I said, that the next two quarters will determine how things turn out. Our execution is still on track. We are definitely challenged, but we are working through those challenges for this quarter. Going forward, we will have to see how it really impacts the execution.
So Shweta, 21% margins, is the impact also going to get reflected in your margin performance, or do you think you can hold on to 21%?
We will definitely try to hold on. Margins, for us, there are good cost measures that have been helping us. Product mix has been helping us. And our growth is very broad-based across segments, so that gives us a very good product mix. That will continue. So all of these things will continue. What will be challenging will be the commodity impact and how soon can that be passed on to the market.
And what's your own sense? And how much is the commodity inflation that you're staring at as we speak?
In different pockets, it's very different. There's copper, there's aluminium.
But on a blended basis, what are we looking at?
Difficult to give you a number. It's changing every day, even as we speak. So I think it will be challenging. We will be able to pass it on. The industry will be able to pass it on, but after a period of time. It will be challenging.
Is that also the reason why exports did what they did in the fourth quarter, that the fact that they were impacted because of this? Now, or is there, do you believe that this was a one-off when it comes to exports, or is there a proper structural softness that you're seeing in exports considering the geopolitical issues that are on ground?
We are seeing softness, and we have been talking about the softness for the last few quarters, that exports has not shown us a very robust growth trend. There are markets like Europe and Asia Pac which still continue to show some growth. And then there are markets like Africa, Middle East, Latin America, which are not showing that growth. So yes, there is impact of the geopolitical situation definitely in some markets that we serve.
Do you expect that to turn this time around?
Not yet, because the geopolitical situation is still continuing.
Okay. Shweta, the attention of the market is squarely focused on data centers. In Q3, you said data centers is about 25% of your power gen business, which is, I think, about a third of your overall revenues. Now, in Q4, I believe that number now stands at 35%. So we've seen a phenomenal jump just quarter on quarter in the contribution of your data center business. And for the full year, it's about 30% of power generation. What is the pipeline and how much can these numbers trend up to, say, when we speak 1 year down the line?
These numbers are definitely trending in the upward direction. After the tax rebates were announced in September, October last year, after that, we have been seeing a lot of momentum in inquiries and the order board from the data center players. And we do see this growing.
One very quickly, Shweta, your industrial segment this time around, is it starting to turn for good? Do you see a further recovery in FY27?
In the industrial market, railways has been growing for us, and we continue to see a very healthy order board on the railway side. On mining, which was not growing as much in the last few quarters, we have seen good order momentum. So mining and railways are growing. Construction is pretty stable, and the compressor segment is actually likely to undergo through its natural down cycle in this year. So it's a mixed bag there.
And how is competition? Is domestic competition picking up, particularly in the genset business? And how sensitive would you be to that?
Domestic competition has been tough. There's nothing different this quarter or going forward. There are, of course...
It's not accelerated. It's not picked up.
It is the same as it was.
Pleasure having you today, Shweta. Thank you for sparing time and joining us. Hope the tide turns soon and wish you good luck for FY27 as well. The management of Cummins India on the road ahead for the company. Take a short break. Continue our conversation on the markets with Ajit Banerjee from Shriram Life Insurance on the other side. Stay tuned. Welcome back. Markets continue to remain where they are, taking the conversation forward with Ajit Banerjee from Shriram Life Insurance, who is joining us in the studios today. Ajit, good morning. Thank you for joining us today, coming down to our studios. The most recent update that we have just witnessed is the monsoon forecast, and it is now turning out to be worse than what was initially anticipated as well. What does that do to the overall scenario right now, because of the fact that just when things were appearing to get back on track, there is this latest domestic curveball that has come in now?
So first of all, first things first, thanks me for having me in the studio. So yeah, I mean, when things are already in a very fragile or in a volatile condition, nothing, I mean, this is again another problem which we would not have liked to have. But at the same time, I think the way it will get impacted, this is also the time when the Kharif crop sowing season will happen. So it is going to definitely impact it adversely. Along with that, it is entire nation is undergoing through a tremendous heat wave, and that will definitely impact the productivity at the farms also, at the productivity in the factory also. So naturally, on the one hand, if the food productivity or the crops productivity goes down, that will have a cascading effect on the food inflation. At the same time, as we are seeing that possibly rate hikes might also start, because beyond a point, I think it is difficult to continue with the same rate hike. Markets are already pricing, as we are seeing 4 to 5 basis, 25 basis point rate hikes in the this year or so. So naturally, to add to that, if the food inflation, it will add further fuel to the fire. So certainly that makes overall affordability a bit difficult. And end of the day, it's ultimately, food supplies might get also impacted. Although I think government has given a lot of assurance that we have a good amount of food grains in the stock. But again, logistics has to be planned accordingly.
Yeah, we were chatting with BOFA, Amish, of the head of BOFA, and he was telling us as a house, they're penciling in 50 basis points of rate hike in FY27. So that's their call. But post the earnings season, have you made any changes to your portfolio? What were the standout trends for you in Q4?
So at this point of time, I would say that we are cautiously optimistic. Everything is not lost out, by the way. But at the same time, we are, certainly, more focused on the large cap still. Where we are more positive is on the banking space. At the same time, we are continuing to have positions selectively on the pharma, as well as on the IT also. We are still there. At the same time, defensive sectors, FMCG is doing well. On the BFSI space, we are also quite positive. These are primarily, and the upstream oil and gas, although the quantum of exposure which we take, the options available are less. But these are the sectors where we are, at this point of time, looking positive at this.
And where do you want to stay away from?
So at this point of time, I think directly, say, the oil consuming, crude consuming sectors, if I may say, so paints, tires and all, those are some of the, at the same time, even although the oil marketing companies, they also have a positive refining margin, right? But that would not be a preferred area for us for this at this point of time.
So is crude the only reason you want to stay away from paints? Because a lot of the companies have mentioned that the competitive intensity is starting to normalize, which had elevated. But Asian Paints is also coming out with numbers today, so their commentary will be more important. But is that the only reason?
See, the thing is, end of the day, the paints as well as the entire crude derivatives for them, specialty chemicals, tires and all, which are all heavily dependent upon crude as a raw material or crude derivatives as a raw material, because there is still a lot of uncertainty. Assuming that for a moment that even if the war stops tomorrow, hopefully it happens, or that we don't know. But then, the supply chains to get normalized will take a lot of time. We have been hearing from the chairman of Aramco as well as from Qatar and all that the plants as well as the pipelines, manufacturing facilities has got damaged quite a lot. So that will take a lot of time to come back to normalcy. Qatar, I think I have heard, if I'm not wrong, they said 3 to 4 years. Aramco CEO has said around 1 year. So certainly, it is and again, there will be a lot of, I think, storing which everybody, because of FOMO factor, they will do. So the price is not going to come down. So we are not expecting it to get normalized very soon, although we would like
Can India, if crude prices remain structurally higher for some time now, 1-2 years, say $90, not at the current levels, But can India give good returns as a whole? I mean, already we've had nearly 2 years of no returns. I'm sure your investors are also questioning, like, what's happening with my portfolio. Can India really give returns if crude remains at $90 per barrel over the next 2-3 years?
Yeah, I guess when I'm hearing the economists as well as, I think RBI commentary also, assuming for a moment that it hovers in the range of 85 to 90, I think that is still manageable. That's what we see. So that way, if continuing with the assumption that it is 85 to 90, I think that will not going to have a significant dent on our fiscal. So at the same time, again, like once the world comes back to normalcy, hopefully, then we can expect that because if you see, if the war would not have been there, then already the EPS earning projections were, I think mid-teen digits is what we were projecting, right? Even Q4 for that matter, if you just, say, slice out the March part, the results were looking good. And even FII, if we see, in the month of February alone, the net outflow was only 6,000 crores. So I think when world were looking, things were going well for India, unfortunately this happened, right? So I think, it can happen because already valuations have come down. At the same time, because our domestic consumption is also, we're starting to pick up quite a lot because of the measures which government has taken. So two things if it happens. One, crude is in the manageable range. Two, that we are going to see that the earnings part starts improving. At the same time, then the valuations also are quite supportive. Then I think there would be some positions which will come down, and also the dollar has to depreciate, because at this point of time the dollar is appreciating quite a lot. So naturally for the FIIs to come back, and the US rate also 30 years has gone beyond I think 5% or more, right? So naturally for them to come back to India, that also has to happen. Then they will definitely be back.
Well, the bottom line, I guess, is handle with care. That's possibly the way you can take it. Ajit, pleasure having you today. Thank you so much for sparing time and joining us. We'll take a short break. Back with more on the other side. Stay tuned.
Thanks.
Welcome back. We had an exclusive conversation with the management of GMR Airports, Saurabh Chawla, that talks about the debt, capex, and the road ahead. Here's a look.
It is the unforeseen circumstances, especially over the last 1 year. And you know, it's the airport story or the infra story is highly correlated to what happens in the economy. So if you grow at about 6 to 7%, your infra grows at about 1.5 to 2x of what your country's growth is. You know, so we over the last, I would say 6 months, because of these sometimes unfortunate events and sometimes geopolitical issues have got impacted. But we are not a quarter to quarter. We are not even year to year story. We are actually a decadal story, right? And most of our investors look at that as to at what point of time are we in our business model and in our model to create cash flows. So if you look at Delhi, for example, Delhi, we have already done our largest capex ever, right? To create 100 million capacity in Delhi. Now, Delhi can go up to 130, right? But small capex is required over the next, maybe next cycle, tariff cycle. So we will do that to grow into that. But those are very small capexes that will grow. So during that interim period of time, as the traffic is growing 5, 7, 10%, it starts to generate significant amount of cash, which does not need reinvestment in the Delhi airport, right? So where does it go? It goes back to the shareholders after meeting with all its obligations to the debt holders. So we are at all our airports, including Hyderabad, although Hyderabad will, in a period of time, grow its capacity from the current 34 million to almost 80 odd million passengers. It will. We have already submitted, you know, in our tariff proposal, but the master planning is right now underway. So once the traffic at Hyderabad also starts to, or is growing, which continues to grow and reaches its capacity of about 34 million, we'll have to put capex to work. But because it's infra, because it's tariff regulated, the cash flows begin as soon as the project is completed and tariff is notified, right? So it's a very interesting play in India. We are still very early stage as a country to create these kinds of infrastructures. And airport in a regulated form is an extremely successful story of creation of infrastructure in our country.
Well, you know, you spoke about your obligation to the equity holders. You spoke about your obligation to the debt holders. A quick word as far as balance sheet growth is concerned. Now, given the fact that you know, 2 new airports are coming, we understand that that will impact debt. Going forward, how are you looking at managing debt? What kind of ratios do you look to maintain? What kind of discipline do you look to maintain?
So you're absolutely right. With 2 new airports coming on board, and potential new airports getting privatized in the future, the debt levels will go up. But the key metric over there is what is my net debt to EBITDA multiple. You know, ideally, I would like it to be about 3.5 to 4. But during the growth times, maybe 5.5 to 6. You know, so there will be sometimes as we acquire assets, it comes along with EBITDA. The debt levels will go up, but the multiple level will go at a much, much lower pace. So as long as we meet that discipline, that there's a cash flow supporting that debt, and the growth of the cash flow is much higher, the debt levels will automatically come down.
Well, with that, we take a leave on this edition of Trading Hour. From Rima and me, thank you for watching. Halftime report on the other side.
Range-bound session for the Nifty as the index slips below 23,900 mark. Uncertainty around US-Iran peace deal weighs on the market sentiment. Realty and IT stocks lead the gains, while auto and metals stock trades.
IT is the top sectoral gainer. Wipro extends its partnership with ServiceNow for agentic AI workflows. TCS also signs a deal with Mistral AI. Stocks surge across the board.
The weather watchdog IMD cuts forecast for monsoon for the year. Rainfall is expected to be below average at 90% versus estimate of 92% of the long period average earlier.
Earnings led strength on shares of GMR Airports. Company turns profit-making for the first time in over a decade. Management sounds optimistic over continued momentum. Tells CNBC TV 18 that they are expecting organic passenger growth for the fiscal to be in the 4 to 5% band. That's the CNBC TV 18 exclusive.
And the conference season kicks off. Amish Shah of BofA Global Research expects around 10% upside for the Nifty from here in INR terms. Likes capex sector like data center, shipbuilding and transformers. Also bats for capital gain tax cut on equities.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala. Starting the show with markets at the day's low. The Nifty is below the 23,900 mark. We are 34 points lower as we speak at the day's low, as I said. The high today was just 24,002. So we've been around that range. It's been a very range-bound market today. And as we speak, we have seen further lows from the levels that we were seeing earlier. Nifty IT is batting it for the bulls. We'll discuss that in greater detail. 2.2% higher on that index, followed by realty. But what's not doing so well? We have auto, CPSE, oil and gas. All these stocks are under pressure. Bank Nifty is high by 0.3%. But mid-caps falling in line with the benchmark. So it's been very consolidated for the Nifty so far. But as we speak, some of these stocks, especially Nifty Bank, losing sheen from the top.
Absolutely. Seems like it's losing a bit of a sheen from the top. Even the broader end of the market, nothing exciting happening there. But a lot of names on the broader end of the market, when you look at it, are buzzing around in trade, right? Whether it's news flows or earnings. Walker holding on to gains of 16-17%. We have Aditya Infotech that is holding on to 10% of gains. NetWeb, Thermax, all of that is buzzing around as well. There are some news flows coming in here, but we'll have to wait out for properly in terms of the data points that come in for these two as well. Clean Sciences, HFCL, those are some of the other names in the broader run of the market that are doing well. But on the flip side, you have GE Shipping that's seeing a fall of around 6% in trade. BDL, after its numbers, also missing estimates, that's also seeing a fall. But that's all about these individual names. We'll talk about it in greater detail through the show as well. But let me tell you all what we have on the show for you all today, right? And our movers and shakers segment, obviously, we'll take you all through and put the spotlight and focus on Bharat Dynamics, Seller World, Alchem Labs, and other big movers in trade today. We have the management of Insecticides India joining us to discuss their Q4 earnings and the impact of IMD revision of the forecast, monsoon forecast on sowing. How will that impact it as well? Now, towards the end of the show, in our Crypto Corner segment, we have the management of a Bharat Web3 Association joining us on tokenization and virtual digital assets.
Okay, let's talk about some important news now. Weather watchdog, the Met Department, they have retained forecast for below average monsoon for the year. Rainfall is expected to be at 90% of the long period average. Rains in June are expected to be around 92% of the long period average as well. The Met Department sees 92% chances of El Nino conditions forming during southwest monsoon as neutral El Nino southern oscillation transitioning to El Nino currently is what they are saying. The watchdog adds that Kerala might see monsoon onset in the next 1 week, with central India monsoon rainfall expecting to see less than 94% of the long period average rainfall. There is also a 60% chance, according to the Met, that there will be deficient monsoon for the country. So very important, affects the economy, affects all businesses. And this is something that we'll be discussing with the economists, with companies, and with the companies catering to the agriculture sector overall. To take this discussion forward, forward to assess the impact on sowing. Also to talk about their earnings, we have with us Rajesh Agrawal, MD at Insecticides India, joining us now. Mr. Agrawal, good afternoon. Thank you so much for joining in. And we are discussing this at a time when there are conversation around El Nino. There is, of course, a forecast which talks about deficient rainfall as well. Give us a sense of how would that impact sowing? How is it different from what we've seen in the earlier years? Are you already seeing things changing on the ground?
Yes, there are some changes. There are worries in the minds of the farmer, what to sow, what not to sow. Because if we look at the country, like the major crop which is being sown in the Kharif season, the wet crop is rice and also sugarcane. So sugarcane sowing is almost completed. And for the rice, farmer is preparing. When it comes to dry crop, then yes, there are gaps because people then start deciding which dry crop they have to. So means if the monsoons are little delayed, then instead of cotton, they might go for bajra. They can adopt maize in certain areas. Certain areas they'll go for pulses. So there can be small up downs between one crop or the another, and still there is a dilemma, and people are waiting for rains. The major worries in the mind of the people is the heat, which India is seeing today. Because in last month we have seen cool weather, and after the cool weather we have seen 48 degrees also in many parts of the country. So that is worrying the people. And as the monsoons were expected to hit India earlier, they have not hit. And now the prediction is after a week. So we are keeping our fingers crossed. As the monsoon hits, the sentiment will start building up. And this is the time when the farmer is sowing his nurseries, and also the transplantation is going to start for paddy in many areas. But for the dry crops, we are still waiting.
Okay, absolutely, Mr. Agarwal. So, given these concerns, monsoon has come in a bit later than what one was expecting it to be. We have some concerns that it's going to be below the average that we've seen as well, right? So what does it mean for you in terms of numbers for FY27? How would you see it if all these concerns continue?
Like if we look at the international scenario, so at this moment, the chemicals are very, very tight. The supplies are tight. The crude is at its high. So which is impacting the availability of the different products. So due to which the sentiment was very up boost in the month of April, and people were wanting the material, network was demanding continuously. But in the month of May, it has slowed down a little. Now as the monsoon starts in the month of June, hitting the country, definitely the sentiment will again start building up again. Now, when we talk about 90 to 92% of rainfalls, they are already good enough, provided the distribution should be good. They should be at regular intervals. There should not be flood-like situation. They should be in gaps which are required. So if it is well distributed, it is good monsoon.
Okay. So 90 to 92% rainfall is good, provided we have decent distribution across the board. Mr. Agrawal, in that case, if we talk about your business in particular, you had indicated a 10% revenue growth in FY26, and you have been able to do a 7% revenue growth. What impact did you see? Was it the West Asia crisis? What are you expecting in terms of revenues and margins in FY27?
FY27, we wish to do a better growth. It's difficult to give the numbers at this juncture because, again, two major problems. One are the international issues, and second is the El Nino issues which are surrounding us. But definitely, we should perform good, actually, and we should have a double-digit growth in this year, for sure.
What about margins?
Margins will also show some improvement because last year, some of the key products, particularly the Maharatna product, got some hit. But this year, they should improve because we have been working very hard around them. And we have been working with the farmer, with the retail chains, so that the retailer and farmer both consume these type of products. So we are working on it.
Okay. So, what also about your premium product side as well? How do you see that moving? Do you expect it to go over 20% in FY27?
That is, of course, the vision of the company that we should grow by the premium products. And we are focusing around them. And this year, again, we are going to launch 2 more. So one will be Granuvia and another will be Spino Ace, which will be the key products which are being launched along with Corteva during this month. Actually, June, they will be available in the market. So this will be the addition to this premium product range. And we expect these to do good. And not only these, but the products which are launched in the last 3 years, about 25 products are launched. So from them also, we see a good increase coming to our.
Okay, so Mr. Agrawal, you indicated a double-digit growth. What are you penciling in terms of volume growth versus value growth? Will it largely be driven by pricing growth, considering that you have high raw material prices and you'll have to pass it on to consumers? Or do you see good volumes in, say, in your premium products or some pockets that are doing well?
It will be the mixed thing. When we talk about the pockets, rice areas will be doing well because if we distribute India into different areas, like North India, the dependence on rain is limited. It is mostly for the sentiment because otherwise there is availability of groundwater. But when it comes to Central India, they are the most hit areas followed by the South India. So these areas are hit. They need the rainfall in the catchment area so that their dams are full and they get the water availability. When it comes to East again generally don't suffer much. Because of this monsoons and the availability of rains is at least like they get the water. So, and the crops are also distributed in these areas. For East, the Rabi season is more important than the Kharif season in many parts of the eastern world. So, the requirement of all the zones of the country is different. And accordingly, I'm not much worried. And this should be a positive year. That is my expectation.
Sir, what about the pricing growth and all as well? What is the expectation here? Will you be taking more price increases as well? Previously, you had indicated 10 to 15% you're taken and you would be looking to take 5 more percent. So any more increase there?
No, I don't think that it will be possible because May has seen a little decline in the prices. In May, the prices have fallen down on an average by 4 to 5%. So June should build up actually. So I don't see a price fall or a price increase, but a stable market should be there. That is my expectation because internationally also if we see, then the prices have stabilized for many products apart from the products which are directly connected to crude.
So what is the situation right now? Since the West Asia war has started, there have been issues with raw materials. We are talking about naphtha, urea supplies. And that is, of course, in some way, other than that, agrochemicals are also impacted because of inputs. Has that situation eased in any way? Are raw material prices stabilizing? And that is why you're seeing maybe a fall in pricing or stabilization in pricing?
Not much actually, because crude generally is at a high price. So the solvents and other things have not shown much improvement. But China, which was a little aggressive in the past, the prices were going up. In China, the prices of the intermediates are falling and some other products are falling because of the poor sentiment. So that has created market a little positive because we hope that at least the price increase is checked. But this Middle East situation is a little bad. So it is still having the impact. But since the market sentiment is not that great, so it was a seller's market in the past. Today, it's a mixed pack, I would say. So we are expecting that as the monsoon starts, then the cards will be open.
Okay. Take that point, Mr. Agrawal. Thank you so much for joining us and explaining to us what's happening in the business, also in light of this forecast that has come in from the weather department, and that is something that we'll be tracking very closely. That's the word coming in from Insecticides India. By the way, the markets are falling yet again. We have the Bank Nifty, which has come off sharply from the highs of the day. So keep an eye out on that one because as we speak, the Nifty Bank has slipped into the red. It's 13 points lower. The Sensex 2 is at the day's low. So is the Nifty. If we get the updated rates on the Nifty, we'll see there is a sharp fall coming in from the highs and the lows continue. So 80 points lower actually. When we started the show, the Nifty was down just 30 points. So keep an eye out on that. We'll slip into a short break. When we come back in our What's Trending segment, we'll decode why IT stocks are surging in trade today. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. The Nifty has moved further lower in trade if you look at it. 23,830 days. Lowest point is what the Nifty is trading at as of now. Nifty Bank is in the red. Look at it, down 25-30 points odd for the Nifty Bank as well. We're seeing the broader end of the market too has come off from the highs, right? So Nifty, mid-cap, small-cap, all of that trading at the day's lowest point as of now. And specifically in the broader end of the market, what's given up gains in the last 20 odd minutes is going to be Praj Industries, Sonata Software, Kajaria Ceramics are some of the names that have come off from the highs as well and trading lower, day's lowest point for most of them. But on that note, let's go across to Vivek, who is here to take us through which are the stocks that are moving around in the trading session this afternoon. Good afternoon, Vivek.
Well, thank you so much for that. Good afternoon, Will. When you're looking at the entire market, what's actually doing quite good today is the entire IT pack. Most of the IT names doing quite well. Names like LTI Mindtree seeing a bit of a bounce back after the sell-off it saw. Names like Infosys, Coforge, Persistent, all of these stocks up anywhere between 1% to 4% each. GMR Airports is the other stock on the back of a strong Q4. Non-aero revenues, almost as high as the GMR Hyderabad Airport revenues, and also monetization as far as the large real estate land bank is something that the street likes. The entire optic fiber stocks, both the names, Sterlite as well as HFCL, both of them moving higher. Sterlite Technologies continues the upswing trend that it has been on in the recent past. Alchem Labs is the other name on the radar, has cooled off a little bit from the day's highest point, despite the fact that earnings were a slight miss. There has been a sharp reduction as far as the IT rate is concerned or the tax rate is concerned, and Nuvama has gone ahead and upgraded the stock on the back of that. And the last stock on the radar, a name we don't speak about too often, is One MI Tech. Strong Q4, 70% AUM growth, and the company says that AUM growth of at least 40% is what they're targeting as far as FY27 and beyond is concerned. Cooled off a little bit, but still high by over 2%. On the other hand, quite a few laggards as well. Bharat Dynamics, an all-round miss, a very weak execution in FY26. That particular stock is down almost 6% in the session today. That is Bharat Dynamics. Praj Industries is the other name on the radar. Again, a very weak execution quarter. Margins contracting over 500 basis points. So that stock down by over 6% today. Ashok Leyland, now despite the fact that the numbers were in line and management commentary was okay, Street is a little worried about the tractor cycle and the CV cycle especially. And on the back of that, you're looking at Ashok Leyland seeing a little bit of profit booking today down over 3%. MCX, a couple of broker downgrades coming in the recent past. Today, UBS downgraded the stock after the sharp rally that the stock has seen. So that particular stock down almost 5% now. And Policy Bazaar, we saw a very large trade prior to market open, and that particular stock has slumped a little bit after that particular block deal went through.
Okay, interesting names there. Thank you so much for bringing us up to speed with those names, Vic. So those are some buzzing stocks. Let's talk about what's trending segment. We focus on the surge in IT stocks. The IT index is the top gainer. Rima is joining us to tell us what's happening here. Rima.
Well, assorted news. So let me start with Wipro, where they've entered into a partnership with ServiceNow for agentic AI implementation across various verticals like cybersecurity, telecom, and procurement. But remember, Wipro ADR was up 18.5%. So the up move wasn't purely linked to this particular announcement. This announcement is important, but not perhaps enough to warrant that kind of an up move. But what we're seeing on Wall Street is that the Magnificent Seven are moving up in a slower pace. And once again, rotation capital is flowing back into the software names and numbers, and the companies are delivering on numbers. So overnight, we had Dell surging nearly about 40%, and the company is guiding for solid numbers, a 47% revenue growth nearly, with AI-linked revenues doubling in next year. Snowflake, it had its best single-day gain surge in nearly 5 years, stock surging about 36%. Not getting into the numbers here, but basically, remember the market was fearing that AI, a plug-and-play AI, is going to completely demolish SaaS companies like software as a service, companies like ServiceNow and many others. There was a SaaS apocalypse, that was the name. But numbers are very, very strong. In fact, ServiceNow went ahead and upped its, Snowflake went ahead and upped its full year revenue guidance for next year. So all the stocks rally, whether it's ServiceNow, whether it's Palantir. So basically, once again, some confidence is re-emerging back into the software and the services name. And then you had Emphasis, which held its analyst day on Wednesday. And I was reading some of the takeaways from that. So this is JP Morgan. They're saying that the company is transitioning from a services-led model to a platform plus outcome-based model from FY27. And FY28 onwards, they will start reporting numbers like ARR, platform, net retention rate, which is what usually these software companies start reporting, product companies are reporting. So even companies are so it's a two-part news. One is that there is some confidence back in the software companies that they're not going to be made obsolete by AI. And secondly, Indian companies themselves, just taking the example of Emphasis, they themselves are pivoting away from services to a platform plus outcome based. So they recognize the need of the hour. And that's just, what's perhaps the news taking place in IT today.
Absolutely, Rima. Thank you so much for that. But Nifty IT on that note continues to be the top sectoral gain as well, with more than 2% gain is what it's holding on to as of now. But time for a movers and shakers segment where we track a whole host of stocks that are buzzing in trade. First up, let's talk about Bharat Dynamics. That's the top loser on the Nifty 500 and down 7%. To take us through the details of this one in terms of earnings, let's go across to Ria. Ria, afternoon.
Well, very weak set of numbers seen in Q4 as well as for the full year of FY26 for Bharat Dynamics. For Q4, the revenue has declined by around 73%, EBITDA also down by 82%, and margins have contracted by over 500 basis points for the quarter. And this has largely been led by weak execution both for the quarter and for the full year as well. And for Q4, the profitability has largely been dragged by higher employee expenses as well as other expenses. However, the material costs have come down substantially to just about 38% of sales versus around 50% of sales in Q4 of FY25. In terms of the full year performance as well, that is also quite weak. Revenue declining by nearly 30% compared to the previous year. EBITDA has halved to around 223 crores and margins down to just 9% on the EBITDA level for the full year of FY26. The order book currently has not been disclosed yet, but as of the end of Q1 of FY26, the order book stood at roughly 23,300 crores. So overall weak set for the company. And in terms of the brokerage views on BDL, Goldman Sachs has a sell rating on the company with the target price being cut to 1,262 rupees. They say that execution remains a huge concern for the company, and in fact the company has also missed its execution expectation over the last 7 years, for 7 consecutive years. So that has been a big drag on Bharat Dynamics performance over the last several years. And in fact their internal channel checks are also suggesting that the miss in FY26 was due to domestic supply chain issues as well as the unavailability of a component from an overseas supplier. And apart from this, the company has, in fact, Goldman Sachs has said that they are estimating the FY26 order book of the company to be around 25,700 crores, which is quite strong. So that remains a key positive among the weak set of results. But overall, execution does continue to remain a big concern for the company.
Okay, all right. 7.5% lower on Bharat Dynamics. Thank you so much, Ria, for joining us with all those updates. Cello World, that is the other stock on our radar. Upasana is joining us with what did she make of the numbers? That stock is lower too.
Well, certainly the weak margin performance is what is weighing down on the stock. If we talk about the revenue first, it has seen a growth of 11%, which is mainly led by companies' writing instrument segment, which has seen a growth of nearly about 64% on year-on-year basis, followed by consumer wear, which has seen a growth of about 7%. And on the flip side, molded furniture has seen a decline of 13% on year-on-year basis. Other income too is down about 41%, further weighing down on the PAT, which is also down 6%. If I talk about the gross margins, even that is under pressure at 46.7% versus 52% same time last year. And EBITDA margins are also under pressure at 19.8% versus 22.9%. Now, if I talk about the full year performance of the company, the revenue has seen an uptick of just about 9%. And PAT has seen a downtick of 9%. Margins are also taken a hit of nearly about 400 basis points. And company has said that on the consumer wear side is where the weakness lies, and the performance in hydration segment has slowed down, while glassware and opalware categories witnessed a steady performance. They are taking some strategic initiatives, including glassware and steel flask capacity expansion for the further growth in the upcoming years. So all in all, it is a mixed set of numbers, and margin is where the pressure lies.
Okay, thank you so much for that, Upasana. Mixed set of numbers that's coming from Cello World. But let's talk about Alkem Laboratories. The stock is managing to hold on to 2% gains. They reported their numbers, largely in line set of numbers that came in. Revenue was slightly better than what the street was expecting, but a good growth in terms of revenue, right? What we have seen coming in. Revenue growth in Q4 FY26, around a 15% growth. Margins have seen an improvement as well this time. 14.3% is the margin at versus 12.4%, so a sharp improvement there. share. Profits of the company, some bit of a decline there, but there were some of the one-offs that came in as well. Now, India business for the company. That's seen a growth of around 9% for the company, driven by key therapy outperformance as well as strong semaglutide traction. Now, in the con call for Q4 FY26, the management gave some FY27 outlook as well. Let's talk about that. They said that US, they expect high single-digit growth in constant currency as well as forex tailwinds, and new launches is something that will support the growth. You have the US growth guidance that they've given, excluding CDMO contribution. They expect that to be good. Rest of the world, they're expecting high teens growth that is expected to continue in the rest of the world. EBITDA margin, they've said a 20 to 21% EBITDA margin with better clarity is expected to come in on that guidance in Q2 and Q3 onwards, maybe Q3 and second half of the year, when they'll see a better clarity in terms of that. But as of now, this is the guidance that they've given. Tolvaptan, which is important for the company, the US launch is expected around September, October 2026. So let's watch out for that. But as of now, good numbers that came in from Alchem Laboratories. So that's about all the stocks that are moving around in the trading session this afternoon, Sonal.
Yes, so we are almost done with the earnings season, but still a lot of them moving around in trade. But with that, we'll do one thing. We'll slip into a short break now. When we come back, Saumil Mehta of Mirae Asset Chair Khan will join in with some trading strategies on the other side. Stay tuned. Welcome back. You're still tuned into Halftime Report. Well, it's important to take a look at the Nifty because it's down 50 points as we speak. A wee bit of recovery from the lows yet again. So continues to be very volatile in the markets. The Bank Nifty is the one which put some pressure on the Nifty. That is the one which has recovered as well, leading to the recovery that we are seeing on the Nifty. We'll keep tracking that for you. But what's happening with the F&O space? Mid-noon, Nigel is joining us now with that. Nigel.
Well, afternoon, Sonal. Yeah, the markets are down, but I'm not too worried still. I'll tell you why. Because the India VIX, well, that's not spurting up, though the markets are down 70, 80 points or thereabouts. So that's giving you some comfort. And as I mentioned earlier today as well, if the VIX can get below that 15-odd mark, that could trigger a fresh round of the uptake. In terms of options data, well, this clearly the call writers have come back into play in today's trading session. And because there is aggressive call writing and some of those puts that were written earlier, they're getting unbound. The PCR has come down to around 0.85 or thereabouts. And we should get a few of those data points up for you on the screen. So you pull up the 24,000 call. The premium out there has come down to around 90 bucks. Remember, the start of the trading session, it was around 130 rupees. At the highs of the day, it was more than 150 rupees. So there's clearly writing being seen at that particular strike. Even the 23,900 call, the premium out there has come down to ballpark around 135 rupees odd. At the start of the trading session, it was close to around 180 or thereabouts. And at the highs, it was even higher than that. So there is writing being seen at both those two strikes. But it appears there is a very strong support at around this 23,650. I say that because 23,800 put is seeing a fair bit of open interest build up. And if you pull up the 50 DMA, you'll see that's exactly where you have that support zone. So 23,650 is the next reference point on the downside. Individual stocks are unfocused. KPIT Technology is one of those big underperformers. It's coming for a bit of a short covering bounce. So, after the sharp correction from the top, you're clearly seeing shorts covering out here. Even Lodha, that's another stock that saw a big correction. Well, that as well has come in for a bit of a short covering bounce. And from the pharma pack, Alchem is clearly the stock that's calling for attention. Fresh buying being seen on that counter. I think the open interest is up close to around 8.5 to around 9% or thereabouts. So net, yes, the market's a little bit jittery, but not too worrying, at least as of now, till around that 23,650 odd level holds out. Back to you guys.
Okay, thank you so much for that, Nigel. We'll watch out for that. Not to worry too much is the word coming in there. But let's also bring on board Saumil Mehta, Head of Retail Research, Mirae Asset Sharekhan, to take us through his technical strategies. What is he keeping an eye out on? 23,650 is what Nigel is saying, not to worry till we reach that level. But it's a very volatile day today, Saumil. What are you keeping an eye out on, as well as your individual bets?
Good afternoon to everyone. Yes, Nigel was correct. 23,650, 23,600 is the level which I'm looking out for as well. Very important, crucial level at this point of time. However, in the very short to medium term outlook, we are still in a range. The range is around 24,200, 300 levels on the upside as a resistance. On the lower end, we are having a support around 23,250, 23,300 levels. And yes, in the very, very short term, 23,650 is extremely important because it is the previous swing low. And also a lot of consolidation has happened in that area. So it's a support zone. Now we are trading exactly around 20 and 40 daily moving average, which is around 23,900, 23,800. So these areas are extremely important, crucial support zones and resistance around 24,200, 24,300. I'm expecting markets to stay range bound, have more time-wise correction, and then pick up from here. But at this point of time, we should definitely focus more on sector-specific and stock-specific action rather than staying, counting on index. Even Bank Nifty, very similar. It is in a range at this point of time. In the very short term, 24,200 will be my crucial support, will be very important as a support. And 200 daily exponential moving average, which is 56,250, that will be also very crucial in the very short term. So my bias is sideways to positive. Focus more on sector-specific and stock-specific action. Two stocks which I have chosen. The first one is NBCC. NBCC has taken support at 200 daily moving average, taken support at short-term averages, has started making higher tops, higher bottom on the weekly, daily charts. Great setup. My target would be 110 and my stop loss would be 97. Next stock is from the IT pack, the heavyweight Infosys. Infosys looks good as well. A breakout of an inverted head and shoulder pattern, trading about 20 daily moving average. Looks great to me. My targets would be 1330 and stop loss would be 1155.
Okay, take that point, Saumil. Thank you so much for joining in today with your technical picks. Have a great weekend ahead. Time for a break now. In our Crypto Corner segment, Manisha Gupta will speak with Bharat Web3 Association's Dilip Shenoy on tokenization virtual digital assets. Stay tuned for that conversation.
CNBC TV 18 presents Crypto Corner, powered by Binance.
On Crypto Corner today, we are joined by Dilip Shenoy. He's from Bharat Web3 Association. Mr. Shenoy, hi, thank you so much for taking time out for us today. And the big talking point across markets today, of course, is the Clarity Act, where we have seen different views and uncertainty creep in yet again. How are you looking at that? Is this normal? Do you see that passing by?
Thank you, Manisha. And, it's very interesting that you talk about the Clarity Act because, again, it is a very interesting aspect of the way the virtual digital asset ecosystem is being regulated. So if you look at the US lawmaking process, it's a to and fro process. The House of Representatives actually passed the Clarity Act, last year, and this was through the Senate. And now in the Senate, there has been a new kind of different stakeholders, and particularly the banking stakeholders, have made certain points which people are seeking clarity. They're talking about, the act weakens security protection, or it creates a loophole for, decentralized finance, etc. But I think this is a typical US lawmaking process, and the strength of the majority party in both houses the relative strength or the strength has actually changed significantly over the last year, not in terms of numbers, but because of other political happenings and the Iran kind of war situation. So this is normal. But again, what it does here is it tries to say, what is a security, what will be regulated by, the securities SEC, where will be a commodity, what will be regulated by the, CFTC, etc. So you're seeing that playing out. But I think given the way that the US system works, there will be discussions and debates, and finally you will see something, there'll be clarity in the Clarity Act.
All right. The other thing really is about on how India continues to still await a draft policy or a policy of any sense or a discussion paper for that matter. But we have seen big banks in the global markets, the likes of JP Morgan and Goldman Sachs and UBS, etc., actually start to on-chain and start financial markets tokenization as well. How are you reading into that, and what do you think is India missing out on?
I think this is a very important question and a very important discussion. And, thank you for having this here. If you look at when we proposed a law or a rule or some sort of a regulation when we were president of G20, the idea was that India would be a rule maker, not a rule taker. A lot of water has flown under the bridge since then, and many of the G20 members have got regulations in place, and even US is now getting regulation in place. And what is happening is the large financial institutions there are getting a march over, let's say, Indian financial institutions of experimenting with tokenized assets or financial products or other things, and are possibly gaining more knowledge and becoming the epicenter of such activity in the world, which will once again, leave other countries, including India, out of that kind of financial activity, and the US or other countries will become the financial capital, even in the virtual digital asset and the Web3 space, and India may lose out. And there are two things playing here. The first thing is that this is one side. The other side is that some regulators in India say that earlier, 2008, there were similar products being developed, not similar products, but products in the financial sector being developed, which we kind of cautioned against, and then there was a bubble burst and India remained protected. I think now it's a time for a serious debate and discussion to balance both views and allow it to happen. But yet at the same time, we are seeing some pilots being done by some organization of tokenization of securities or tokenization of real estate. But the Indian financial institutions have not yet got into it. And will this mean that they remain disadvantaged, or they are not competitive enough as their foreign counterparts who transition to the new financial and IT architecture of the future, and we lose out? So I think it's a very important thing, and here possibly the Indian financial institutions and the banks and other financial institutions need to seriously look at this and look at ways and how we can actually work together to not lose out leadership in this area.
But when you look at the overall markets right now, Mr. Shenoy, we will wait for that, of course, in sense of what India brings out in policy paper. But when you look at the overall market right now, would you say there's better maturity? Because for the longest time, we haven't even spoken about meme coins. And from that whole dominance that we've seen Bitcoin hold, it does seem like Ethereum and Hyperliquid and Solana and XRP seem to be getting their due now.
Yes, Manisha, if you see the evolution of any kind of financial asset, people first, when they come into a new asset class, try and move with the trusted kind of products there. And in the virtual digital asset space, undoubtedly Bitcoin and Ethereum were the two main things. In fact, even yesterday at the earlier this week in the CNBC Awaz Bharat Economic Samvad, there was a discussion for first-time investors to look at, Bitcoin and Ethereum. But now, a lot of people in the market and a lot of analysts have come in and analytic frameworks are developed where you're seeing tokens like you mentioned, Hyperliquid, Solana, or XRP, which are based on applications. And these applications are finding traction. More applications are being developed for them. There's a greater demand for those products, and therefore the prices are rising. And they're not as volatile as the other prices or the virtual digital assets they are. And this definitely does reflect maturity in the market. This looks at also a lot of developmental activity happening on these chains and products being developed there. So it's a very positive development, and you're seeing it reflected in India as well.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Well, the market continues to trend lower. The mid-caps are now down to 80 points. So that is one index which is on our radar and is underperforming at the day's low. But in the broader markets, we do have stocks which are buzzing on the upside. Walk hard on the back of the news update that came by is at the day's high, 17% higher on that one. Supriya Life Sciences on the back of numbers. We'll be speaking to the management in just a bit, so you'll get more insights on that one. Locked in upper circuit. We do have Relaxo Footwears as well, doing well in trade, 16% higher on that. But the market texture continues to be very volatile. So we'll see which way things go for now. But more stocks on our radar. Aditya Infotech is one of them. It is following Q4 numbers. Tell us about the numbers this time around, Vinny.
Hi, Sonal. So, yes, numbers, good numbers that came in, but they've raised the guidance for FY27 as well, right? So, first in terms of numbers, 46% revenue growth in Q4. EBITDA margins have seen a sharp expansion. You're seeing the profits of the company also have seen a very, very strong growth, 169 crores versus 55 crores. So, good performance all in all that came in from Aditya Infotech. Now, obviously, it's a fairly recent listing as well. Revenue growth, what was supporting the revenue growth? They saw strong traction that came in for their CP Plus brand. Margins, what aided the EBITDA and the margins of the company, product mix that was favorable, as well as operational efficiencies. That's something that led to a better performance for the margins. Guidance, now that's where the excitement comes in, right? What have they done? Previously, they'd given a guidance for FY27 where they said revenue would grow in the range of 5,350 to 5,550 crores. Now they've revised it up and they've said that now they expect the revenues to come in at 6,000 to 6,500 crores. Margins from previous FY27 guidance of 12 to 13%, now they've given a 14 to 15% guidance for the margins. And PAT margins, they expect that to come in the range of 8.5 to 9.5%. So in terms of the FY27 guidance, revenue, they expect the growth to be in the 40 to 50% range. EBITDA in the range of 45 to 65%, while in terms of the profit, they expect that to be in the range of growth in the range of 50 to 65%. Capacity plans, that's what they've announced as well. So when you talk about the capacity plan as well, they said they have a current capacity of around 2.5 million units per month that is there. Now the Kadapa facility will scale it up 2 times in the next 2 years. So big expansion plans. This is all going to be funded through internal accruals. They're evaluating a land parcel in North India as well to support their further long-term growth needs. Lens assembly line is also in the trial phase. So a lot that's happening on the capex story as well. And once all this capex comes up as well, they would see, and one would see more growth coming in as well. But that's why Aditya Infotech today is locked in upper circuit.
Okay, all right. That's about Aditya Infotech. And with that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action ahead.
It's a range-bound session for the Nifty and the final trading day of the week. The index is trading below the 23,900 mark. Uncertainty around the US-Iran peace deal weighs on market sentiment. Realty and IT stocks lead the gains while autos and metal stocks drag.
IT is the top sectoral gainer. Wipro extends its partnership with ServiceNow for agentic AI workflows. TCS also signs a deal with Mistral AI. Stock surge across the sector.
The weather watchdog IMD cuts forecast for monsoons for this year. The rainfall is expected to be below average at 90% versus estimates of 92% of the long period average earlier.
Earnings led strength on shares of GMR Airports. Company turns profit-making for the first time in over a decade. Management sounds optimism over continued momentum. Tells CNBC TV 18 that they expect organic passenger growth for the fiscal to be in the 4 to 5% band. That's CNBC TV 18 exclusive.
And the conference season kicks off with Amish Shah of BofA Global Research expecting around 10% upside from the Nifty from these levels in INR terms. Likes capex-oriented sectors like data centers, shipbuilding and transformers, also bats for capital gains tax cut on equities. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, it's right before the weekend, but the markets have come off those highs that they saw in the day, right? Now, all of it is in the red. Mid-caps also underperforming the blue chips now.
That's been the story of the market, just not able to sustain at higher levels. In fact, today is a day of a lot of lasts, actually. It's the last trading day of the week, the last trading day of the month, and also the last day of this quarter's earnings season. So there are plenty of numbers that are still coming in. There are still awaiting two major numbers from the Nifty pack, which is Asian Paints and Interglobe Aviation. Both of them going to be reporting numbers soon. Indigo 2 is trading with losses of around 2.5% before its results. And a lot expected from Asian Paints this time, with whether the competitive intensity has finally ebbed and that the numbers are finally starting to show up. Nothing much on the stock front as of now for Asian Paints. But for the index, well, the index is nearing some very important support levels that of 23,800. That's the most important level that the bulls would want to defend before close. That is one. The Nifty Bank, 55,000 is one level that the bulls would want to close above for the week. That appears to be a little unlikely as of now, is at 54,700. Of course, bear in mind that the MSCI rebalancing happens in the final 30 minutes of today's trading session. So that will also have a bearing on what the market moves in the last 30 minutes. But as of now, not looking good. The screen's lower despite the fact that oil prices are down. Both the Nifty and the Nifty Bank at the day's low.
Absolutely. And if you take a look at the sectors, I'll talk about the ones that are doing well because so few are doing well today. We've got that IT pack that's up there. It's over 2% higher. There's renewed optimism over those AI-linked tech stocks. So Infosys up over 3%. We've got Wipro that's doing well as well. Tech Mahindra up 2.5% and Persistent Systems also 2.5% in the green. We've also got that Realty pack that's doing well. That index is up over 1%. Now about 0.5% in the green. We've got Lodha that's gaining, DLF, Oberoi Realty, all of those stocks in the green today. Lodha 2% higher. On the downside, we've got oil and gas names that are the top losers. That index is the top loser today. We've got ONGC down 2.3%, GAIL down 2.2%, Reliance down over 1%, and the auto pack also not doing very well. Most of those stocks in the red. Ashok Leyland down over 4% now. Eicher Motors down 3% and Bajaj Auto down nearly 2%. So that's how the markets are looking today. But to our What's Trending segment, and today we put the focus on that big surge that we're seeing in IT stocks, right? Rima Tendulkar is here with all of those details. Rima, IT stocks doing well. Take us through what's going on in that sector.
Well, a lot of news flow. So let me start with Wipro, where the company has extended its partnership with ServiceNow to provide agentic AI implementation across various verticals like telecom, cybersecurity. Separately, TCS said that they've gotten into a partnership with Mistral again. So companies are taking a lot of steps. And then you had positive news flow coming out of the software SaaS companies out of the US. So whether it's Dell, whose shares surged nearly 40%, very strong numbers, and the guidance for FY27 is for a 47% revenue growth. Snowflake, another big mover, 36.5% share price rise overnight, the biggest single-day surge in the last 5 years. And basically what these numbers seem to be telling you is there was a fear in the market that AI will make software companies, SaaS companies, obsolete. But these companies are delivering very strong numbers. Look at Snowflake, the numbers that I just spoke about. In 3 months, the company's gone ahead and upped its guidance for the current year. So they're now talking about a 31% revenue growth. So basically, there is growth right now. These companies themselves are using AI. So it's just giving some confidence into the services companies back home in India, and money seems to be, capital seems to be rotating. Other companies did well, whether it's ServiceNow, Palantir. And then again, getting back to the Indian companies and the steps they're taking. On Wednesday, Mphasis had their analyst day, and this is what JP Morgan said. Mphasis said that they are transitioning from a services-led model to a platform plus outcome-based model from FY27, and FY28 onwards, they will start giving you more metrics like the ARR, from FY28 onwards. So companies themselves are acknowledging that change is required, and they are pivoting. They're making the partnerships with AI companies, and they're also transitioning towards product and outcome based. So after the deep sell-off that we've had in IT names, the comeback in the US stocks, software stocks overnight, and the steps taken by the IT companies is giving some confidence, and buying is seen in IT names here.
Indeed, and they are the ones that are still lending some form of support to the market, which has now slumped even further to the day's low, 100 points down on the index currently, but 2% on the Nifty IT as we speak. It's been a good week for this index. But given the uncertainty around fuel prices and the decreasing cost of operations, Indian automakers are increasingly betting big on electric vehicles. We spoke to Tata Motors passenger vehicles' Shailesh Chandra and Shenu Agarwal of Ashok Leyland, who told us of their plans in the electric vehicle space. Listen to what they had to say.
After the Mid East crisis started, I'll give you our data. Before Feb, if my bookings were X, today it is 2 to 2.5X. I have a supply problem. Because of the uncertainty around fuel prices, fuel availability, people feel that it is better to now move to EVs. Because EVs are now, there are more than 500,000 EVs on the road. People have confidence. They have seen neighbors using the car very practically, saving a lot of money. And now when you get a car like Tiago EV coming at such compelling price, and when you see the bus prices, it is actually equal to the price of an ex-showroom price of an entry model of a petrol manual transmission. If you do the on-road comparison, this will be even lower than that price. And then it is saving you significant money. I mean, you would be spending 10 rupees per kilometer in a petrol car. In a bus model, the ex-showroom price are same, and this is coming at 2.3 or 2.4 rupees per kilometer.
EV ecosystem is fast developing into India. I mean, there is a lot of government push. There is a lot of policy push, and I think the biggest factor is that the TCO, which is like the magical word in CV industry, the TCO of a EV vehicle is getting closer in parity to the TCO of a ICE vehicle or a diesel vehicle. So I think with all this, we see a huge shift in the EV penetration going forward. FY26 was a great year for us. In terms of electric buses, we grew more than 200%. In case of electric light commercial vehicles, we grew more than 50%. And while heavy-duty truck segment or medium-duty truck segment is still kind of developing as far as electrification is concerned, but we think that that segment will also show some promise going forward. So we are very optimistic, confident about FY27. I think we should be doing very well.
The RBI's annual report for FY26 is out, and it shows that the balance sheet of the RBI grew by 20.6%, much more than the 8.2% growth in FY25. Where else did the RBI spend more or make more money? Lata Venkatesh is here to decode those details for us. Lata?
The RBI's balance sheet is a very esoteric, difficult to understand one, and we only look at it to know how much money they printed. Which of their investments made money for them, because they invest in foreign securities, Indian bonds, gold, etc. So those are the teeny-weeny details. Balance sheet grew much more. It grew by 20.6, as you said, versus only 8.2% growth in FY25. Now, what was the one reason it grew so much? No prizes for guessing. Gold. Gold revaluation was much higher. Gold revaluation rose by 66% in FY26. The year before, it had risen by only 15%. They also printed more notes. The notes in circulation increased by 11.8%. Last year, that is FY25, it had increased by only 6%. Expenditure also grew 102%. Why? Last year, it had grown only by 7%. Why did it grow? Because they set aside a huge 1.09 lakh crore for contingency. So a better part of my explanation is, why was the contingency fund higher? Okay. Actually, the Reserve Bank lowered the amount in the percentage in the contingency fund. They have the liberty to keep the contingency fund at 4.5% to 7.5% of the total balance sheet. They can choose the number. Last year, they had kept it at 7.5%. This year, they actually brought it down in FY26 to 6.5%. So contingency fund should go down, you would think, but no. They had to transfer 1.09 lakh crore, whereas the year before, they had transferred only 44,000 crore. Why did they have to transfer? Because the investments in the contingency fund shrank. Why did it shrink? Because and I can give you that breakup. Foreign securities were, they lost because of the mark-to-market. They lost 90,000 crores. On Indian bonds, they lost 30,000 crores. And on forward contracts, they had to, the mark-to-market valuation gave them a charge of 43,000 crore. If you looked at last year, the year before, they did make losses on the foreign securities. See, you make losses because when interest rates rise, prices of bonds fall. So that is how they've made, losses. They did not make any losses the year before on Indian bonds, and they had not entered into forward contracts. Now we know the RBI does a lot of forward sales this year, and those have to be marked to market. That is where this another 43,000 crore of losses come. And because the contingency fund shrank, they had to transfer 1.09 lakh crore. That explains why the expenditure went up. And just a few more things. These are promises that the Reserve Bank makes in its annual report, what it will do next year. That is this year. It is going to expand its central bank digital currency pilots a little more. That is interesting. They are going to increase tokenization of financial assets. Again, that can be interesting. Imagine if land records are tokenized. It would be a very big forward step. And finally, this is very important, the Monetary Policy Department has promised to review and improve its GDP growth forecasting. That's interesting.
Interesting indeed. Lata, thank you for summarizing the key takeaways from the RBI annual report. By the way, a further fall on the index. Now you're below 23,800, 130 points lower now as we speak. So it's almost a 200 odd point downtick that we've seen from the opening highs, and a part of the reason behind this fall could very well be this forecast from the IMD, which has retained its forecast for a below average monsoon for the year, which is now expected to be at 90% of the long period average. Rains in June expected to be around 92% of the long period average, and the Met Department sees a 92% chance of El Nino conditions forming during the southwest monsoon as neutral El Nino southern oscillation transitioning to El Nino. Currently, the watchdog adds that the Kerala state might see monsoon onset in the next 1 week, with central India monsoon rainfall expecting to see less than 94% of the long period average.
So that's the rainfall forecast that we have. But earlier today, we spoke to Amish Shah on whether a cut in capital gains taxation was warranted given the lack of capital flows to India and the sustained weakness in the rupee. Let's listen in to what he had to say.
Has taxation lopsided allocations of retail savings towards equities? Completely yes. Has the capital gains discouraged foreign investors, especially when rupee is hurting, especially when earnings growth is low, valuations for India are high? So therefore, is India out of my radar as a foreign investor? The answer is yes. And given that large part of the rupee problem right now is also lack of capital flows, I think it makes sense for us to do it. So the answer that I'm trying to give is that, logically, if you think about it, we must do it.
We'll take a short break. Back with more news and updates on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. Let's get you the latest on the US-Iran peace negotiations. The US and Iran are within reach of an agreement to wind down the war. Treasury Secretary Scott Bessent told reporters, but President Trump has yet to sign off on it, and the White House wants a deal that satisfies several key conditions. Take a look at this report.
That we perhaps have the makings of a deal here.
While U.S. Treasury Secretary Scott Bessent was tight-lipped about a possible deal between the U.S. and Iran, sources told Reuters on Thursday that the two sides reached an agreement to extend their ceasefire for another 60 days and lift restrictions on shipping through the Strait of Hormuz. But the sources said President Donald Trump had yet to approve it.
Again, it's always a mistake to get out ahead of the president, so it is all going to be the president's decision.
Iran's Tasnim news agency, meanwhile, said the text of a potential memorandum of understanding with the U.S. had not yet been finalized or confirmed, citing a source close to the negotiating team. According to 4 sources familiar with the matter, the agreement would allow ship traffic through the Strait of Hormuz, while negotiators tackled difficult issues such as Iran's nuclear program. If a new deal is approved, it would amount to the biggest step towards peace since the conflict began on February 28th. News of the possible agreement came after a round of tit-for-tat attacks between the two countries, the latest such incident since the ceasefire took effect in early April. The new deal would specify unrestricted shipping through the strait and would require the U.S. to also lift its blockade of Iranian ports. The U.S. would also lift some sanctions on Iranian oil sales. The U.S. warned Oman not to get involved in any effort with Iran to impose a toll in the Strait of Hormuz, and Trump on Wednesday threatened to bomb the country.
They would like to control it. Nobody's going to control it. It's international waters, and Oman will behave just like everybody else, so we'll have to blow them up.
Treasury Secretary Scott Bessent on Thursday said Oman's ambassador told him there were no plans to impose tolls.
I had a call with the Omani ambassador this morning, and he assured me that there were no plans for tolling the strait. As he said, our countries have had 200 years of good relations. He wants to have another 200 more.
Oman has not mentioned the idea of joint control of the strait with Iran, with which it says it has discussed freedom of navigation. Tehran expressed solidarity with Oman after what it called U.S. officials' threats.
Meanwhile, in a Fox News interview recorded earlier and set to air over the weekend, President Trump said that any agreement with Iran would depend on securing a good deal. Listen in.
A deal that wasn't going to be good for us is the line, ultimately, because, I'm playing it out and we're going to see, and that's what I do. I negotiate, they negotiate. They're very good negotiators. They're crafty. But in the end, we have all the cards because we've defeated them militarily. Look, they have no Navy. Every ship, they have 159 ships. Every one of them are at the bottom of the sea. Every single one. We take pictures of them. We have people going down taking pictures of hundreds of ships. Their Navy is totally gone, 100%. Their Air Force is totally gone, 100%. Their military, we've sort of left it alone because we think that their military is somewhat moderate.
On that note, it is time for us to head into a short break. But as we go, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or Google Play Store, or you can just scan the QR code on your screen.
Welcome back. Now, NASA's plans to build a lunar base and return humans to the moon in the next 2 years were thrown into jeopardy after a New Glenn rocket from Jeff Bezos' Blue Origin exploded during a test in Florida. In a statement on social media, Blue Origin said that it had experienced an anomaly during a hot fire test. Bezos wrote on social media that all personnel are accounted for and safe, and they are working to find the root cause of the explosion.
A small programming note as we wrap up. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune in to CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer and Rhythm Desai, as well as Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Last day of the trading week, the markets have taken turn for the worst. We are down 130 points as we speak, below the 23,800 mark. Started very volatile, and now there's a definite trend that we are seeing. The question is whether we recover from that or we see further lows.
That's right. Good afternoon, Sonal. Like you point out, it's been quite volatile, and it's a truncated week that we are ending. One thing that we'll keep an eye out on, especially in the last hour or so, is the fact that we are going to see the MSCI rejig, and there will be outflows of a little over $750 million. So maybe something that the street is preempting, but especially in the second half, we will see some outflows going out of India as well. But a lot lined up on the show, a couple of very important management interactions as well. So let's start off with the top headlines. Weak session for the Nifty as the index slips below the 23,800 mark. Uncertainty around the US-Iran peace deal weighs on market sentiment. Auto, financials and metal stocks drag. Mid-caps underperform.
On EMI, Tech delivers an over 50% growth in profit. Assets under management soars 70% over 7,000 crore rupees. In a conversation with CNBC TV 18, management lowers FY27 disbursement forecast by 7%, but is confident of achieving 40% growth going forward.
Central Drugs Standard Control Organization greenlights Wocards newly developed antibiotic Zynic in India. The stock extends gains upwards of 15%.
Execution-led weakness dents results of Bharat Dynamics. Lofty expenses drag profits. Brokerages, Goldman Sachs and Motilal Oswal downbeat on the counter, citing challenges in FY27.
Praj Industries bleeds on the back of weak results. The profit falls 28%. Margins contract to 5% from 11% earlier. Management talks ambitious targets. Tells CNBC TV 18 that they hope to achieve 10,000 crores in revenues by FY30.
Okay, those are the top headlines that we are tracking. As we've been pointing out, there was a point in time when Nifty and midcap were underperforming at the same level, but now the underperformance in the midcaps has gotten worse than what we are seeing in the Nifty. So the midcap index is down 0.8%. It's a 500-point downtick that we are seeing there. The small cap index should also come up here on the screen because there is a lot of action that we are seeing there towards the fag end of the earnings season, when we are getting extreme reactions to earnings as well. A sharp fall from the highs, but continues to be in the green as we speak. So let's talk about a lot of these movers in the broader markets. This is our segment Midcap Movers. Upasana is here to take us through the midcaps that are moving around in trade. Upasana.
Well, certainly the mid-cap index is under pressure today. Now, first up, let us look at some of the key top gainers. First up is Relaxo Footwear, one of the key volume buzzers. Volumes as high as 183 times the daily average volumes. Nuvoco Vistas is the second one in the terms of volume buzzers. The volumes are up more than 10 times the daily average. Netweb Technologies, it is nearing its 52-week high, so up nearly about 14% out there. And HFCL, the stock continues to remain in focus this week throughout. It's up 26% in this week and up 6% as we speak. And lastly, Ola Electric, even this stock continued to be in focus today, surging since morning, up nearly about 7%. Next up is some of the stocks in focus on the back of the result reaction. Bajaj Projects up more than 10% on back of that good result. Aditya Infotech also in focus, up nearly about 10% on the back of that FY27, the guidance that the company has raised. Next up is Bata. The JM Financial has reduced and given a reduced rating with a target price of 700 per share. Stock has taken a hit, down about 4%. Cello World, weak margin performance has overall impacted the company's Q4 performance overall. The stock is down nearly about 5%. And lastly, Aegis Logistics reported its numbers some time back, and the stock is up nearly about 6% as we speak. Now, jewelry stocks also continue to shine today. Senco Gold up nearly about 2%. Mind you, it was up as high as 6% around 12 p.m. Next up is Thangamay Jewellers, up nearly about 6% in today's trading session. Now, on the flip side, let us look at some of the top losers in today's trading session. Pace Digitech down about 6%. Bank of India has taken a hit of more than 4% out there. Delta Corp is down nearly 15%. And lastly, coming to Enviro Infra, that is up nearly about 7% as we speak.
Well, thank you so much, Upasana, for joining in and giving us all of the key movers as far as the broader end of the markets are concerned. But one stock you highlighted was Bajaj Projects, and that stock is higher by 10% despite a very weak market that we are currently dealing with. It closed FY26 on a strong footing with a near 3 times growth as far as profitability was concerned. EBITDA grew over 50%, while the revenue was up 26%. Order book stands at over 3,400 crore rupees. Let's take performance of the company in the quarter gone by and the road ahead with Rajesh Ganesh, MD and CEO of Bajil projects. Mr. Ganesh, thank you so much for joining us. Very good to have you on the show. Street is clearly cheering what is essentially a very strong end as far as FY26 was concerned. Going into FY27 with the order book that you have in hand, please chart out a guidance for us in terms of top line, EBITDA margin, especially given the supply chain volatility and the profitability.
Yeah, thank you, Vivek. Thank you for having me on the show. The numbers are trending in the right direction for us, as I've said several times in the past and on your show as well, that we are working to a script, we're working to a strategy, which is called Rasta 2030. And as part of that strategy, we are looking for not just improving, top line, but also profitable bottom line. So that's work in that's work happening. So that's in motion. There's been several challenges last year, and that sort of continues through to this year as well. With all that's happening around the Middle East and the impact that it's having on oil prices, and especially the run on commodities. I mean, these are significant challenges. But despite these, our focus has been on execution. I mean, that's the heartbeat. That's really where we would like to differentiate ourselves. And to that extent, we've executed quite well in the last financial year, and we hope to continue that trend going forward into this financial year as well. So we executed 17 projects last year, and that was a record for us. Continuing with all this, we expect to see a growth in revenue. Definitely, there will be a growth in EBITDA in line with our.
Can you quantify it for us, sir?
Yeah.
Can you quantify the numbers for us?
Well, I mean, it'd be very, very challenging to quantify numbers at the early part of the year. I mean, it's just beginning, and with all that's happening around us, you see, it'd be quite difficult. But given that the intent is to trend in that direction, which is to continue to improve on our EBITDA margins and also on our PBT and PAT margins. So that would be the endeavor going forward, really.
Okay. Mr. Ganesh, how much contribution will come from export markets in the growth that you're talking about? What is the split currently in the order book when it comes to domestic versus exports? Is there a margin difference between the two geographies as well?
Well, yeah, thank you, Sonal, for the question. Well, fortunately, we're not that exposed as of now on international markets, but we've actually starting our foray into international market as compared to several of our peers who fairly well entrenched. We've announced a joint venture in Saudi Arabia. We've also won a order in Egypt, a 500 kV line, but these have not started yet, and we're going a little slow given the geopolitical sort of macroeconomic environment that's sort of playing out. So majority of the order book is domestic for us. I mean, to answer your question.
Are any of these projects, where you actually have price escalation clauses built in, or are these fixed price projects? So in that case, given rising commodity pressures, will you need to take a temporary margin hit?
Well, I mean, a majority of them are fixed price contracts, Vivek. So, but then, for aluminium, we're well hedged. There's some exposure, but we're well hedged. But for steel and for zinc, and these are the two other metals for which we're exposed, I think there we'd have to find, we will have to find ways to take out that much amount of cost from our system in order to compensate for the increase. And as of now, I mean, it's too early in the year. We think we should wait and watch. We should be able to tide them. We should be able to tide over them, really.
Okay, all right. Take that point. If you can give us a sense of the capex that you have planned going forward. It is for your Ranjangaon plant. How will you fund it? And is there any further capex other than this that you have in the pipeline?
Well, yeah, it's in Ranjangaon. Sonal, you're absolutely right. This is a place outside Pune. And what we're doing there is we're expanding our capacity to manufacture more towers and monopoles. So it's well underway. It's being done in 3 phases. Phase 1 is really putting that galvanizing bath, which is a bath of zinc, where we dip these towers and poles. So that should be ready by August. and then we should start work on the tower facilities. So would say about 60 or 70% of the capex would be spent in this financial year, and the balance would be rolled over to the next year.
Well, thank you so much, Mr. Ganey, for joining us. We wish you all the best as you embark on Rasta 2030, and we'll keep meeting with you more often, even mid-quarter, once some of those initiatives that you've mentioned come on stream. Well, we'll now slip into a short break. Up next, the management of Supriya Life Sciences will be with us to talk about their Q4 numbers and the outlook ahead.
Welcome back. You're still tuned in a mid-cap radar. Shares of Supriya Life Sciences rally on the back of solid Q4 earnings. Top line in the quarter gone was up by 50%. Profits also grew 47%. Let's discuss the results and the road ahead for the business with Saloni Satish Wagh, the managing director at the company. Saloni, good afternoon. Thank you so much for joining in.
Thank you so much for having me.
It's a solid set, 20% higher on the stock price as we speak. You have guided for a 20% revenue growth in FY27. Give us a sense of how much of it will come from new products, new therapies that you're looking at. You have some product launches in ADHD, anesthetic. How much will that contribute? Are these higher margin businesses or products for you? Break it down for us.
So I think 20% of the total revenue that we are guiding for FY27 will come from the new product launches. These are mainly products across ADHD. Then we have a lot of anesthetic products that we are planning to launch, and also CMO, CDMO opportunities, because the company is making good progress in that direction. So I would say when we are guiding for 1,000 crores in FY27, about 20% of that would come from the new products that we are launching, plus the CMO, CDMO vertical.
Well, no, Saloni, the other question what we want to ask you is, when you're talking about CAPEX, especially for Patel Ganga and the other CAPEX that you do, typically the CAPEX, is it tied to a long-term contract with the customer, or are these, you introduce these products to the market later on?
So the capex that we do is 2 point. One is definitely tied to the long-term contracts that we have, and we have good visibility on that front. And the second is also for the scale-up that we see happening in some of our new product launches. We will continue to launch about 3 to 4 new products every year. That trend would also continue in FY27. And when these products scale up, we would need to have the capacity. So it's directed towards both capacity enhancement for scale-up of existing products, plus the long-term CMO, CDMO tie-ups that we are currently exploring.
Okay. Saloni, usually these CDMO, CMO projects have higher margins, right? How much will that add to your margin profile currently? There was a decline in the quarter gone by. You've targeted 33 to 35% going forward. What happens once a bigger chunk from CDMO comes in?
So I think we are very confident given the mix of CMO, CDMO, plus the new launches, plus the existing basket that we have. We are fairly confident we'll be able to maintain that 33 to 35% margin that we have been guiding. And if I look at the last quarter gone by also, in terms of the absolute EBITDA, definitely we have seen a growth. Of course, the turnover is also growing. And typically what happens is whenever you launch any new products, the first scale-up of these products happens in semi-regulated markets where the margins are not as high as the regulated markets. So that's one of the reasons why you see them slightly muted towards 35%. But going forward, I think 33 to 35% is something that we would like to guide on the margin front.
Okay. Saloni, one of the larger peers, Divi's, did allude to the fact that they are facing certain EBITDA margin pressures because of supply chain disruptions from West Asia and also certain disruptions as far as China is concerned. Given the fact that you do have a little bit of a product, or you could say therapy overlap, are you facing similar margin pressures, at least in the first half of FY27?
So as far as margins go, I don't think we are seeing that kind of pressure, mainly because we have a very backward integrated business model. Almost 80% of product which contribute to the revenue, we are fully backward integrated. We only buy basic chemicals from outside. So as such, I'm not seeing much on the margin side. On the supply side, yes, because of the crude prices going up, solvent prices going up, a lot of logistic issues, there has been a slight delay in getting the raw material shipments as well as shipping out the final API to the customers. So that is the only impact that we are seeing of the war, which you can also see in our quarter 4. Almost 10-15 crores of sales got deferred into quarter 1 of FY27. Other than that, I'm not seeing much pressure for us as a company on the margin front.
Okay, so not seeing much pressure, and West Asia crisis has been quite uncertain, so it is difficult to quantify the impact you can have going forward as well. But certainly one other thing that everyone's been talking about is GLP-1, semaglutide opportunity. You are talking about it as well. Have you started rolling it out? Will you be rolling it out? What is the plan here, and how big of an opportunity do you think this could be? The market is already crowding a lot. There could be pricing pressures. So what makes you like this particular space so much?
So the semaglutide opportunity that we have is more on the finished formulation side, not on the API side. The Ambernath facility where we are doing contract manufacturing for finished formulations is coming up very soon. In fact, we are expecting to get the EU approval by end of FY27. I think there we have a lot of opportunity. We have one potential opportunity with an Indian generic company where they want us to develop the injection for them. And because we are not getting into API, which is now crowded, and we are going more into the injection front, the tablet front, I think that we will be able to still deliver a very niche product. Our strength here is, I think, on the R&D part, because the R&D has been able to develop a very, very novel tablet, which, is non-conflicting with what is available in the market. So definitely, I think we have that niche opportunity there.
Okay. You spoke to us about the CDMO, CMO opportunities, how they're going to be contributing close to 20%. Another thing what the street wants to understand is earlier you had guided that the DSM opportunity could scale up almost 3 times from the current levels. Where are we standing on that currently? End of FY27, or what will be the opportunity size there?
So the DSM opportunity at its peak is about 70 crores of revenue. And already in FY26, we have seen almost 35 crores of contribution from that. We have always guided that in FY27, we would reach the peak revenues of DSM. So this year, we are on track for getting that 75 crores from the DSM contract.
Okay, you also recently set up close to 1,000 tons of capacity for the cardiovascular visibility intermediate, if I'm getting that right. We understand that Q4 there was expected to be offtake from the customer. Where do you stand on that currently? And also, give us some sense of the kind of revenues you see from this particular segment.
So cardiovascular advanced intermediate, actually, we are one of the first Indian companies to develop this fully backward integrated. Up until now, the entire world was only dependent on China for this particular advanced intermediate, and we have fully backward integrated that. We have already started seeing revenues coming in Q4. Almost 25 crores of revenue have come from that single intermediate in Q4. And we definitely are seeing an uptake in FY27. Of course, the 1,000-ton capacity that we have set up will not be able to achieve it in 1 year or 2 years' time. It would take us 3 to 4 years. But we are seeing at least to the tune of 150-200 tons in FY27.
So what would the revenues...
Because the competition in that is very, very low. Particular revenue for this particular product, I'll not be able to guide, but it is well within our expectation of 20% growth in revenue.
So you'll be able to do 100 crores at least in FY27, considering that you did 25 in Q4 and you're just ramping up the capacity anyway.
Yes, the expectation is to do to the tune of that number.
Okay, all right. Pleasure speaking with you. Thank you so much for joining in and speaking to us about the business outlook going forward. The street likes your numbers. The stock is logged in upper circuit as we speak. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, even as we speak, the market has taken a turn for the worse. All of the indices are now in the negative territory. The small cap index too has slipped into the negative territory, and the midcap index now down 0.9%. As you can see, the Sensex is down over 1%. Two important stocks that stand out are capital market stocks. MCX on the back of the UBS downgrade is down almost 5%, and BSE too has now fallen to the day's lowest point. The other stock on the radar is BML. The company just came out with its Q4 FY26 numbers, and that particular stock too has seen quite a bit of selling pressure emerge post the results. But with that, that's all the time we have on this edition of Midcap Radar. Your stocks when you return.
Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Vinny Motiwala. Vinny, good afternoon, but the market's not a very good afternoon for it. It's come off sharply from the highs of the day. It's now below the 23,800 mark, 0.6% lower. The mid-cap index also underperforming today. It's about 0.8% in the red, and the Nifty Bank also falling in line with the blue chips. If you take a look at the sectors, there's only one sector. There's very few sectors in the green, and one of them is the IT pack. That index is about 1.6% higher, and that's because of renewed optimism over that AI trade. So that's the only index in the green. We're seeing some green in realty, but apart from that, Vinny, all of the sectors in the red.
Absolutely. All of the sectors that we're seeing are under pressure again today. And, what we're seeing also coming in from the markets, IT also came off from the highs as well, right? IT was also holding on to that 2-3%, 2% gain, more than that in the trading session. Now it's just holding on to 1.7% of gain. You're seeing autos, PSU banks, all of them also are off. And look at Nifty Bank itself, right? See the fall that we've seen coming in. The trend has been that we've seen the markets come off from the highs, and that's what it's been for the market in general, or the sectors in general that you look at it as well. So now Nifty is just holding on to that 23,750 levels, around that mark is what the Nifty trades at. But yes, that's what the market setup is looking like. A lot of individual movers on the back of their earnings. You were seeing Tega Industries also at the bottom of your screens, the earnings that came in for Q4, and we've seen a fall coming in that stock as well. So watch out for that one. But let's move on and get started with the show. This is a show where we solve all your stock-related queries. We're going to be doing just that with our experts. We have Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President Technical Research. I have Prabhudas Leeladhar. Vaishali as well as Shaina, good afternoon. Thank you so much, as always, for joining us on the show. Let's get started with the first query for today. This one is coming from Bhaskar, who's writing to us from Chennai. He is holding 1,400 shares of EPAC Prefab, and this is at a price of 271 rupees they bought it at. They're making a loss on this one. The stock is trading at 180 rupees. They bought 1,400 shares of this. Now they want to know, does it merit still holding the stock, or sell, book their losses, get out, and maybe look at investing somewhere else? Shaina, good afternoon. What's your view on the fundamentals for this one?
Good afternoon, Vinny. Good afternoon, ladies. So this stock has underperformed from the time it actually did rally post-listing, which was in October, and but it has not even managed to sustain its IPO price. So it's disappointing. The Q4 numbers were good, but margins, I think, when you look through it, the margins were impacted to some extent because of higher steel prices, and their projects are actually fixed price. So it takes that time lag to actually pass on any increases in the price of raw materials. So I think this is going to continue to impact the Q1. My suggestion would be to the investor is to book half the loss and hold the remaining, because order book is decent. If you look at FY26 sales, half of that in terms of numbers, crores, is there in order book. It's around 1,000 crores of orders. So I think it should be reasonably okay for the second half of the year. But as of now, I would suggest sell half.
So your suggestion is to sell half of the holdings that this person has. Vaishali, let me bring you into the conversation. What's the technical view on this stock? Should he continue to hold it or sell at current levels?
Hi, very good afternoon, ladies. So I think the stock is attempting to show some bounce, but it can see further weakness if 170 levels are broken. So I would suggest hold, because if follow this range, if below 170 you should exit. But if this stock attempts to go above 190, then it could trigger a further bounce going towards 210 to 20. So that's the way I would look at this stock.
All right, let's move on to the next query then. Shriram writes to us from Chennai. He holds 100 shares of HUL at 1,100 rupees. He wants to know if he should continue to hold or if he should sell and switch to players like Vishal Mega Mart. He's currently making a profit on the stock. So Shaina, let me come to you first. What's the fundamental view on the stock? Should he continue to hold HUL at current levels, or should he sell, book profits, and move on to other players in the sector?
Yeah, Rundhati, my view on HUL is basically related to the overall market. This is a very low beta stock. And in times of volatility, I would prefer sticking with a low beta stock, something like an HUL, which has given decent numbers also. If you saw the quarter numbers, they were pretty good. They have shown a good profit growth, good revenue growth, I think almost about 8%, driven by volumes of 6%. So I would believe that one should continue to hold HUL and ride it through this volatile times. I don't expect it to be a multi-bagger if you look at a 2 to 3 year perspective, but a decent performer, more market related. So I would continue to suggest to hold HUL as of now.
Okay, that's HUL, but we have Asian Paints that has just reported its numbers. You can see it flashing at the bottom of your screens for you all as well. We were expecting Asian Paints to report a volume growth maybe in the 9 to 10% range is what we were expecting. Revenue growth was expected to be at around 5%. We've seen the stock spike up as well. Seems like the numbers are slightly bit better. We'll see it flashing at the bottom of the screen. So versus the poll, revenue has come in at 9,247 crores. Expectation was 8,765. Clearly better on the top line front. Let's look at the bottom line as well. We have the profits also that are doing better than what we were expecting. We'll wait out for internals as well. We were already expecting an expansion. So where the EBITDA margin has moved up, that is also going to be key to watch out for. EBITDA is coming at 1,787 crores and expectation was 1,594 crores. So on the operational front, EBITDA front, we are seeing a good growth that is coming there as well. A sharp spike up. And then again, we've seen a bit of a downtick coming in, spike up and then a bit of a downtick. But yes, as of now, Asian Paints is holding on to gains of around 0.7% in the trading session. So inching up a bit higher, now up almost 1% in the trading session. We'll wait out for the decorative segment volumes, right? Like I mentioned, that's the key to watch out for as well. The decorative segment. Oh, that's the business, right? Decorative business growth that has come in 12.4%. We were expecting of 9 to 10%. So yes, better than what we were expecting, and that is why that stock has seen a very good run up coming in as well. You know, what I would also watch out for is going to be commentary, right? Because crude derivatives, Arundhati, that's something that impacts these companies as well. So will be key to see what the management is actually saying in terms of that. What is the outlook for them going forward as well? That will be key to watch out for. But as of now, first cut, the numbers seem that they're better than that. But stock is moving a bit higher and then suddenly lower, so we'll watch out for that, and we'll see where that's going to be headed. As of now, these are the details that we have that are flashing at the bottom of your screens for you all. Improvement in terms of growth that is better than expected for that as well, for decoratives business. But Shaina, your thoughts on Asian Paints? Any view here?
Well, I think the numbers are pretty good. Like volumes are good, and they seem to have. The competition that had come in the last year, I think most of them are now starting to show decent numbers in terms of volume growth. And as you mentioned, crude oil prices, at least as of now, doesn't seem to have impacted their margins, given that they are doing better than what the street has expected. But I will like to caution that overall still valuations are expensive. So I would not rush in and buy at current levels, and just wait for it to consolidate and buy it at lower levels. Asian Paints has always been expensive, but I think current valuations are still remain expensive, and I don't think that one needs to rush in and buy as of now.
Okay, don't need to rush in and buy as of now. Vaishali, your thoughts on Asian Paints as well? Anything on the technical front? Would you say just wait up a bit before you enter the stock, or is it the right time to maybe look at it?
Actually, I think Asian Paints had already shown signs of reversal, because we had seen the stock correcting right from 3,000 to a low of perhaps 2,100. And from there on, we have been seeing signs of reversal, and a buy trigger had already come at 2,450, 2,500 levels. So to those who want to buy, should wait for a little bit of a dip to 2,550. And I think the way the chartical formation is, I won't be surprised the stock going towards 2,850 to 3,000. So it's purely a trading bet, but the levels I would watch for, and I think it's already in the positive move.
Okay, that's the word there, and you've seen the numbers at the bottom of your screens. We're seeing a margin expansion this time, 19.3% versus 17.2%. Just in terms of some commentary that's coming from the management as well, they said that the external environment remains fluid, with the West Asia conflict obviously contributing to those near-term uncertainties in terms of demand trends. However, their earnings are resilient, so that's what they're keeping an eye out on. Even the industrials business has seen a strong double-digit growth during the quarter, mainly driven by automotive, general industrial, as well as protective coating segments. And overall, that domestic coating value growth has also seen a growth of around 11%. While decorative business volume growth is the highest that one has seen coming in the last few quarters as well. So that is something that you also at the bottom of your screens for you all. So watch out for that. Good growth in terms of volumes, the fundamental and the technical view there as well. On that note, we're going to slip into a very short break. After the break, we'll come back with more of your stock-related queries. Stay tuned in.
we are not two business based. We are three business based. One is the aero part, which is tariff linked and gives a fixed, return on equity. And that's pretty much well understood. That's the utility part of our business. The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business. The third business, which till date has been more as land monetization.
Welcome back to your stocks in CNBC TV 18. Asian Paints continues to be in focus after its numbers, but let's keep it going with all your stock-related queries. We still have with us Shaina Mukaddam as well as Vaishali Parekh. Let's move on to the next query then, ladies. This is coming in from Gupta, who's writing to us from Pune. He's holding 200 shares of Sterlite Tech. This is at a price of 150 rupees per share. Wants to know if he should continue to hold or sell this one. Making a good profit, seems like, from the levels that they bought it at, right? 150 rupees. Currently, the stock is trading at 536 rupees. What should they be doing with this, Shaina? Is it time maybe to still hold on or book out some bit of a profit?
Well, since he's gotten at a very good price, that is one. The main turnaround from losses to profits happened in FY26. And the investors actually, got the full benefit of the not only, higher profits that happened in the current year, but also the PE expansion, because the business that this company supports is like now, the favor of the, I would say, season. And it's got good orders from large telecom company in the US, and order book is now around 7,000 crores, which is almost double what it was a year back. So everything is running for the company except valuations. In my view, this sharp run up has made the valuations quite expensive. If you look at it 1 year forward, FY28, considering all these things, better numbers, better revenue growth, better EBITDA margins, still I believe at EV by EBITDA of 25 times is slightly expensive. So I wouldn't mind if the investor would take a bit more profits off the table, but hold some quantity for the long term, irrespective of valuations, because the sector is doing very well.
All right, so book some profits, but hold the rest of it for the long term is what you're saying. Vaishali, that stock has been doing well. It's seen a stellar run-up in the last 1 year itself, right? So what should he do? Should he continue to hold, book some profits, or should he sell the stock?
So I totally concur with Shaina, because technically it's a perpendicular rise and right now it's in a very deep overbought zone. So some profit booking eventually cannot be ruled out. So I would say it's better now that he's reaping good profit, book partial profit, and again look for a decline to get into the trade.
All right, book partial profits is what you're saying. The next query is coming to us from Raju, who writes to us from Tirupati. He holds 44 shares of Sansera Engineering at 2,415 rupees. He is making a profit. The stock is currently trading at 2,870 rupees. He wants to know if he can hold the shares for the long term. So, Shahina, if I can come to you first, what's the fundamental in the long term for this stock? Is it a good stock to continue to hold, considering he's making some profits on it right now?
Yeah, it's a small cap and the promoter holds 30% equity. So these are the two risk factors in my view. But I would still say continue to hold, keep strict stop loss because the numbers, fourth quarter numbers, in fact, the full year numbers, FY26 numbers were very good. They ended with about close to 3,500 crores of revenue. And going forward, I think 27, they're talking of 5,000 crores, 4,500 to 5,000 crores of revenues, and on expanded margins. They're also talking of expanding the products from just auto ancillaries to something like defense and some of the new age sector supplies. So I would say hold, but hold with a stop loss.
Okay, you would say hold, but hold with a stop loss. That's a word for Sansera Engineering. On the technicals, Vaishali, what's your view for Sansera Engineering? Last 1 year, the stock has already seen a good up move. But fundamentally, right now, Shaina was also saying that there are some positive triggers that come in here. So what should the viewer be doing? Continue to hold their stock, which they bought it at 2,450.
So I would say keep a trailing stop loss of 2,700 because the way it shows the momentum and the trend, I think this is very likely to go towards 3,000, 3,200 levels. So 2,700 should be taken as a trailing stop loss and hold on.
Okay, keep an eye out on the trailing stop loss and hold on. That's a word on the technicals. Next query for today, we have KL, who's writing to us from Vadodara. He's holding 5,000 shares of Ireda, and this is at a price of 185 rupees per share. They bought it at 185. Currently, the stock is trading at 130 rupees per share. And the other one is HAL, 400 shares of HAL. Average price is 5,150 rupees per share. What's your view on both the names, Shaina? Ireda and HAL. HAL obviously is in that defense basket, but should they continue to hold or sell at current levels? They're not making a profit on this one right now, at least.
Actually, both these are PSU stocks, which are going to, give just decent, I would say, market-related returns over the next 1 to 2 years. Very strong PSU stocks, good business. For example, Reda, they have got, while the price to book is not too cheap, 3 times price to book 1 year forward. At the same time, the growth in terms of their on the loan book is quite decent. Almost, I think it would be 9-10% for the year. Numbers are still not out, I believe. So they should do reasonably well going forward. One can continue to hold, keep a stop loss. And same goes with HAL. HAL actually, the numbers for this year were a bit, it was a challenging year for them. Given that the order book position is very strong, and also in terms of their operational improvement that they are talking about for the next year, FY27, I think the year could be much better than FY26. So I would hold both the stocks. You can keep stop losses for both of them.
Absolutely. All right, China. Before we go on to the next query, we've got Natco Pharma's numbers that have come out. The stock has fallen sharply over 5% lower. Margins have come in at 17.2% versus 45% on a year-on-year basis. And net profits have also fallen 34%, on a year-on-year basis as well. So those are the numbers that are coming in. Revenues down 39.5%. And that stock, as you can see, falling sharply over 6% lower, Vinny.
6% lower. We'll wait out and see maybe are there any one-offs, are there any concerns that have come in specifically will be key to watch out for. But as of now, obviously down 6% in trade. That's Natco Pharma for your day's low is what it trades at, Aru.
Absolutely. And moving on to the next query, we've got Deepak Dave, who's writing to us from Gandhinagar. He holds 500 shares of Afcons Infra at an average price of 440 rupees. He is a long-term investor and he wants to know if he can add more shares. So, Shaina, he is a long-term investor. Is this a good time for him to add more shares of Afcons Infra? He is making a lot from what he currently has.
Yeah, no, I don't think he should add more. Though, of course, the stock is giving you a good, it's giving you an upside despite the numbers being extremely poor. Because they've got a very good order book position. The order book is almost 3 times their revenues. So the potential is there. But I think there is a risk in terms of balance sheet because one is actually, while valuations are not too expensive, for funding, it will depend on their core promoter, which is Sapoji Palonji, which I believe there is a bit of risk unless you have some settlement on, the Tata Sons front and how they would sort of get some additional liquidity. So I think the better stocks that are available in the segment. So I would, not add any more. In fact, any rise or any upside, I would actually book some more loss, I would say, this investor is making, and switch to some other stocks which are doing much better, similar size, something like Semindia or something like that. But I would not continue holding the full quantity for the long term.
Okay, that's a view coming in there for Afcons Infra, but that's all the time we have on this edition of Your Stock. So, Shaina as well as Vaishali, thank you so much for joining us on the show as always and helping our viewers get answers to their stock-related queries. But viewers, here's a small programming note for you all as we wrap up Your Stocks. Uncertainty in the market is rising given geopolitical and trade headwinds. Even we at CNBC are featuring now some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune in to CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amit Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Ayar, Vidam Desai, as well as Jonathan Garner, Citi's Managing Director Sue Lee, and CEO Jane Fraser will also be a part of the blockbuster panel lined up only on CNBC TV 18.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Asian markets continue to trade in a sea of green, powered by most of the AI-led names.
Oman will behave just like everybody else, so we'll have to blow them up.
If a deal is not made, options of striking Iran still exist. It's going to be a higher start. I think about 0.27% higher.
Within the energy security, if you drill down, there are 6 different themes.
So basically, monsoon forecasts have been downgraded.
So organically, I think we should grow by about 4 to 5%.
Actually, personally, I'm a little bit more confident than many other people.
My bookings for X to date is 2 to 2.5x.
But so far as we speak for the week, we're up about 0.7% and the midcap index is up 1.8%.
Domestic competition has been tough. There's nothing different this quarter or going forward.
Last day of the trading week, the markets have taken turn for the worst. We are down 130 points as we speak.
Well, that is the day so far, and the markets, of course, off the day's high. And this is, of course, the last day of the week as well, going into one more weekend with, this or that, not very clear, peace or war, we don't know. But as we are starting this program, there are some flashes which we will address in just a bit. This is Sergio Gore, US ambassador to India, saying that, well, an interim deal is on the table. So I think that is a little bit of positivity coming through into the system. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi. Afternoon.
Hi, and the fall that we've seen today, we've erased out all the weekly gains. So the Nifty in the morning had almost got to the 24,000 mark, and now we're a good 200 point plus away from that level. 136 points down on the Nifty. The Sensex is lower by 350 points. Midcaps is selling off. Numbers are coming in and pretty okay. So Asian Paints numbers positively surprised, and that stock has moved up in the green.
Well, that's right, Reema. And a few more stocks actually from the broader markets. Rain Industries, the stock has made a fresh 52-week high. Earlier this year, I think in the first week of January, we had explained like the aluminium cycle could be strong, and a potential play on it is the input cost, which is CPC as well as CTP. That stock is now up closer on 7%. And in the last 1 month, it's up more than 40%. So you just pull up a 1 month chart, you'll see that stock is doing very, very well. Wokart, that's another stock that's up closer on 17%. So massive move out there. And though the markets are down, it still appears that the trend is up. The 50 DMA gets defended. That 23,650 is extremely important going by the options data. So I don't think any big concern, even though we're down closer under 130 points. And crude oil prices are well behaved. That's the biggest trigger out there.
Yeah. No, absolutely. And that you just see that last flash, which is saying this is, again, the other thing, right, which is the US trade deal. If something takes the front seat, something moves to the background, then, and what's moved to the background is, of course, US-India. What's moved to the front seat is oil prices, Iran, etc. But this is, whenever it happens, it's going to be pretty important, right? So Sergio Gore saying that last week, India sent a team to finalize last 1% of the deal. So that is an interesting way to put it. Confident that India-US trade deal will be signed in the weeks to come, and interim trade deal is on the table for us to finalize. So these are important comments coming through with regards to India-US at this point in time. And let's see if the market starts to respond, because this one also has been, out there for a while, right? Back and forth, proposals on both sides, and of course some contentious issues, etc. So we'll see what gets done. But in a few weeks, in the weeks to come, is what the US ambassador to India is saying. Lots of individual movers. By the way, I think the market is moved up a little bit from the lows of the day. We were at, I'll tell you, we were at about 23,730. Yeah. And we've moved up about 70 points in the last 7-8 minutes or so. Yeah. On the index, it's a turn, and we've got about 100-odd point cut now. It was looking like it'll be a 200-point cut, one point. So there is a bit of a bounce which is appearing as well.
It's one more
I think
TCS is.
Sorry, just play out that soundbite. We have the soundbite, Sergio Gore. So let's just use it.
Our current interim trade agreement is on the table for us to finalize, and that will unlock prosperity for both of our countries. Just last week, India had sent a team to Washington, D.C. to finalize the last 1% of that trade deal. Next week, we will welcome a U.S. delegation here to continue those talks. We fully expect that the trade deal will be signed over the next few weeks and months.
Okay, just a clarification coming through on TCS on the report that Money Control had put out earlier. The TCS has lost a part of the RBC Canada mandate. They've lost the deal to Accenture, and 150 members would be rebadged. So there was, when the news came out, TCS had slipped from the high point of the day, but the company is clarifying to the exchanges, and I'm saying we'd like to bring to your attention the article is false, so denying it. And they go on to say that we have a long-standing partnership with Royal Bank of Canada, and we cherish this partnership. So refuting the report about losing this deal to Accenture, and the stock is now recovering a bit. But we've got Shrikant Chauhan now joining in on the last day of this trading week, the last trading day of this month as well, and that of the earnings season. Shrikant, and we're very much back in the range. The 23,800, 23,850 was seen as that upper end, the ceiling for a while now. Then we broke it this week. But once again, with the fall today, we're back in that end. How do you read the near term, medium term, and the trades?
Good afternoon, Rima. Good afternoon, Nigel and Prashant. I think the market is very clearly in the range. It is waiting for some outcome. And while looking at the macros, the way there is fall in the 10-year bond yield, as well as crude prices, which are quoting below the mark of 93, which is something positive that I can say, because sustaining below the mark of 95 itself gives some confidence that something is happening on the positive side. That's my view. Today, on the back of MSCI rebalancing, we are seeing some selling pressure in the market, but at the same time, 23,700, which acted as major support since last 3 days, today also acting as major support. So while looking at the setup of the market in the near term, we can see the market within the range of 23,700 and 24,000 on the higher side. On the dismissal of 24,000, we can expect some short covering in the market. And in case today market closes below 23,700, then we can expect some more weakness. But otherwise, broadly, I am of the view that the market is on the verge of moving towards the levels of 24,200 or 24,500 based on the overall activity in the market.
Okay, so headed to 24,200. What's the individual stock calls for the day or for next week?
If we consider the broader market, then there we are seeing a lot of opportunities where we are seeing consistent gains in mid and small size companies. For large cap stocks, very few stocks, they are participating whenever there is activity in the market. But we like NBFCs. There we are seeing good amount of buying strength whenever there is a recovery in the market. Bajaj Finance, which is currently around 935, 937, there we have a bullish view. We are of the view that it is heading for the levels of at least 1,050 in the near future, and downside is quite limited. So at current levels, it's a buy with a target of 1,000 on the higher side. We can keep a stop loss below 890 for the same. The other stock on which we are bullish is Shriram Finance. There also we are bullish, and there also we are expecting some 1100 sort of levels in the near future. Currently it is 950, and it has spent a lot of time within the range of 950 and 925. So in case if there is any correction, it's an opportunity to buy. But it is advisable to take some positional view. We also like TVS Motors from the auto space, and we are also focusing on few metal companies. If we have to consider the broader space of the market, then I think new age stocks, there we are seeing good amount of buying attraction, and stocks like Eternal, or maybe I can say even after a very long time, Swiggy has given some recovery sort of pattern, and delivery. I think these are the stock on which we can keep a focus.
Okay, all right. Got that. Thanks a lot for that, Shrikant. By the way, just keep an eye out on Asian Paints. Those numbers actually look quite good. The domestic volume growth came at a 12-quarter high. Looked rather good out there. I think it was close to around 12%. So that's the reason why we did see a bit of a spike. And in terms of the outlook as well, the external environment remains fluid, is what they're saying. West Asia conflict contributed to near-term uncertainty. However, supported by strong fundamentals and execution discipline, they remained resilient to navigate the near-term challenges. So that's why the stock initially saw a bit of a downtake, but otherwise overall the numbers look good. Solid volume growth, multi-quarter high. The street likes it on that front. Mayuresh Joshi is with us. Mayuresh, you want to come in on Asian Paints? Will it be painting the street green this year after a couple of years of disappointment?
Nigel, I think that's the hope, right? But yes, I think in terms of the domestic decorative volume growth, I think outstanding number at that. And again, I think the expectation in terms of volume and the value-led growth, obviously because of certain bits and pieces of the paint industry where competition intensity still persists, value growth might not keep on matching the volume growth, which is probably also what has happened in Q4 of Asian Paints numbers. However, in terms of what the management commentary might be, will be very, very interesting to watch out for. West Asian prices, supply chain issues, crude derivative prices, which means titanium dioxide prices moving significantly higher, which is a key input material for the paint industry as a whole, as well as the impending overhang in terms of the El Nino effect. I think if the El Nino effect plays out, it can have some element of a reverse impact in terms of demand as we head into Q2 and the second half itself. And then there can be some elements in terms of how the annualized numbers might probably look out. So Q4, outstanding set of numbers by Asian Paints. However, I think what the commentary might point out and all the factors which might act as headwinds might still persist in case of Asian Paints and the industry as well.
The conference call, I think, is today, 5 o'clock. So we will get more clarity on the way forward. Stay on, Mayuresh. Let's talk about NetWeb Technologies surging up 15%. Vinny joins in to tell us the news.
Hi, afternoon. So NetWeb Technologies again is buzzing in trade by. One, we had the Maharashtra CM, Devendra Fadnavis, who actually is talking at the Mumbai Tech Week, which is going on. Now, key updates came in because the focus for Maharashtra, Mumbai, he's saying, is the AI story. He's saying the state is planning to establish 6 centers of excellence for AI in Mumbai. They have around 2,000 graphic processing units, the GPUs, that is, they're going to make available maybe to meet the rising demand that one has seen coming in. AI continues to be the focus for data as well as new technologies, and that's what the focus continues to be for Mumbai and Maharashtra in terms of data center as well. So they are looking to grow the data center base in Mumbai and Maharashtra. Now, apart from that, obviously, during the week, we had CRISIL that upgraded CRISIL that upgraded NetWeb Technologies long-term rating to CRISIL A+ stable versus previously CRISIL A stable was the rating for long-term rating. Short-term is maintained at that. Now, what was the reason they also gave? They said that the growth that one is seeing in the industry for AI, data centers, GPUs, NetWeb Technologies is well placed to capture that, right? Healthy order book as on FY26, the company had very good order book and strong order book, L1 orders of around 300 crores. This provides a revenue visibility for the company as well. Growing demand for HPC's cloud services, that continues as well. Government initiatives, like we've seen today specifically from Maharashtra government, but otherwise also the government is focusing a lot more in terms of the AI data point. And do not forget, and NetWeb Technologies has good relations, long-standing suppliers that they have, NVIDIA tie-up, they have Samsung, AMD, Intel. So that gives them an access to most of these, supplies and chips that they require much ahead of time in terms of technology also versus other players. So 9 to 12 months in advance is what they could get that benefit of as well versus other players. And that is why NetWeb continues to buzz every time you see any news coming in around AI, data center, and today also buzzing in trade.
Thank you very much for that. Mayuresh, is the market overlinking the connection between AI, data centers and NetWebs? Yes, there is a connection. But it's a 15% up move. How are you drawing the parallels between what's happening in AI and the benefit to NetWeb and where it's headed? Is it getting that scarcity premium here?
It is, Reema. Afternoon to you as well. And again, I think the expectations that are largely getting built in is the kind of humongous growth opportunities that exist over the next few quarters and next few years as far as this space is concerned. And therefore, as Vinny was pointing out, I think there is sufficient room for NetWeb to probably grow and expand its business quite meaningfully. And this remains one of the major growth drivers which can propel earnings to a significant extent. So yes, I think it is a beneficiary. To what extent it will translate in numbers, I think it is still going to take time on a substantial basis for numbers to come through. But I think the market is going with the momentum of the entire AI stock data center tomorrow.
Yeah, 14%. Oh dear, that's a big move on NetWeb at this point in time. And as Vinny said, there's a bunch of things coming together for this one. 120 points lower. So, I mean, you know, we were, as we were starting, we saw that sharp recovery. It's not sort of translated into more since then. Any thoughts on BEML? Mayurish? Results just came. Stock fell, I think, almost 7-8%, down 4 now.
Prashant, I think the numbers were very soft compared on a year-on-year basis. And again, I think the expectation largely being built in is that with the entire infrastructure push that is happening, the expectations in terms of mining operations picking up steam, a part of its portfolio also caters to the defense part of the business. We are extremely bullish and optimistic in terms of select metal and mining names, Prashant. And therefore, I think BEML becomes a proxy to this entire trade. However, I think numbers were soft and not as per the expectations that one really desired. So I think it's up to the press release now or the management commentary to decode or decipher what really went wrong in the quarter.
Okay, BEML and BDL Bharat Dynamics both have disappointed in the quarter gone by. But let's talk about GMR Airports. It set its eyes on an ambitious growth target on the back of the new brownfield airports coming up in Nagpur and Visakhapatnam. My colleague Vivek had a chat with the management. Vivek, what were your key takeaways from that conversation?
Well, you know, the biggest headline, of course, as far as GMR Airports is concerned, on the back of very favorable regulatory orders coming in as far as tariffs are concerned for the control, every 5-year control period. Number one is that you can now expect GMR Airports to be consistently profitable. FY26 marks the first year of profitability in over a decade. Now, as far as FY27 is concerned, the company is still grappling with various geopolitical headwinds, which has actually impacted passenger growth across all of airlines across the world. And GMR Airports, despite that, with the new airports coming into their fold from next month onwards, they are expecting passenger growth to trend in the range of 4 to 5%. They say that H1 passenger growth will be slightly softer compared to the kind of recovery that they are seeing as far as H2 is concerned. And they are saying that Vizag as well as Nagpur will start contributing to the financials for the 9 months of FY27. The bigger takeaway, of course, will be the fact that GMR Airports will now focus on 3 key business segments going forward. The aero business, of course, will be dependent on traffic growth and passenger growth, and that is something that they expect to remain quite steady. They call it the utility business. The second business, they say, or they call it the consumer-facing business, which is the non-aero part of the business. And remember, non-aero part of the business has scaled up significantly in FY26. It is almost equal to the revenue, EBITDA, and profitability of GMR Hyderabad, just to give some perspective to the kind of growth that is seeing. But what the street will be really excited about come Q1 FY27, the management will give a detailed plan on how they plan to go ahead and monetize the very large land banks that they hold. Remember, they hold close to 1,200 acres of land in Hyderabad and close to 200 acres of land near the Delhi airport. So real estate monetization via development of these assets is something that the street will keep a close eye on. And also remember, there's another airport which the street expects could get some sort of value unlocking scene. So that also something that the street will keep an eye out on. GMR Airports, one of the top gainers today.
Okay, let's actually hear it from the management. Vivek, thanks very much for that. This is the GMR Airports management in that conversation earlier.
We are not too business-based. We are 3 business-based.
Okay.
One is the aero part, which is tariff-linked and gives a fixed, return on equity. And that's pretty much well understood. That's the utility part of our business.
Right.
The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business.
Wow.
The third business, which till date has been more as land monetization.
Any thoughts here? Okay, I think you can catch the full conversation a little later on the channel. 4:30 p.m. by the way, is that when that we air that full conversation. Saurabh Chawla at the GMR Group, and you know, as he said, he kind of sort of explains the logic and what they're doing across the three lines of businesses at GMR. Mayuresh, any thoughts on this one? GMR Airports.
A very positive commentary from the management of GMR. And again, I think the expectations in terms of more airports coming their way can be a huge possibility. That's one. I think what the street is also probably looking at is the entire land monetization aspect. Because if they are able to successfully monetize a part of that entire fixed asset holding that they've probably got, I think it alleviates a lot of concerns in terms of balance sheet. And if the core business, as the management is pointing out, is looking at significant addition in terms of earnings delivery, I think you've got engine firing on all cylinders. So I think anybody holding should continue holding. I think I would be very much interested to hear the entire conversation at 4:30.
Okay, 4:30. Tune in, Mayuresh. It's an interesting one. Appreciate it very much as always. Thank you very much for joining us as well. Have a good weekend, Mayuresh. Always good speaking with you. We'll take a quick commercial break here. We'll come back and we will talk to Dinshaw Irani of Helios Mutual Fund. And he's the Alpha Manager of the day. Stay tuned.
Welcome back. Well, the Nifty is down close to around 130 points. But as I mentioned earlier, the India VIX is still pretty much well behaved. So that's good, because the VIX is not really spiking up. It's up 4.5% or thereabouts. Last few days, the trend has been down. And even though we have pulled back from around the 24,100, by around 300 points or thereabouts. Still, we're not seeing the big spike up. So that's a bit of a positive. In terms of the options data, the PCR, that's holding below that 0.8 mark. So it's gradually moving towards the lower end because the call writers are having a blast. 24,000 call. Premiums come down to around, 91 rupees. That compares with around 130 rupees. 23,900 call as well. Premiums down to around 130 rupees from around 180 rupees. So clearly there is aggressive writing at these levels. However, on the flip side, the 23,800 put, there is a mix of activity out there. Earlier this morning, there were some signs of buying, but now the premium at around, 88 odd, there clearly seems to be some writing at that particular strike. And it's important that the Nifty doesn't break this band. It's trading around the 20 DMA. The 50 DMA is the next reference point on the downside. You don't want it to break on the downside. In terms of stocks that are in focus, Swiggy is the one that's come in for a bit of unbinding in today's trading session. So, that one comes up for you on the screen. GMR is seeing some fresh buying. And Wipro, there's a mix of some shorts covering out as well as, some buying being seen on that one. More than 60 lakh shares getting added in terms of open interest. So net, though we're seeing a bit of a downtick, overall the structure still looks more positive than negative.
Okay, all right. That's the options data and what that suggests at this point. We have Dinshaw Irani with us. He's CEO, Helios Mutual Fund. Dinshaw, good to have you with us here. Thanks for joining in. I don't know if you saw, but our colleague Vivek had the GMR Airports management with us, and we just played a slice of that conversation a little early. I don't know if you own it or if you have any thoughts on it, or how any way to think about this one as a business, Dinshaw.
So thank you, Prashant, for having me on your show, and a very good afternoon to you and your viewers. Yeah, we do own GMR Airports. We like the business given that India's domestic tourism, as well as aviation industry is still in a very nascent phase. So that's why we like that stock, and we've been holding on to it for a while now, and we continue to hold. Beyond that, I don't want to give any further bites on this one. Company specifics normally avoid.
What's your read of the overall earnings season? We were just chatting with Amish Bofa, and he was telling us that while at the headline level you feel there have been a lot of beats, it's primarily driven on account of the commodity inflation pass-through. So in their analysis, 48 out of the Nifty 50 companies which have reported so far, there were many beats, but 45% of the beat was courtesy in commodities. And if you look at the NSE 200, it's about, I think 30% is on account of the commodity inflation. And generally, you won't give a higher PE on account of a beat linked to a pass-through. What is your own assessment of the earnings so far for your portfolio? What did well? What didn't do well?
So basically, if you look at NSE 500 also, that percentage will come down further. Anyway, the fact is that these compositions keep happening and so on and so forth. The point is that if you look at the quarterly numbers and break them up into market caps, and we do that on a daily basis, the numbers that we have is as of yesterday. And if you look at the way the market caps have, by the way, roughly around 95% of the market caps have given out the numbers. The large caps have grown at, I think, 11 or 12%. Low teens number is what the large cap growth is. The mid caps, however, have been the surprise part. There are commodity plays, but what we've done is we've tried to take away the companies which have turned from loss to profit, the likes of a Vodafone Idea and IndusInd Bank, which add a lot of beta to that difference. So that's why we've taken them off. Despite that, the growth there is around 26-27% in the mid-cap earnings. And the small caps have done their bit at 17-18% odd growth. Now, the fact is that when the war started, we were of the opinion that this overall, by the way, numbers are around 14-15% growth for NSE 500. We felt that this will be closer to a low double-digit number, 10-11%. But it's come as a surprise to us. Commodities, I don't think has that much impact as the consumption names have had. Obviously, the big dampener were IT companies and so on and so forth. But the fact is that overall, the numbers are not looking that bad. Valuations, again, not that stretched. You've seen the rupee of the last few days. It's been doing fairly well. Government has been talking about doing certain things to control the fall in the rupee and to get the FIs back. I think things are looking pretty decent as what they were looking, say, a couple of weeks back. The conflict, if that gets sorted out, we'll see the market coming back on even keel. By the way, one has to tone down their expectations for the market growth also. last year, probably if I told the people that we're looking about mid-teens kind of growth, they would have been more than happy. I think this is what you're supposed to look at going forward. Those heady days of mid-20s and 30s kind of growth rates are over for us right now.
Hi, Dinshaw. Good to see you, Ben. Dinshaw, the last time we were chatting, you were saying hopefully that we have crude coming down to $85, $90 per barrel, and your wish has been granted. If I'm not mistaken, first week of April is when we were chatting about this. And I think you were sticking to being overweight on BFSI while you were staying away from tech. You hold on to that stance?
Yeah, so we continue to hold on to that stance, Nigel. But what we've done within the BFSI is we are now reducing weights on the large caps a bit because we believe that that stability part is done and dusted now. You want to look at growth going forward. So you'll see quite a bit of changes happening when you see the portfolio for May. You'll see quite a few names being added to the mid-cap space and to the small-cap space. Certain new names coming up and stuff like that. Obviously, there'll be some chop-off happening on the large-cap space as such. And that's how we've been playing this. By the way, the call on crude was fairly simple at that point in time because what the Strait of Hormuz had affected was 14 million barrels a day, of which 5 additional million barrels were coming from US. They're from 4 million net exporter. They became a 9 million net exporter of barrels a day. And China, for obvious reasons, because demand collapsed out there, they've come down from 14 million consumption, rather 14 and a half, 15 million consumption to around 10 million. I mean, net imports to 10 million. So that was the whole reason that the offset was around 4-5 million barrels. And that could happen in a pretty short period of time if that strait opens up. And that's why normalization also could be sharp. That was the call there.
Okay, all right. Then, Shaw, I wanted to ask you about these EV plays. Ola is something that you all flirted with in the past, and it didn't work out according to plan at that point of time. And you all said, I think you all got out. But, suddenly now the street is more and more interested about it because on a month-on-month basis, after the low that it hit in terms of sales volume on a monthly basis in Jan, I think, of Feb, from there it's a gradual uptake. And my colleague Sudarshan was telling us that, in fact, the Vahan data suggesting that May will be even better. And if this trend continues, then maybe they'll move towards that profitability that they're talking about. Ambitious guidelines, they haven't gone according to it. But will you all be reinterested?
Nigel, I won't say yes or no to that one. But the fact is that when you said flirted with Ola, we had a love affair with Ather. I don't think you mentioned that one there. But that love affair has worked out perfectly well for us. And you've seen where
that's
Ather
a steady
is.
relationship.
We like the EV space. We like the two-wheeler EV space. But we're being very selective out here, so probably we'll take a call later on this.
Okay, no, this is Ather's the steady relationship. Y'all are rocking it on that front. This was, I said, flirt because you got in, out, and then, obviously that's the one with the technological advantage as well, as we know. And it's done very, very well. It's been actually poles apart between the two. But for the time being, at least telling us that you like that theme. What will make you all get positive, though, on this entire tech space? The debate out there, some calling for a bubble in AI. The street is totally divided. Every time you see the tech index come down, there is suddenly some good news. It pops out a little bit, then it corrects a little bit more. What will make you all turn this stance?
So basically, the fact is that once the pure poison is out of the system, in the sense that even now, the likes of Anthropic and OpenAI are now acquiring services companies because they want to keep the whole value chain with themselves. They don't even want to let that go out. So obviously they see a huge potential going forward for the products that they're offering. And that's why they're getting into that. And that for some unfortunate reason is being taken as a positive for Indian IT services. Guys, I don't think it is a positive right now. The fact is when this happens, when this whole chain plays out, we're talking about compression of margins. We're talking about lower growth rates. Already you've seen the growth rates are the guidance for Infosys 1 to 3%, which is being nowhere actually. I mean, no single digits. And unfortunately, if they do disappoint the market going forward, even the low Ps will not look low enough because once you cut down the forward earnings growth, your Ps straight away start expanding. So we expect this to be a very painful transition. In the best case scenario, probably there will be a flat line in the IT space. Otherwise, we're not going to get in a rush out here.
Look at the market, which is cracked. The Nifty is down 300 points, and it's all My God, it's dropped like a stone. Just pull up the Nifty if we can. And there you go. We were trading with a 100-point cut, which means that we were from 220 odd to 230, 235. The market actually had recovered. All that is gone, and it's like a vertical slide, which we are looking at.
MSCI angle
MSCI,
also,
yeah.
right? Remember the MSCI outflows were likely to take place from 3 to 330. So that explains that waterfall kind of decline.
Yeah, I mean, that's perhaps that explains it. But Dinshaw, you want to comment on that? You know, these MSCI changes, FTSE changes, etc. There's usually pre-positioning, right? So not all that impact comes through in such a way in the last half hour. Or
So I just got a Nuvama note that I'm looking at. The India-related changes are estimated to result in $800 million to $1 billion of foreign passive outflows from India. That's the calculation according to Nuvama Alternate. You know, so they're saying, and the calculation, and today is the day when that rejig takes place. The changes will be implemented from today. So.
I agree. The numbers are very large. But my question was whether this is. You heard the question, right, Dinshaw?
Yeah. So Prashant, the fact is that the active funds do this much earlier. But the passive ones, they do it on the last day. There's no way out for them. I mean, they do it when the changes actually are getting implemented. So maybe that is what the impact you're seeing. And by the way, while you were telling me this, I was checking on the tweets of the Portos. There's no fresh tweets from there. So that's not the reason why the market has collapsed. That much I can guarantee. So.
Mr. Trump is sleeping.
or he's watching CNBC. Watching you, Dinshaw. I think. Well, looks like it is MSCI and the passive active. Yeah, make sense that they have to wait and get the error rate down to tracking error down to the minimum, right? So you got to do it as close to the event as possible and not do it earlier. So 350 lower now. So this is going and going. So 23,550, 560 is where we are at right now. If we have those hot boards for Nigel, do you have that list of stocks where this is most?
Vivek's list.
Vivek has that.
I mean, I've got my own list, but I'm not sure.
If we have the list, if we can put the hot boards up, we should just look at the MSCI changes, the ones that Vivek put out. I think we'll get a sense of which stocks are seeing, and you know, technically it should show up in those individual stocks, etc. As well. Reliance is, of course, having the most index point cut. ICICI and HDFC, etc. Yeah.
There is, in addition, there's Federal Bank. In deletion, there's Hyundai, Jubilant, RVNL, Kalyan. Yeah, this is deletion. Hyundai, Jubilant, RVNL, Kalyan. A little bit of a weight increase in Bharti, HDFC Bank. A weight reduction in Bajaj Finance, HUL and TCS. So Bajaj Finance, according to the note that I have, I think that's going to see an outflow of $250 million.
Anything in HDFC Bank, Rima?
Very slight increase is what I can see. Weight increase. In Bharti, HDFC Bank, ICICI Bank. So those are slight increases.
So
but the
Bajaj
one
Finance
you can see the decline. HUL is the other one. And TCS is the other one. TCS could see about $180 million of estimated outflows.
Okay.
And on the small cap end, addition is that's the list, right? Yeah, that's the list. IRDAI is going to see increase. Escorts, addition, Anthem, addition. Deletion is Federal Bank, and there is a decrease in weightage in Uno Minda, M&M Financial Services. Some of those hot boards also simultaneously. We should get that up, but you can clearly see that playing out. And net, we're looking at an outflow almost of nearly $1 billion. So fairly sizable.
Yeah, there's a lot of stocks on the positive side and negative, but still
negative side. But net, we're looking at an outflow of a large number, $1 billion.
Uno is there as well, right?
Uno is there as well, which is going to see a weight reduction.
Okay.
Along with Glenmark Pharma.
I think that explains it. Except maybe an HDFC Bank, where there is a weight up, but HDFC Bank is slumped 2%. Everything else, it's kind of sort of tallies up. Yeah, there you go. HDFC Bank is sold off 2%, whereas here there is, I think, a bit of an increase from what we had.
And on the MSCI small cap index, the number of deletions will be to the tune, I think, of from 474, it will come down to around 459. So there'll be some deletions as well.
Okay.
Like you see, over a dozen deletions.
So about 14, 15 odd
15.
deletions from the small cap. Let's just actually have the small cap index as well. Take a quick look at it. And then we can sort of, go back to Dinshaw. There you go. It's down about 1%. And suddenly, very, very quickly coming through at at this point. Dinshaw, the other, it's not so much about, MSCI but do you guys, I'm sure this is a discussion topic, because I know there's a discussion topic across many funds and all kinds of market participants about the impact of, these large high-frequency trading firms, the big ones. Many are still active here, and the outsized impact they still have, especially on expiry days. Dinshaw, any thoughts there?
Not really, Prashant, but you can see it very clearly that closer to expiry, excuse me, it's always been a very choppy and volatile market, which never used to happen earlier. I'm sure these HFTs are the ones which are creating this, but frankly, there's no, we internally also, we're not even discussing this right now. So
I see. I got that. So 390 now, so almost getting to the 400-point cut mark on the index. 23,516 is where we're at. We still have, 20 minutes to go for market closing to come through. Dinshaw, we'll leave it there. Thank you very much for joining us. Have a good weekend, and we'll speak again. Appreciate your time here on CNBC. 1% lower on the Nifty Bank, and about a 1% cut on the Nifty as well. Take a break. We're back on the other side. More coming up.
We are not two business based. We are three business based. One is the aero part, which is tariff linked and gives a fixed return on equity, and that's pretty much well understood. That's the utility part of our business. The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business. The third business, which till date has been more as land monetization.
Welcome back. Well, the sharp drop that we are seeing is because of a rejig with regard to the MSCI. And if that's the sole reason and the structure doesn't get broken, you could see a rather swift, some part of this drop of this 380 points odd could actually get reversed either in the last few minutes of today or on Monday morning as well. So just keep that in mind for the time being. If it's only because of the MSCI outflows and passive outflows, then you could see a bit of a pullback as well from this 380 points odd. Let's talk about stocks in the broader markets. MCX had a beautiful run. However, today the stock is under pressure. There's a bearish call coming in from UBS. Devyani joins us to help us out with those details. Devyani?
UBS has come out with a note on MCX and has downgraded the stock to a neutral with the target price raised to 3,600 rupees per share from the earlier 3,200 rupees per share. Now, UBS says that the peak earnings momentum is likely behind with elevated volatility seen across key commodities in recent months. Now, while the Q1 FY26 volumes till date have been healthy, they still say that they have normalized since Q4 levels. Now, from a competition standpoint, they say that they're not currently worried about the competition as yet, while taking note of the fact that the stock is currently trading at 50 times its one-year forward price to earnings, which is 10% higher than the historical average that the stock has traded at till today. Now, they believe that the strong volume run rate is already priced in and there is limited upside from current levels. So the stock is clearly taking a beating for it.
Okay, all right, Devyani, thanks a lot for that. Sudeep Bandyopadhyay, market expert, joins us on the show. Hi, Sudeep. What's your take on MCX? A big outperformer. The average turnover has been moving up on a month-to-month basis, but it got a little bit too expensive. What's your view on the stock?
Well, Nigel, we have been positive on MCX for quite some time, and we maintain our positive view. I think a lot of things are happening which are good for MCX. Of course, I mean, they are the absolute leaders. There's no competition worth talking about. Commodity is absolutely, hot, red hot. A lot of action is there in all commodities, whether it's soft or hard. MCX benefits out of that. New contracts, including options, are getting launched. Hopefully, more and more will get launched in the coming few months. An NSE listing, which is on the cards, will create further excitement in the entire exchange space. So this is not the time to exit MCX. This is the time to remain invested or even get into MCX. 1 year forward earning based on historical data, I think will not give the right answer. MCX definitely is a hold or a buy.
Among the three exchanges, MCX and BSE, one-way move out there. You have the unlisted NSE also. Your pecking order among the three, if you're allocating fresh money?
MCX, BSE, and of course, NSE as and when lists, we'll have to see what price they come up with and what the excitement is around listing.
Got it. Okay. All right. Got that. Sudeep, I want to ask you about a couple of other names then. Any view on stocks like Rain Industries? The stock has burst up. If you have a view, or even Bharat Coking Coal, stock listed, I think, at around 45 rupees, then it corrected to around 33 rupees, and now it's pulled back up to around 40 rupees. If you have a view on either of these two, Rain Industries or BCCL.
Rain, of course, because what's happening in the metal space, aluminum in particular, I think Rain is definitely going to have a good time, and no doubt the performance has been improving. We are positive on Rain, and it's the company has been pretty efficiently managing its operations, and I think the upswing in the industry, particularly the aluminum industry, is going to continue to benefit Rain in the foreseeable future.
Yeah, got that. So that is the view. Well, 360 odd points lower is what you have at this point in time. And I mean, a bit of a recovery from the absolute day's lowest level, but not very much beyond that. 2:1 is the declines to advances ratio. So things have sort of, turned on the other side in a pretty dramatic kind of a way coming through. Sudeep, we had Amish from Amisha of Bank of America this morning. Their conference kicks off on Monday. And it's not the first time we've heard it. But his view was that there's going to be a lot of focus on developing shipbuilding as a big industry in the country, and it's a very long gestation sector, capex heavy, all of that, of course. But he thinks these are first of all, he thinks there are limited names, and that list will expand as we go along. as the sector develops. But even within the listed space now, the 4 or 5 names that we have, there is still opportunity. Do you like anything there?
Oh, well, I definitely like, and I think he's absolutely right. Look at the global, shipbuilding industry. China is completely at a different level altogether. Korea, the entire capacity is booked for, I think, 30, 40 years. US is a serious capacity constraint. So the opportunity for India to develop shipbuilding industry is humongous. And I think Andhra Pradesh is going to get a large shipyard project approved very soon. Of course, amongst the listed 3 companies, we can talk about Cochin, Mazgaon, and Garden Reach. I think all 3 have got fantastic prospects. There are challenges in terms of valuation at which they trade, and there are challenges on execution. But the question of future, the question of receiving orders, I think is absolutely clear. They have a great future, and they will continue to receive orders by dozens. So there is no doubt. Now, if I have to pick one of the 3, I think I'll still go for Mazgaon Dock. But my request is somebody buying the stock, please think long term. This is an industry where long term pays, and you also should enter the industry thinking long term.
Got that. Stay with us, and that's well put there. Auto numbers, right, will be with us when we come back on Monday morning. So let's get a quick preview going. What will May auto sales look like? Sudarshan gets us that preview. So over to you.
So as the Vahan data has been indicating that even for the month of May, we are expecting a strong set of numbers despite the price increase that most of the companies have announced in the month of April or in the early part of May. So if we talk about the industry for passenger vehicle wholesales, we are expecting an increase of 24%. Even waiting periods as per Nomura have normalized for passenger vehicle segment. For two-wheeler industry, growth can be up to 10%. For MNHCV, it can be up to 9%. And as far as tractor segment is concerned, it can underperform the industry, I would say the peers, and there can growth be of 4%. And also, as far as the tractor segment is concerned, we'll have to see the monsoon update, because today only Met Department has come out with the update and it believes that monsoon can be below normal. Now talking about the company wise, in the two-wheeler segment, Bajaj Auto growth can outperform the peers, and there the growth can be up to 24%, followed by Hero Moto where growth can be 11%. TVS can again outperform Royal Enfield, and here growth can be 16%. And for Royal Enfield, because of the production loss that company had talked about in the analyst call, their growth can be up to 12%. In the four-wheeler segment, Maruti can continue to report the healthy growth, and it can be 24%. Tata Motors PV will continue to outperform the industry, and growth can be as high as 39%. M&M Auto growth can be 15%, and Hyundai will underperform, and here growth can be 9%. In the commercial vehicle segment, both Tata Motors CV and Ashok Leyland are expected to see healthy growth, while Ashok Leyland will underperform Tata Motors CV. For Tata Motors, growth can be 24%, and Ashok Leyland growth can be 8%. In the tractor segment, one company that we are tracking, that is Mahindra & Mahindra Tractor, and growth can be 7%. So, despite the price increase that I have talked about, we are expecting a healthy set of numbers, and especially in two-wheeler segment and in the passenger vehicle segment.
So you have to choose one number, so what would that be?
Tata Motors passenger vehicle. And mainly because of the push that we are getting from government and the regulatory bodies regarding the electric vehicle.
I see. It's already been like a good performer, right, lately?
Good performer. And if you talk about the stock also, it has outperformed the peers in the last month, or say even in the last 2 months. And after the earnings, the stock has jumped as high as 25%.
You remember even Shailesh Chandra, we had some snippets of him, and he was talking about very, very strong growth coming in on Tata Motors passenger vehicle, particularly on the EV front. Demand has just exploded. So that's clearly the number to watch, according to our own Sudarshan.
Yeah. Well, so thank you very much for that. So that is, the May auto numbers as we will get them. And stocks, of course, will react to all of this on Monday. Amish Shah of Bank of America with thoughts as the BofA annual investor conference kicks off. We had him earlier today. So, I mean, his assessment of on earnings, he's not very impressed. Sector bets, he spoke a great deal about that. And of course, he thinks logically taxation on equities should be lower. Listen and take that break. See you on the other side.
Has taxation lopsided allocations of retail savings towards equities? Completely yes. has the capital gains discouraged foreign investors, especially when rupee is hurting, especially when earnings growth is low, valuations for India are high. So therefore, is India out of my radar as a foreign investor? The answer is yes. And given that large part of the rupee problem right now is also lack of capital flows, I think it makes sense for us to do it. So the answer that I'm trying to give is that, logically, if you think about it, we must do it. The likes of data centers, shipbuilding, defense, cables, transformers, so that as an ecosystem or any company linked to that ecosystem will do very well. But in general, anything that was linked to state government capex, state governments, as we know, have gone more populist and at the cost of capex, therefore. So, so state government capex is primarily in water, irrigation, metros, those kind of things we think will take a knockdown in terms of capex.
Very, very sharp sell-off. We're now staring at 23,500 on the Nifty. 400 points gone. Sensex lower by 1,200 points. Sudeep, pretty much out of time. We've got 2 minutes to go before we wrap the trading day and the week. Do you want to quickly share one or two ideas?
do like LIC. I think it looks pretty good. Numbers were pretty good. Really.
Okay, we'll try and reconnect with you, but LIC is a stock that he likes. I think there's some adjustment which must have taken place
LIC,
in
yeah,
LIC. There's an adjustment.
There is
a bonus of 1:1, which explains that 50% drop in price. But for the market, it's an MSCI-led sell-off which took place in the last 30 minutes. There was a waterfall decline. But even if you look at the chart on an intraday basis, we opened higher, we opened flat, but with a positive bias. 2400 was nearly the intraday high on the Nifty, and from there we were gravitating lower before that vertical fall which took place, ending with a cut of about 1,000 points on the Sensex. Now it's trying to pull back a bit, and the Nifty around the 23,550 mark. Sectorally, I think IT was the only sector where we managed little bit of some gains coming through. So Tech Mahindra, HCL Tech, Wipro in the green, ending with gains of about 1.5%. Asian Paints saw buying post their numbers, a good set of numbers. Street likes the performance, and generally the numbers from many of these paint companies have been quite strong. Nestle trend, so there was a consumption tilt on the buying side too. On the way down, the top loser is Power Grid, so that slipped below the 200-day moving average today. Bajaj Auto, Eicher Motors saw selling. The May auto sales numbers will be out over the weekend and early next week. Interglobe Aviation under pressure ahead of numbers. Q4 is going to be weak on account of the March geopolitical stress, and even Q1. So the street will watch the outlook very closely. NTPC, Max Healthcare. Max has been a big drag this entire week. So today 2.5% down, but it's lost nearly 5.5% from the top of the week. And ONGC, with the slide in crude prices to $92 per barrel, ONGC slipped 3% today, and for the week it's down 8.5%. So that was the biggest casualty of the week.
Well, I think that is the week, right? I mean, Nifty down 0.9, Bank Nifty up a little bit, mid-cap index up a little bit, small-cap index up about almost 1%. So the best performing part is the small-cap index. Once again, it's a wrap on this edition of Closing Bell. Thank you very much for staying with us. More comes up on the other side.
A sharp sell-off on Friday dragged the markets lower, leaving the benchmark indices in the red for the week. The Sensex and the Nifty both ended with losses of nearly 1%. However, the broader markets continued to show some resilience. The midcaps outperformed the benchmarks, while the Nifty Bank too managed to close with some gains. Over the next 30 minutes on Editors Roundtable, we will decode all the action, the key triggers driving markets, and what investors should watch out for in the coming week. Hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are my colleagues Prashant, Nigel, and Nimesh. And here with us in the studio is Ravi Dharamshi, CIO, ValueQuest Investment Advisors. Hi guys.
Hello.
Very tough Friday, particularly the last 30 minutes. And today is yesterday, marked 3 months since the conflict started.
Oh, yeah. Nobody thought it'll go on for 3 months, right? So that's the nature of the market. So, but I guess markets have been quite resilient, right? I mean, initial hiccups, but seems like we're back to normal. We started ignoring the war sort of news as well. Ravi, what's your call on the market now?
No, I think you're right. See, once market gets a sense of if you can quantify what is the risk, what market tends to react to is what is unknown and unknowable. If you don't know how long this conflict will last, the bombardment continues, the crude goes up 120, 130, you don't know where to put a cap on things and you can't quantify the risk. That is where the problem lies. But now some market has come to terms that, worst in terms of hostilities is over. The red line for US might be here and Iran might be here, and it might take some time to bridge that gap. But at least we are not going back to that kind of hostilities. And also, both of them want the Strait of Hormuz to open up. And there is a invisible line, essentially the midterm elections for US, where he basically needs to, the president needs to show a win. And for that, he needs to ensure that this conflict ends, because the longer it drags, it's negative for him also. And the bond yields have also started reaching the point from where he starts listening to it. So I do believe that the conflict, unless we see a new spike in the crude, which takes it to beyond $120, $130, I think we are for the moment done with this whole thing.
Otherwise, you're constructive, Ravi?
So you know what? It is a very, very bipolar market. If you see the index, you feel you're not going anywhere. On the bears feel it is not crashing in the way it should for the kind of crisis we have. The bulls feel it's not rising the way it should because we are in a cyclical recovery. You look at the credit growth, you look at the monthly sales number. The quarterly results were not bad. So everything economic-wise, we are on the cusp of a cyclical recovery. But because of the global uncertainty, we are kind of capped. So indices, the headline indices are not headed anywhere. But there is clearly a segment in the market where there's a bull market going on. And it is a stealth bull market because it is not coming on the radar. And we might categorize it as mid-cap. But even within that mid-cap, specifically where the bull market is going on are the industrials, the manufacturing-related stocks. And it is not only in India, it is happening worldwide. In fact, I do believe that we are in a global industrial, super cycle in terms of capex.
Actually, the list is long. I mean, actually about 10 names, right? There's an absolute bull market, all-time highs. The GE and the Hitachi and the CG Power is back to all-time high. Siemens, there's ABB, there's Cummins India, which has seen massive moves. The cables and wires, perhaps, I mean, they've not really, they're not started.
No, they have. Even they are at a new all-time high. You can
so this is the
check.
pack that you're referring to, right?
Yes. So this is, okay, let me just take a step back and paint the whole picture to you. This is but one segment. So, since 1990 to maybe till late, early 2020, the world was running on a principle of building cost-efficient supply chain. Essentially, the world was flattening. There was globalization happening. Suddenly, in the last 4 or 5 years, things have happened which have kind of turned it on its head. We are no more focused on cost and efficiencies. We are focused on resilience, redundancy, on safety, security, those kind of things. First, it was COVID, which kind of made us realize that supply chains are vulnerable. Then there was a semiconductor shortage that panned out. Then we saw Russia-Ukraine war broke out, which led to energy prices going through the roof in Europe. And then, of course, there was a tariff war, trade war, which made us realize that if you are too dependent on a particular country for your needs, then they can possibly weaponize it and use it against you. So there is a trend towards building this global supply chain resilience, energy security and independence, your own nation's sovereignty and security, and become part of the crucial technologies that are coming up, and you become part of that supply chain also. And this is what is driving the global capex super cycle. And that, I believe, is the whole world is. I mean, why is Taiwan, Korea, why are they doing so well? In fact, if you over there also, if you see, if you strip out Samsung and if you strip out SK Hynix and the likes of it, you will see that the rest of the market is going down. The foreigners are actually exiting in those countries also, in the other side of the market. Similarly, it is happening in India also. There is a pocket which is actually doing very well, and there is a other market which is nobody is interested in. And all this money is essentially drawing more towards US, because US is where the bulk of the action is happening in terms of the technology companies are out of there, and the hyperscalers are driving this entire capex super cycle. So I do believe there are two different sides to the market. If you are looking at indices, you will feel there's nothing in the market, and if you are looking at this pocket, you feel the valuations are going berserk.
But Ravi, because all the capital is chasing such few names, the industrials that you're talking about, stocks have doubled, valuations of 50, 70 times. Can you make a bullish argument from here on for these stocks that you were referring to?
So you, no doubt about it that the valuations have become expensive, and no doubt about it that market has recognized it is not an unknown theme anymore. However, I think where market might be underestimating is the length of the cycle, the kind of value and the the opportunity size, and how this value can accrue to few players. So you see, in this is a kind of opportunity where on every sector I look at, let's take the example of transformer. There are only handful of companies that can actually manufacture those high-end transformers, which is the need of the hour. If you are going to electrify, if you are going to move towards AI data centers, you need those transformers, whether it is medium voltage, high voltage, HVDC. There are only 2-3 players. And when that kind of a huge opportunity meets an monopoly or an oligopoly kind of an industry structure, the valuation tends to go crazy. And it has been so the case for the last 1 year or so, but I don't think we are at the fag end of the cycle. You have to focus on the cycle rather than the valuation. If you keep valuation as the decision point for entry or exit, then you will likely miss out on the cycle.
Even if you buy right now a transformer, 1 or 2 transformer companies, you will make money comfortably?
I will never say you should buy at this valuation, but at the same time, the cycle is not ending. See, the 9 lakh crore capex cycle in India itself is still ahead of us. Also, the entire data center capex build out is ahead of us. I think by 2032, I think almost 150 gigawatt of data centers will be built. Now, if you were to just when will those risks come about? Is if this everybody has so I think all hyperscalers combined have a operating cash flow of about $300 to $350 billion, and their capex this year is going to be $700 billion. So already they are going to start leveraging their balance sheet to fund this capex. This number from $700 billion goes to $1 trillion the next year, and it sustains for a 4-5 year period. Now, at some point of time, if they don't start seeing the return on their investment and their balance sheets are leveraged, and the interest rates go through the roof, that is when the bubble current boom will become a bubble and it will start bursting. Are we at that point? I don't think we are at that point at this point in time, and a lot of the capex still needs to happen. The balance sheets will still probably get even more leveraged from here before we start seeing the problem. But yeah, I mean, that is a discussion probably for a later date, not today. Okay, Ravi, let's talk about another theme then that you all have liked, the renewables theme. I mean, it's public knowledge in terms of the companies you'll have. But at one point of time, you all were the so-called lone warriors out there, because the street was doubting. There is module production, maybe there is excess. Then they were going to forward integration. There was cell production, but maybe there is excess. How are you feeling about this renewable themes with regard to the listed players here in India? Because suddenly there's a resurgence out there.
Yeah, so Nigel, I'm going to take a step back and again explain that first of all, in this larger global industrial capex theme, energy security and energy dependence is the larger theme. Within that, energy transition. So we are not only trying to become energy secure, we are also trying to move away from fossil fuel towards renewables. And in this renewables also,
solar is but one part of it. There are many other things to it as well. Hydrogen, nuclear, wind, battery. So many other technologies will also come. It's not like solar is the only one. But solar definitely is the largest because it is the cheapest form of energy that humans have created at mass. So it will have the largest adoption. The size is huge. But the problem for this is that when this whole revolution started in India, we were completely dependent on China. Today, you take the same case for batteries, we are completely dependent on China. In fact, the entire world is dependent on China, not only us. So now one has to understand the strategic intent of the government. If you are trying to become energy secure and you are trying to become energy independent, then you are not going to start thinking that, you know, if I buy this from China, then it will be cheaper. So I should rather import from China and do this. But if you do this, you are actually giving away the leverage that you have, and you are in fact going to become dependent on a rival nation for your supply chain, and that can be weaponized at some point of time. So you want to avoid that situation. So government, what it is doing is, it is keeping the profit pools protected. So they started with providing, ALMM to ALMM1, which is essentially only the local guys can sell modules. Then they give added incentives of PLI. They also added customs duty to make the imports expensive. Now that was the beginning at the module end. But if you go through now, their ALMM2 comes into effect. In fact, from 1st June onwards. Now, what that will essentially do is move the profit pools from only a standalone module guy to somebody who's integrated with a cell plus module. Then from June 28 onwards, this will move to wafers. So essentially government is saying, make your money in that window of opportunity when I'm giving you protection, use that cash flow, backward integrate, all the way they will go till polysilicon. So that is the way, that is the pathway that government has adopted in ensuring that we have a supply chain. See, an entrepreneur will not put money unless he has some kind of guarantee that they will make money. And we are not the kind of state like China is, where you don't have to consider the ROIs, or you don't have to worry about the land or many other things. So our entrepreneurs have to think about making money. Now, if they are given a window of opportunity to make that money and they use that to backward integrate, I think that's the right way to go about doing this.
I must say, there are still, Nigel put it the right, you were the lone warriors, it's worked out beautifully, but there are still those who are kind of on the sidelines, institutions especially, on this theme. And the worry, we hear it often enough with analysts, etc. also, that maybe overcapacity is the
returns,
in 2 years' time. And by the way, I got a call today and maybe I should put this to the management, and you're a shareholder. With regards to Wari, there was I think it was a news item that they're raising 7,000 crores.
10,000 crores.
And somebody called me and said, well, you should ask, why are they raising equity? They're not highly levered. They can raise debt. Why do equity?
So I think...
as I said, I should...
No, it's not a question for me, but as I understand, and I'll just answer it, not only for this company, any company, I think the capex is 4x, 5x larger than the equity raise that they are doing. So equity will still be only 20-30% of the total fund that will be required. It's a 30-40,000 crore kind of a capex plan that they have. So, I mean, but they are first raising the equity and the debt will come in later.
They have some ambitious plans that they laid out in the analyst meet, at least Wari, earlier last month. Ravi, stay on. We need to slip into a very short break. We'll come back and continue this fascinating conversation on Editors Roundtable with Ravi.
Welcome back. You're with us here on Editors Roundtable. You know, one of the things, and we've discussed lots of stuff with Ravi in terms of what he likes, his bets, etc. But now this is not a bet, but this is the wish list that many have, especially the equity folk. I mean, all of us, that equities taxation perhaps should be reduced. I mean, this has, of course, been a constant demand since the time it was introduced back in 2008. But I guess it's gained more momentum with what has been happening on capital, with capital outflows, etc. So we had, you know, Bank of America's Amish Shah earlier today, and we put that same question to him. So just we want to play that soundbite out, and then we'll ask Ravi how he thinks about this question.
Has taxation lopsided allocations of retail savings towards equities? Completely yes. Has the capital gains discouraged foreign investors, especially when rupee is hurting, especially when, you know, earnings growth is low, valuations for India are high? So therefore, is India out of my radar as a foreign investor? The answer is yes. And given that large part of the rupee problem right now is also lack of capital flows, I think it makes sense for us to do it. So the answer that I'm trying to give is that, you know, logically, if you think about it, we must do it.
Ravi, your thoughts. Amish says we must do it. Logically thinking, we must do it. Your thoughts?
So, you know what? If this crisis has revealed, it is our vulnerability. And vulnerability is not only on the energy security and supply chain security, it is also on the fact that we are dependent on, you know, our foreign currency. And we have been kind of caught up in a downward spiral over there. FIIs are exiting, rupee is depreciating, balance of payments is going for a toss, current account deficit, fiscal deficit, both are ballooning up. And if we want to get out of this vicious cycle, then there is only one external injection that can help, which is essentially attracting foreign capital flows. So in terms of what is the need of the hour is very, very clear. We need to attract capital. Now, government can adopt any playbook they want, but essentially we need to attract $100 billion next year. That will stabilize the rupee. That will make our macros fall in place again, and we'll become an attractive destination again. Will they cut LTCG to attract FPI flows? I seriously doubt that. I do believe that their government is making a distinction between long-term, attracting long-term sticky money, and FPI flows are considered as hot money, and that is definitely not a priority for this government, as I understand. Now, I could be completely wrong, and I'll be very pleasantly surprised if it was to happen. But I think I will be more you know, probably hoping that something on the bond market side, something on the attracting FDI in some of the larger sectors, like probably what they have done for data centers, where they have given a 20-year tax holiday. I expect you know, at least $25–30 billion kind of inflow coming in for data centers. So those kind of more larger avenues will open up, and we have to take steps to attract capital. This will be a cherry on top, not something that I'm expecting.
Not the baseline, but you'd be happy. Who
will not be? I am anyway 100% invested in the markets.
You know, there was two on this question of how to stabilize things, and maybe it's already stabilized. We don't know. We'll be wiser in hindsight. But the fixed income guys were saying maybe we need a rate hike, and the counter to that is we're not a large foreign-owned debt market. This is an equity. I mean, it's an equity market, not debt market. I mean, when rates go up, it leads to selling, not buying. So I don't know if that does the opposite. So that's the other debate, which, I mean, the classical economics says increase rates. I mean, you know, bonds get firmer, rupee gets stronger, etc., etc. But I don't know. I mean, if that is something you've thought about or not, but at least on the fixed income side, we've heard that a couple of times.
No, I think, see, we have to think longer term, and I do think government is thinking longer term. And we have to correct this whole situation. Next time there's an energy shock, we should not be vulnerable to it, and we should not be vulnerable to capital flows going out. And how do you do that? First, basically, the biggest problems are we consume more than we produce, and we import more than we export. We have to correct those situations. So we have corrected to some extent on the electronics import side, but I think there's a lot more to be done on the energy side. Energy is the next big item. Gold, unfortunately we can't do anything about. Maybe we can do something to monetize the domestic gold that we have. We have tried and failed over there, but I think still more can be done. But on the energy front, I think that is where that is why I get that confidence that this energy transition theme, it is not only about moving away from fossil fuel to renewables, but it is also moving away from spending dollars to get our energy requirement. So we should have a domestically produced energy, and that is what will make our country far more stable and secure in the future. But that is a 10-year story. From a 1 year perspective, we need to take care of what is urgent and important rather than what is more strategic in nature.
Other theme which you've been very bullish on is the defense theme. I just put out some data. I was looking at for the last 4 years, the entire defense pack market cap has gone up by 6x, but the top line and bottom line has gone up only by 1.5 or 2x maximum. So, are you seeing that in many of these companies, market is overpaying the kind of valuation that they should pay? For example, today BDL was a classic accident for the day. For the 7th year in a row, execution has been a bit of a question mark on that company. How do you look at this opportunity? I understand, long term there is a big TAM, but near term, you think there is a pain?
No, so first of all, let's understand what this long term is. Because of the events that I mentioned, which is leading to this global industrial capex super cycle, defense or the security concerns are definitely a part of it. We used to have US security cover, the NATO nations used to have that. That is not available anymore, or at least it is available at a price. It is not available for free anymore. So in that kind of a case, Europe is rearming itself. Japan, which post World War II, had pledged that they will never rearm itself, is again giving a boost to its domestic defense this thing. So there is a new wave of rearmament that is happening across the world, and the skirmishes that have happened everywhere has made everyone even more sensitive to that fact that we are also still spending only 2% of the GDP, and the other nations are spending 4-5%. So we need to increase our budget also. So I don't think the defense capex cycle is over, but it might undergo a transition, or it might undergo some kind of a change. Valuations can ensure that there are no returns for a year or so, absolutely possible. I think the big change that is happening in India is that we are moving away from a PSU-led defense capex cycle to now more a private sector-led capex cycle. Now the private sector capex, private sector has been opened up to defense. If you see the last 2026 DAP, the defense acquisition policy, a lot of the R&D where the DRDOs of the world were kind of monopolizing this. Now the private sector will be able to do that. And the way this is structured is that first the MOD or DRDO gives the order to the large system integrators, who in turn give the orders to the large tier 1 vendors, sub-assembly guys, component manufacturers, and that is the value chain. So that value chain down the stream is where the opportunity is still opening up. So I don't think the defense cycle is over, but the large listed defense PSU defense companies, I don't think can be a large multi-bagger from here. They will be a compounder at best.
There is a sign of things that I think the founder of Solar Industries got, I think, one of the nation's highest civilian awards, right? I mean, so
yes.
Which is quite incredible. We've not seen that.
Yeah, but I mean, that's a great example. But let me point you also to a fact that we've been tracking this company for the last 15 years, since 2010. It used to be an explosive company. Yeah. It still is an explosive company. It has a almost 1.2, 1.3 lakh crore kind of a market cap. The order book for defense is 7,000 crores, which is a big jump. But 7,000 crores and 1.5 lakh crore market cap. So the defense opportunity tends to come about slowly, but once it comes, then the runway tends to be much longer.
No, and just on this one only, I think 10 years ago, there were around 11 crores from defense. And in the coming year, they're talking about 4,500 crores of defense. So we'll have to see where this goes. But, as you're saying, the defense book is just 7,000 crores. So thereabouts. Time to wind down, guys?
Yes.
Absolutely. Thank you, Ravi, for coming down to our studio. It's been a great conversation. Thank you.
Thank you.
Well, with that, it's curtains down on Editor's Roundtable. Thank you very much for watching.
evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty declined by nearly 2% after a late sell-off. Only 5 Nifty stocks end in the green. The sharp fall on Friday leads to a weekly loss of 1% for our indices. US and Iran reach a potential agreement to extend the ceasefire by 60 days and reopen the Strait of Hormuz, pending President Trump's approval. Vice President J.D. Vance says very close to a deal, but not there yet. Crude oil prices on track for a 10% decline this week, the steepest in nearly 2 months. U.S. Ambassador to India Sergio Gore says the last 1% of the interim trade deal between India and the U.S. has to be finalized. Confident a deal will be signed in the weeks to come. A U.S. delegation is scheduled to visit India between the 1st and the 4th of June. India's Met Department scales down its monsoon forecast to the lowest ever reading of 90%, also predicts a 60% chance of a deficient rainfall and warns of higher temperatures in June. The Reserve Bank's balance sheet expands by over 20% in FY26 due to the sharp rise in gold prices. The central bank's expenditure more than doubles after setting aside more than 1 lakh crore rupees to the contingency fund. Anthropic becomes the world's most valuable private AI company after raising $65 billion at a valuation of $965 billion. OpenAI is valued at over $850 billion as per the last funding round in March. Both companies are planning to go public this year. GMR Airports achieves full-year profitability for the first time in over a decade. Plans to monetize the vast land bank around airports. Expects the addition of 2 new airports to bolster passenger growth by 5% this fiscal. That's an exclusive. The Supreme Court terms the NEET question paper leak as traumatic, says we cannot disappoint students. The National Testing Agency outlines corrective measures. The government says the Prime Minister is personally monitoring the situation. The Supreme Court sets a 3-month deadline for high courts to pronounce judgments in a case, calls for bail pleas to be disposed of within 48 hours. Decks cleared for DK Shivakumar, who in all likelihood will succeed Siddaramaiah as Karnataka's next chief minister. The Congress Legislature Party will meet tomorrow to elect a new leader. Siddaramaiah and Shivakumar meet the Congress High Command in Delhi. Jeff Bezos' Blue Origin rocket explodes on the launch pad during a test, sending an enormous fireball into the sky. Bezos says all personnel are safe. The company will rebuild the rocket. Well, the top story this evening, White House officials say the U.S. and Iran have reached a tentative agreement to extend the ceasefire by another 60 days, though President Trump's final approval is not in yet. That is still pending. Here are the latest developments in the West Asia conflicts. Reports say that the 2 nations will start negotiations to permanently end the war in the 60 days. The deal reportedly stipulates that vessel traffic would be unrestricted in the Strait of Hormuz. However, Iranian state media reports that no text of a possible MOU has been finalized yet between Washington and Tehran. This comes after Tehran said it targeted an American airbase in the region in what it called retaliation to fresh U.S. strikes. Meanwhile, the Strait of Hormuz remains a major contention point in the negotiations. Now, according to shipping data from Kepler, an LNG tanker has crossed the strait and is now set to arrive in India on the 31st of May. 13 Indian flag ships remain stranded. 1 is an LPG carrier, while 5 are crude oil tankers. This as the Iranian Revolutionary Guards claim that 26 ships have transited through the strait in the last 24 hours. Speaking to reporters at the White House, U.S. Treasury Secretary Scott Bessent said that Oman has assured the U.S. that there are no plans of a tolling system being put in place in the strait. Remember, Oman and Iran have been working towards a joint mechanism. Bessent also said that oil prices will fall rapidly once the strait is opened. This has Brent crude prices eased to see a weekly drop of over 10% on the hopes of a potential deal. U.S. Vice President J.D. Vance has also said that both Tehran and Washington are making progress in the negotiations, adding that the U.S. is now in a position where it could set back Iran's nuclear program substantially. Separately, in an interview to Fox News, President Trump said military options remain on the table if negotiations fail to deliver an outcome favorable to the U.S.
A deal that wasn't going to be good for us is the line, ultimately, because, I'm playing it out and we're going to see, and that's what I do. I negotiate, they negotiate. They're very good negotiators. They're crafty. But in the end, we have all the cards because we've defeated them militarily. Look, they have no Navy. Every ship, they have 159 ships. Every one of them are at the bottom of the sea. Every single one. We take pictures of them. We have people going down taking pictures of hundreds of ships. Their Navy is totally gone, 100%. Their Air Force is totally gone, 100%. Their military, we've sort of left it alone because we think that their military is somewhat moderate.
If you look at what we've already accomplished here, assuming that we're able to get to a final agreement here, we're reopening the Straits of Hormuz. We've already decimated their conventional military, and we're in a position where we could substantially set back their nuclear program, not just during the term of this president, but over the long term. That's a very, very good thing for the American people. So we're not there yet, but we're very close. We're going to keep on working at it.
I think the president wanted to punctuate freedom of navigation in the strait. I had a call with the Omani ambassador this morning, and he assured me that there were no plans for tolling the strait. As he said, our countries have had 200 years of good relations. He wants to have another 200 more. And I told him that this was a non-starter, and he did not want to risk either the Omani individuals or Omani financial institutions getting sanctioned.
Well, that is the U.S. Treasury Secretary Scott Bessent. Now, let's move from the West Asia conflict to what's happening in Russia, Ukraine. A Russian drone hit a residential complex in Romania. Officials have said that this attack caused a fire and wounded 2 people. Russia's move has prompted a strong response from the NATO and EU officials. NATO Secretary General Mark Rutte says Russia's reckless behavior is a danger to everyone. European Commission President Ursula von der Leyen echoed Rutte's sentiment, saying that Russia's war of aggression has crossed yet another line. Russian drones have strayed across Romania's border a number of times during the 4-year war with Ukraine. However, this is the first time that citizens from the NATO member state have been injured on account of a Russian attack. Back home, U.S. Ambassador to India Sergio Gore has said that the interim trade agreement between India and the U.S. is in the final lap. Speaking at an event, the U.S. ambassador said he's confident that India and the U.S. will sign a deal in the coming weeks. Listen in.
Our current interim trade agreement is on the table for us to finalize, and that will unlock prosperity for both of our countries. Just last week, India had sent a team to Washington, D.C. to finalize the last 1% of that trade deal. Next week, we will welcome a U.S. delegation here to continue those talks. We fully expect that the trade deal will be signed over the next few weeks and months.
Well, that is the U.S. ambassador to India, Sergio Gore, saying that last lap as far as the U.S.-India trade agreement is concerned. On to the day's market action. Markets ending at the day's low after a sharp downtick. In the last hour of trade, the Sensex and the Nifty fell nearly 2% each. The midcaps and the Nifty Bank also dropped over 1%. So we saw that fall coming in towards the end, 1.5% lower for both the Sensex and the Nifty, and 1% lower for the Nifty Midcap and Nifty Bank. Only 5 Nifty stocks closed higher today, while 13 stocks fell more than 3%. Now, let's bring up the picture for the week. The Sensex and the Nifty have dropped nearly 1% each for the week. Broader markets have outperformed, though, with the Midcap Index and the Nifty Bank seeing weekly gains. In the currency market, the rupee hitting a 3-week high against the dollar. The Indian currency gained nearly 70 paise. Traders say the RBI is likely to have intervened. The rupee now stands at the 95 mark against the dollar. Well, the Reserve Bank has released its annual report for FY26, which shows that the balance sheet has expanded by more than 20%, and this is largely on account of the sharp rise in the value of gold. The central bank's expenditure more than doubled last fiscal after it set aside more than 1 lakh crore rupees for the contingency fund. That's the latest from the RBI on its balance sheet. India's Met Department has scaled down its monsoon forecast to the lowest ever reading of 90%. The IMD also predicts a 60% chance of deficient rainfall and warns of higher temperatures through June. Now, this comes as concerns mount over the developing El Nino conditions, which are associated with weaker monsoons. With the heat wave likely to persist in June, power consumption will also remain high. The Coal Ministry says India has sufficient supply for nearly 19 days of consumption. In earnings, Asian Paints has reported a strong set of numbers for Q4, beating street estimates on all fronts. Net profit up 69%, revenue up 10% on an annual basis. The decorative business volume grew 12.4%, registering the highest growth since the first quarter of FY25. The big global story, Anthropic is now the most valuable artificial intelligence company in the world. The AI giant announced a $65 billion financing round at a valuation of $965 billion. This fundraise pushes the company's overall valuation above its rival OpenAI. Rachna joins us now with more. Rachna, what does this mean for the AI giant?
You know, when Anthropic was founded in 2021, its pitch was simple.
AI needed to be built more responsibly. And 5 years later, the market has rewarded that pitch with the largest private fundraise in the history of technology industry, $65 billion, a valuation of $965 billion closed in under 2 weeks. To understand why this number matters, we need to understand what has happened to Anthropic's revenue in 5 months. At the end of last year, the company was running at $9 billion annually. As of this month, that number is $47 billion. 5x growth in 5 months. The product driving that is not the chatbot that we use, that is Claude, but it is actually Claude Code, Anthropic's AI coding agent, which has become the tool that engineers inside the world's largest enterprises cannot work without. Now look at who's in this round. Sequoia and Altimeter on one side, Singapore's sovereign wealth funds, GIC and Temasek on another. GC called its largest single investment ever. Tough, though the exact amount isn't known, but it's definitely more than $1 billion, one can imagine, because their largest single investment was Grammarly, which was $1 billion. There's also UAE's MGX, and notably chip makers Samsung, SK Hynix and Micron. All three recent members of the $1 trillion club have come together to pull Anthropic into the club as well. Then there's Amazon putting in $5 billion. Now, every layer of the AI supply chain is now a financial stakeholder in Anthropic. Two things the market has not fully digested. First is the $15 billion number, which is a part of the raise that was already committed. The net new demand was for $50 billion and it was oversubscribed. Second is early investors are still sitting this round out entirely, waiting for the IPO expected as early as October. That tells us that what sophisticated money believes this company is worth at listing. The unanswered question here is the one that will define whether $965 billion is cheap or expensive. Would be the gross margin of the company. Anthropic is spending at a scale almost no private company has ever attempted. 10 gigawatts of compute capacity across Amazon, Google and SpaceX Colossus supercomputer. What is left after that infrastructure bill is paid? That number will be the first line every analyst would turn to when the S1 drops in October. Anthropic has spent 5 years arguing that safety and commercial success are not in conflict. The market for now agrees, but the IPO will be the real verdict of that. Yes, it certainly will. Rachna, many thanks for joining us. Now, Meta has rolled out paid subscription plans for Instagram, Facebook and WhatsApp. This comes as the company expands premium features and artificial intelligence offerings across its platform. Meta says Instagram Plus and Facebook Plus will cost $4 per month each, while WhatsApp Plus will cost $3 monthly. The plans are expected to begin rolling out globally in the coming weeks. Meta also announced a subscription fee for its AI services starting at nearly $8 a month. So Meta starting to monetize its big products. Speaking of AI, venture capital firm Prosus and Indian Council for Research on International have released a new index which ranks India at number 4, just behind the US, China and Singapore. However, the report shows that India's large consumer base has helped break into the top 5 and the creation of intellectual property remains a constraint. Take a look.
You know, we've all been benefiting from the billions of dollars of investments that have been put into building LLMs and building the platform, the data, the energy consumption that is going hand in hand with this current proliferation. But if those costs and the cost of tokens go up dramatically, frankly, the rate of diffusion that you're seeing today in AI, which is the fastest of any technology in the history of this world, that will slow down. I do think that the cost of compute has been underestimated up till this point in the deployment of AI.
Well, the big newsmaker today, GMR Airports achieving full-year profitability for the first time in over a decade. We spoke with top executive Saurabh Chawla at the Hyderabad airport, one of the company's marquee assets. He told us it plans to monetize vast land banks around airports and treat them as a third business stream. He expects the addition of 2 new airports to bolster passenger growth by 5% this fiscal. Here's a sneak peek of that conversation.
We are not too business based. We are 3 business based. One is the aero part, which is tariff linked and gives a fixed return on equity. And that's pretty much well understood. That's the utility part of our business. The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business. The third business, which till date has been more as land monetization.
Well, the centre has begun consultations with the automobile industry for the rollout of E25 fuel, which is petrol blended with 25% ethanol and 75% gasoline. Shivani joins us now with more. Shivani, give us a sense of the rollout timeline that the government is targeting.
Well, yes, India may soon be preparing for the next big shift in its fuel roadmap. CNBC TV18 has learned from sources that the government is in talks with the automobile industry on a plan to roll out E25 fuel, that's petrol blended with 25% ethanol, as a part of the broader push towards making it India's standard fuel, which is monofuel. Sources tell CNBC TV18 that the government is looking at a 2 to 3 year timeline for this transition to start, with the Ministry of Heavy Industry currently holding consultations with automakers and industry stakeholders. Now remember, India currently uses E20 petrol, which contains 20% ethanol blending. But the government is keen to move further up the ethanol ladder. In fact, on May 15, the centre notified BIS standards for higher ethanol petrol blends, ranging from E22 to E30, a move seen as laying the groundwork for future adoption. However, the transition to E25 may not be all that easy. Industry players have sought at least 6 months for vehicle testing before any rollout begins, while the Automotive Research Association of India, the ARAI, is currently working on testing metrics for E25 compatible vehicles. Automakers have also flagged concerns over the impact of higher ethanol blends on older vehicles, especially in terms of engine compatibility and long-term performance. The move also ties into government's larger ambition on alternative fuels. Earlier this year, Union Minister Nitin Gadkari in April actually had said India should aspire for 100% ethanol blending in the near future as part of efforts to become energy self-reliant amid global supply disruptions. How soon the government is able to achieve this, that remains to be seen. Back to you.
All right. Many thanks, Shivani, for joining us. Now, decks have been cleared for DK Shivakumar, who in all likelihood will succeed Siddaramaiah as Karnataka's next chief minister. The Congress Legislative Party will meet tomorrow to elect a new leader. Siddaramaiah and Shivakumar met the Congress High Command in New Delhi. 6 Labour killed and 3 others injured after an under-construction bridge collapsed in UP. Officials have said a concrete slab of the bridge caved in due to strong winds and rains. It is feared that the number of casualties can rise as some labourers may still be trapped under the debris. The Supreme Court has termed the NEET question paper leak as traumatic. The court has said that the nation cannot disappoint its students. The National Testing Agency has outlined corrective measures. The government has said the Prime Minister is personally monitoring the situation. This, even as the CBSE has opened the window for students to apply for re-evaluation today. Now, only students who have obtained scanned copies of their answer sheets can apply for re-evaluation. So far, over 4 lakh students have applied to access their answer sheets. Archana joins us now with more on both the exam controversies, NEET and CBSE. Archana, give us an update on both.
Yes, let's talk about these 2 big headlines that we have been consistently tracking. Let's talk about NEET, the medical entrance exam that got cancelled due to a paper leak and impacted over 22.7 lakh students. And on the other hand, we'll also talk about CBSE's on-screen marking controversy, which impacted 17 lakh students who appeared for the board examination. Let's start with the NEET hearing that took place in the Supreme Court today. The top court raised concerns over the ad hoc nature of the National Testing Agency that conducts major entrance exams in India like NEET. The top court said that unless clear accountability is fixed, the problems will recur. During the hearing today, the bench observed that the NTA needs to learn from other bodies like the UPSC, which conduct large-scale competitive exams without any paper leak. The judges said, and I quote, "It is very traumatic. We cannot disappoint our students. It's not merely the student, it's the family too. It's so much emotions, love, time, years of study," unquote. The Solicitor General, who was representing the government, told the court that Prime Minister Modi himself is monitoring the NEET retest. The court has now directed the Ministry of Education to file a separate affidavit detailing the mechanism by which the process of conducting and concluding NEET examination would be institutionalized by the NTA on a year-to-year basis. The centre has 6 weeks to respond to this and submit the affidavit. Meanwhile, let's talk about the CBSE. The issue is getting political after over 4 lakh students sought review of their answer sheets amid the newly introduced on-screen marking process. Leader of opposition Rahul Gandhi has flagged that the company that got the contract to carry out the digital revaluation, that's Coemt Edutech Private Limited, previously operated as Globarina Technologies, was blacklisted during the 2019 Telangana intermediate exams. Despite that, this company was awarded the contract by CBSE. However, CBSE has called these allegations erroneous, misleading and not based on facts. Now, as outrage continues, Union Education Minister Dharmendra Pradhan has said that he takes full responsibility and he has assured students and parents that no one will be spared if irregularities are found in the evaluation process. Back to you.
पहली बार देश में सीबीएसई ने इसको प्रयोग किया, उसमें कुछ विसंगति ध्यान में आ रही है। इसको मैं दायित्व लेता हूं, उसको ऐसे ठीक करा जाएगा, उसके उपाय निकाला जाएगा, उस काम पे हम सब लोग जुटे हैं। हम एक भी विद्यार्थी की अनआंसर्ड क्वारी को, कोई उनकी मन की जिज्ञासा को हम असमाधित नहीं छोड़ेंगे। उसमें जो कुछ विसंगति आई है, जब इतने बड़े मात्रा में इसको व्यवस्था किया गया, मैंने जैसे कहा 40 करोड़ पेपर स्कैन्ड हुई है।
Well, 4 lakh students who took the CBSE exam have asked for a copy of their scanned answer sheets. The re-evaluation process will now begin. A quick check of some of the other headlines that we are tracking. A forex loss of 4,823 crore rupees. That's largely on the back of the West Asia crisis has seen Indigo reporting an unexpected loss of 2,536 crore rupees in the last quarter of FY26. That's not all. The airline's losses for the entire fiscal have come in at over 2,300 crore rupees. So a significantly weak quarter there for Indigo. The first chairman of India's Competition Commission, Dharmendra Kumar, has passed away. The 80-year-old died after a suspected blast of an air conditioner at his residence in Delhi, which sparked a fire. He was rushed to the All India Institute of Medical Sciences, where he was declared dead. His son was injured in the incident and is undergoing treatment. Dharmendra Kumar also served as an executive director at the World Bank. Well, that is an unfortunate and untimely demise there of the former chairman of the Competition Commission of India. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Good morning. We are here at the GMR Hyderabad Airport. We are joined by Mr. Saurabh Chawla, the Group Executive Director of the GMR Group. And this is just a day after the company reported its FY26 results, where the company turned profitable after a decade. And this was despite the fact that it was a very turbulent year as far as Indian aviation was concerned. It's a pleasure to be here, sir. Thank you so much for having us.
Thank you.
A lot of questions that we have for you, and a lot depends on FY27, especially given the base that you've now set and expectations are now high.
No, absolutely. It's wonderful to again chat with you. We are at an inflection point, despite a lot of geopolitical challenges that we have seen in the last 12 months.
We'll quickly touch upon that, sir. The first one, of course, you started off the year, you saw Operation Sindoor take place. In the middle of the year, you did see quite a bit of disruptions in terms of flight timings, flight schedules, aviation capacity. Two of India's largest carriers saw that, both Air India as well as Indigo. And you also, towards the end of the year, saw West Asia conflict that impacted air traffic across the world. Despite that, how did you manage to turn profitable? And going forward, do you feel that you've now set a very favorable base going into FY27?
So our planning always envisaged that we will be profitable during this fiscal year. And that was predicated on one aspect, which was the tariff of Delhi Airport. So as soon as that came, obviously our revenues went up sharply. And that was post the expansion of Delhi Airport to 100-odd million passenger base. So it was always there on cards. We never, give any guidance on revenues and profitability. So we just kept a positive perspective over there. From our perspective, we also plan for some of the black swan events. So whether it was the mishap in Ahmedabad or it was Operation Sindoor, due to which traffic came off, and then the Pakistan airspace has been shut. Because of that, we plan all those in our forecasting, and even today, as I speak, we are very confident that we will continue with this momentum going forward, despite these conditions still continuing in this current fiscal year.
You've said you're going to continue with the momentum, but I'm going to force you, and I'm going to try and quantify some of the numbers going into FY27. FY26, you've set a favorable pace, given the fact that because of so much disruption, PAX growth across quite a few of the airports was flat to marginally positive. Now, with this base and going into FY27, and we also know that you have two very big airports coming up across the country, what kind of passenger growth are you targeting? If you could break it down in terms of the airport-wise, that will be great. But overall, what is the group targeting in terms of passenger growth?
So organically, I think we should grow by about 4 to 5%, despite the current conditions. The first half will be softer than the second half. First half is continually being negatively impacted because of the geopolitical issues. But we believe in the second half, things should come back. And in that context, I think about 4 to 5% organic growth will be there. We have two airports which are going to go live very immediately. The brownfield airport in Nagpur will come into our portfolio, which will grow our PAX universe there. And of course, the opening up of Bhogapuram or Vizag Airport, that will also.
A quick word on the capacity there and how much you all are expanding it by?
So in both these places, the PAX will be about 2.5 million odd each, is what should get added in the current year. With respect to and these will all come into play in Q2. So about a 9-month impact, positive impact will be there.
Okay, understood that. You also gave a very important update to the exchanges, to the investors during Q4, where your largest partner, Group ADP, was paring its stake to a level where both yourself as well as Group ADP will have very similar holding as far as the platform is concerned. Simplify that structure for us. Do they continue as partners? And how are you funding the stake buy from Group ADP?
So I think the press release by ADP is quite clear. They have categorically said that this is one-off transactions that they are taking, and by selling about 7.3% stake to the GMR family. The understanding with ADP has always been from day one is that at all points of time, GMR will be 1% higher in equity stakeholding, issued equity capital stakeholding. So that will continue. The group ADP, in order to comply with this condition, had converted their equity into a convertible instrument called OCRPS.
Right.
And so by selling about 7.3% stake, they will be able to convert a part of their OCRPS to maintain that delta of 1% between the GMR and Group ADP. So they will continue to be a strategic partners. There is no nothing envisaged where they want to exit an investment or they want to dilute their involvement in a GMR.
So no change in operations. The shareholding remains as per what was the original agreement. And a quick word on how that particular stake buy will be funded.
So it's the promoters who have bought it, and they have their own, resources to purchase that stake. Over the last, I would say, a decade, they have had the ability to monetize many of their assets and investments, and create enough cash reserves for themselves that whether it is entering into new businesses or buying stake back from ADP, they should be ready. So they have done it from their own sources.
So when we look at the airport business in India, I think we can now broadly categorize it into two key categories. One is the aero part of the business, which has a fixed return, and the other one is the non-aero part, which you've been very excited in past interactions with us. FY27, what kind of growth are you envisaging, especially with new airports coming in? And also a quick word, given that you have so much real estate across your various airports, any plans to monetize any of them?
So very clearly, I'll tell you, we are not two business-based. We are three business-based.
Okay.
One is the aero part, which is tariff-linked and gives a fixed, return on equity. And that's pretty much well understood. That's the utility part of our business.
Right.
The second, which now you can see the fruits of our strategy, is the non-aero part of it. Very interestingly, non-aero today as a platform, both from revenue and EBITDA perspective, is bigger than Hyderabad Airport as a utility business.
Wow.
Okay, so that gives you the consumer-facing consumer business that is there. The third business, which till date has been more as land monetization. So you basically you offer land to third-party developers who develop commercial properties or hotels on that parcel of land, and we get land rentals. Now that is the lowest margin business for any person.
Right.
The real business is when you develop properties on those, and then either you monetize them or you earn rentals on it. So as we go forward, that is where our focus would be, is to how to create a platform play on the real estate side of it. If you look at India, probably we have one of the most valuable land resources in the country. Land has certain attributes. It has, location is key.
Right.
Delhi, for example, Delhi Airport is now a central business district of national capital region.
Right.
With its own airport.
Right.
Okay, with 4 or 5 metros coming into that CBD. So if you go to Connaught Place, it's exactly the same thing as far as metro is concerned.
Right.
But Connaught Place does not have its own airport. We have our own airport, right? And it is sandwiched between an economic engine of Delhi and of Gurgaon, right? So it's very compelling, the real estate over there. The second is the land is owned by the respective airport entities. Hence, the title is clear, right? The third is we don't have to wait for approvals, because who's the master developer? The airport itself is the master developer. They give the approvals, they clear the buildings, they clear the designs. So it is inherent that we now start to look at becoming a developer ourselves. And in cash, this check which is already embedded in it.
Can you put a timeline, or can you quantify the size of the opportunity, or all of these are still in the works?
So, I mean, it is already there in public space. We have land resources in Delhi of, yet to be developed of almost 100 acres.
Right.
We have land resources here in Hyderabad of almost, which is not yet been monetized, is almost 1,200 to 1,300 acres. Goa, another 200 acres. Bhogapuram, once it becomes live, another 200, 230 acres. So there is enough land available for us to actually develop in perpetuity. That is the kind of land resource we have. How do we make a business model of it? How do we extract enough value so that our equity shareholders derive the benefits of this over a period of period of time is what we are really working on. And I think in next few months, we will articulate it to the marketplace. Hopefully in the first quarter call itself of fiscal 27, we'll be able to articulate as to how we are modifying our business model to create this third very valuable
and glimpses
vertical.
of what you plan to articulate during the call you've already given us. And we hope to get some more details out of you soon.
We will. Once it is finalized, once we present it to our board and the board clears that strategic plan, obviously we will surely come back to you.
Going back into passenger growth and going back into India's aviation story and the growth story especially, it's always been seen as a structural growth story that air traffic in India is bound to grow higher. But going into FY27, there have been a couple of pain points. Number one, we've actually seen capacity cuts announced by two of the largest carriers. They're actually facing constraints in terms of getting slots at airports, across different airports. And another worry has been air traffic passenger growth in India is actually continues to be around the pre-COVID levels. Is that a bit of a worry, or is it due to a lot of unseen circumstances that have transpired over the last couple of years?
It is the unforeseen circumstances, especially over the last 1 year. And you know, it's the airport story or the infra story is highly correlated to what happens in the economy. So if you grow at about 6 to 7%, your infra grows at about 1.5 to 2x of what your country's growth is. You know, so we over the last I would say 6 months, because of these sometimes unfortunate events and sometimes geopolitical issues have got impacted. But we are not a quarter to quarter. We're not even year to year story. We are actually a decadal story, right? And most of our investors look at that as to at what point of time are we in our business model and in our model to create cash flows. So if you look at Delhi, for example, Delhi, we have already done our largest capex ever, right? To create 100 million capacity in Delhi. Now, Delhi can go up to 130, right? But small capex is required over the next, maybe next cycle, tariff cycle. So we will do that to grow into that. But those are very small capexes that will grow. So during that interim period of time, as the traffic is growing 5, 7, 10%, it starts to generate significant amount of cash, which does not need reinvestment in the Delhi airport, right? So where does it go? It goes back to the shareholders after meeting with all its obligations to the debt holders. So we are at all our airports, including Hyderabad, although Hyderabad will, in a period of time, grow its capacity from the current 34 million to almost 80 odd million passengers. It will. We have already submitted, you know, in our tariff proposal, but the master planning is right now underway. So once the traffic at Hyderabad also starts to, or is growing, which continues to grow and reaches its capacity of about 34 million, we'll have to put capex to work. But because it's infra, because it's tariff regulated, the cash flows begin as soon as the project is completed and tariff is notified, right? So it's a very interesting play in India. We are still very early stage as a country to create these kinds of infrastructures. And airport in a regulated form is an extremely successful story of creation of infrastructure in our country.
Well, you know, you spoke about your obligation to the equity holders. You spoke about your obligation to the debt holders. A quick word as far as balance sheet growth is concerned. Now, given the fact that you know, 2 new airports are coming, we understand that that will impact debt. Going forward, how are you looking at managing debt? What kind of ratios do you look to maintain? What kind of discipline do you look to maintain?
So you're absolutely right. With 2 new airports coming on board, and potential new airports getting privatized in the future, the debt levels will go up. But the key metric over there is what is my net debt to EBITDA multiple. You know, ideally, I would like it to be about 3.5 to 4. But during the growth times, maybe 5.5 to 6. You know, so there will be sometimes as we acquire assets, it comes along with EBITDA. The debt levels will go up, but the multiple level will go at a much, much lower pace. So as long as we meet that discipline, that there's a cash flow supporting that debt, and the growth of the cash flow is much higher, the debt levels will automatically come down. So that's why if you look at it, today GMR Airports is rated A+ by GAL. It's a simple reason for that. Look at Delhi airports, it's rated AA, right? You look at our Hyderabad airport, it's AA+. Now these are very highly rated, you know, metrics from rating agencies. So debt itself is not an issue. Yes, maintaining a discipline of net debt to EBITDA is something that we need to be steadfast on. That's all.
You spoke about new opportunities coming up. What are the new opportunities coming up in terms of privatization? How aggressively will you be bidding in for new opportunities? And during those periods, would we see some fluctuation in terms of balance sheet discipline?
Not really. You know, the government has been indicating for now quite some time that they will be privatizing, you know, 5 medium airports with a smaller airport attached to those 5. So about 10 to 11 airports will come for privatization, and we look forward to participating in those. There have been some, conversations in the public space that they would not like to have more than 2 airports go to one operator, so that they have more participation in managing these airports. So we are quite happy with all these conditions as such. We'll be very disciplined. We cannot compete on cost of capital with the foreigners. Right. The country risk is high. You've seen what has happened in our currency. So we cannot ever compete on cost of capital. But we can compete on efficiency. We can compete on managing risk. So our preference would be more of greenfield airports than brownfield airports. But having said that, we will surely, in a very disciplined fashion, bid for new airports in the forthcoming privatizations whenever the government of India, articulates.
So, and finally, given the fact that you're a regulated entity, there are a lot of litigations ongoing in terms of tariff structures, in terms of asset-based calculations. Where are we on currently? Any risks on the horizon? And in case of favorable outcomes, you also believe that there are significant benefits that shareholders can accrue?
No, absolutely. I think these are historical litigations that have been there in their final, I would say, stage of adjudication, right? So they are right now with the Supreme Court. And hopefully, I think in the current fiscal year, at least one, if not 2 of them, do find a final decision by the Supreme Court. And we are very confident that we will be in the positive on these adjudications, because the lower courts have given a positive dispensation. But so we are happy that we are at that inflection point. But having said that, we also need to be cognizant that any such positive decision that comes will get reflective in future tariffs. It's not going to be an immediate windfall of cash that will come. It will reflect in future tariffs, which will again impact a positive impact on our long-term valuation.
Understood. Well, thank you so much, sir. Thank you so much for joining us immediately a day after results. Historic year, you've turned profitable on the bottom line.
Yes.
And I believe you are one of the key men responsible for getting that done as well. So congratulations, sir.
Thank you.
And we hope that this particular journey continues.
Thank you so much. Thank you so much. Thank you so much for having me over, and look forward to interacting with you in the near future.
We believe you're coming out with a presentation soon on a changed business strategy or a new business strategy. So I think that is something that the street will watch out for.
We are designing a new business strategy, which I said that the third vertical of real estate will form a bedrock of that strategy. Still under evaluation, still under discussions. We will take it to our board, and based on board's wisdom and approval, once they clear it, that's the time we will come and guide the markets and our investors.
Thank you so much.
Thank you so much. All the best.
Hello and welcome to CEO Centimeter. I am Ashmit Kumar. Now today, we take a pulse check on India Inc., which continues to remain resilient even as the ripple effects of the West Asia conflict cloud the global economy. Now, the RBI's latest annual report offers a mix of confidence and caution as it states that the Indian economy is expected to remain resilient with inflation in 2026-27 likely to stay aligned with the target. However, the report also flagged concerns similar to those raised by India's chief economic advisor, V. Anantanageswaran, warning that a prolonged conflict poses downside risks to the Indian economy. Now, the report further highlighted that geopolitical risks have re-emerged as a dominant drag on global growth in 2026. But how is India Inc. viewing these risks? Well, we speak with CII President Mr. R. Mukundan, CII Director General Chandrajit Banerjee, and BP India Chairman and co-chair of the CII Hydrocarbons Committee, Mr. Kartikeya Dubey, to understand the corporate India sentiment, to understand the corporate pulse. To all of our panelists, thank you so much for joining us. Mr. Banerjee, let me come to you first. And this, of course, is a broad question. I want to begin with this. If the conflict were to end today, of course, neither of us have any clarity when that will happen. We're hearing, of course, reports coming in from Washington that some interim framework may be around the corner. But given that we don't know what the situation looks like, assuming the conflict ends today, business as usual, how many months out is that?
So, I think, number one, we should be prepared for navigating through this with or without the conflict for quite a few months to come. I mean, we have heard many types of months. I mean, September, October, November is what one sees in terms of the time frame through which one will have to navigate through these global uncertainties. But yes, as you mentioned, that there is strong resilience in the Indian economy. But what we really require and need to do is to how do we focus on messaging? How do we take advantage through many steps that one can take in terms of our reforms, so to say, if I can say that. I mean, when the heat is strong, it's good to take advantage and do certain actions which will enable us. But I would really be looking at three quick things. One is, of course, inflation, and there would be a lot that would need to be managed. And as so far we we would see some short-term challenges. Second, of course, consumption, and that can get affected, and there will be some challenges which will come to that. But third, I think there is a responsibility of both industry, pretty much importantly on this, is to see how we are able to focus on discipline when we pass through such troubled times across the globe.
All right, Mr. Banerjee, it's interesting. In fact, just days back when we had the CII annual business summit take place, only a few hours before that, we also heard from the Prime Minister issuing a similar appeal on need for a nation as a whole approach for addressing the situation. But before we come to that and some of the issues that Mr. Banerjee has raised, Mr. Mukundan, let me come to you. The same question that I posed to Mr. Banerjee, is this no longer just a temporary disruption? Is there a longer-term contingency planning that is now required on part of India Inc. to meet this challenge?
Certainly, I think every incident like this leads to how do you build even further resilience. And I think Indian industry is very much focused on it. But as Chandrajit explained already, that we need to work together with all the stakeholders to make sure that we navigate the short term and prepare for the medium term and become very robust in the long term. When I mean short term, it is about 3 to 6 months. When I say medium term, is about 12 months to 18 months, and then the time beyond. What is in our favor, I think many people need to look at, is our proximity to Middle East. Because of being so close to Middle East, we will be the first and the fastest to recover from this as the situation normalizes. And obviously, we built over a period of time very strong linkages and relationship there. I think that's going to come to our benefit. But I think in the meantime, I think we all have to work together to make sure that we manage the demand side as well as the supply side, which government is doing, frankly, as whatever it needs to do. And we all now need to sort of look at what is the long term. The long-term solution, of course, is rapid electrification, rapid change in our energy mix. I think government has done a lot of stuff, including, the whole piece around nuclear energy. All these pieces are all going to come together. And industry is absolutely getting prepared for it. And what I must also commend is in the short term, government has ensured that the impact on common man is sharply reduced and kept in check, even though we hear stories. But in reality, if you look at compared to other countries, we have been less impacted, and that should come in very good stead. But if this conflict is to go, let's say, beyond 3 months into 6 months, which is unlikely because the news we are getting is it's very close to getting resolved, then I think we all need to look at what further measures we need to do.
Well, the world will be holding bated breath as to the announcements coming out of Washington with respect to status quo. But speaking of India not bearing the brunt as much as some of the other countries, Mr. Dubey, let me come to you. We've seen a few rounds of price hikes when it comes to petrol and diesel. You're from the oil and gas space. Tell us what has been the impact in terms of perhaps reducing the burden of losses that were piling up.
The losses that the oil marketing companies and the government companies have been taking has been in support of the common man and the citizen, and they've been covered in the media as well as the government briefings. These are listed companies, and it would not be appropriate to go beyond that. But definitely, the price increases will help with the losses. And the government has also stepped up to contribute in its own way by reducing the excise duty by 10 rupees, which is a massive contribution. I last checked maybe half an hour back, crude price is at 92. So this is starting to look more reasonable. And, the tough times are there, but they don't last forever. So I think, the momentum is going towards the right direction now.
Just laboring on that same point, Mr. Dubey, that we've seen again a few rounds of hikes, but we continue to hear the messaging with respect to under-recoveries and losses. Tell us how much bandwidth, how much appetite is there available with the government, with these OMCs to continue supporting it, and is that what's needed at this stage?
Well, I think, this is a complex question, and really you have to balance the needs of all the stakeholders. The first and foremost is the citizen and the common man. And then there is industry, and then there are the oil marketing companies. I think there are times when we have to step in to support the citizens, and which is what the ministry is doing at this point. And, the changes with excise duty, the SAED duty that have come in, they do provide some flexibility here to do more. At the same time, in various states, they've also stepped in with the permit system to try and moderate some of the shift of demand that is happening, which is also helping in the way this needs to be done. So I think, we are going along as we are. And as I mentioned, we are quite close to hopefully some positive news, which should help curtail this situation.
Sure. Mr. Banerjee, I want to come back to you. In your opening remark, you talked about the impact. One of the aspects that you pointed out was inflation. I just want to get a sense, the situation that we are in, are we looking at a triple strike of inflation when it comes to food, fertilizer, fuel? How severe is the impact that you're estimating going forward?
So, when you look at inflation as a piece, of course, the immediate inflation risk is from what's going on in the energy side. And that's we are seeing some effect of it. But the concern is not just only fuel prices. All of that leads to higher freight costs, say, for instance, or even affect our food group one. Very, very importantly, the industrial raw materials of packaging, so on. I underline the MSME operation side of it very strongly. Also, we would need to have these increases, but a sustained increase in the crude oil prices, but that would have a measurable inflationary impact. I would think every $10, say, for instance, barrel, can add easily about 30 basis points. So that's apart from pressurizing the current account service. So I would imagine that the first priority of ours should be to prevent an external energy shock from becoming a broader domestic price. And that requires a type of action that we are seeing, coordination action across the, as you mentioned, fertilizer, transport and logistics. So we have to have calibrated response, and our country does not at this point in time at all need any panic response or open-ended sort of a subsidy situation. What is required, I would imagine, is some of the time-bound measures to protect some of the vulnerable sections, the households, the MSME, essential supply chains, so to say. And food inflations, we need to keep that watch, and it is, as you heard. But some of the timely usage of buffer stocks, given the type of what we hear about El Nino, etc., calibrated imports of pulses and edible oils, and somewhere I would think very strongly on anti-hoarding of any kind and smooth movement of food and fertilizer. All of this can help deal with any inflationary pressure that can come in. And I end with, of course, clear communication. It's extremely important. If people believe supplies are uncertain, panic buying and speculative stocking, that itself can create price pressure. So the larger lesson is that inflation management at this point in time is not just a monetary issue or anything like that. It's all about energy security, logistics efficiency, agriculture resilience, supply chain resilience, supply chain coordination, and so on.
Right. I actually wanted to continue with that line of thought on inflation, but you've brought up an interesting point with respect to panic buying. Before I come to you, Mr. Mukundan, on inflation, let me come to you, Mr. Dubey, on that one specific issue, panic buying. We're seeing images that come up on our feeds of long queues outside some vending stations, some retail stations. Are you witnessing that? Are you seeing that? Is there a case here where you are seeing increased instances of panic buying, of hoarding? Is that taking place?
I think we live in an age of social media and instant communication. And so what you'll see are very sporadic, limited incidents of this happening. And there is ongoing monitoring by the ministry, literally on an hourly basis. So what happens is that if that happens in a certain pocket, you will immediately see a response and stocking to support that situation. And typically, you will not see the same images on the next day at that location. So there will be these one-offs, but the supply chain and the availability of product, the entire industry led by the public sector is working at its best, and the ministry is enabling and supporting this. So I am not particularly disturbed by that.
Is there a case, Mr. Dubey, where perhaps bulk buyers are moving towards retail stations and that perhaps is leading to such images, such situations?
Again, that is the case, but that's again very sporadic, and there is a difference in the pricing, as you know. Now, there are two channels. There is the retail channel, and then there's the direct channel, which is typically used by the industry. And there are times when, because of that difference, you will have some demand moving to the retail side as well. But again, I think, as Mr. Mukundan pointed out, we need to look at a little bit of responsibility over there. The other thing is that when things are normal, the direct channel actually offers some discounts to the industrial customers. So again, this is a tough time, but I think it's a bit more temporary. The second thing is, as I mentioned, the state governments have provided a permitting system and more will do it. And they're also monitoring this. So again, these are one-offs. It's sporadic.
Right. Right. So tough times again that we are looking at. Mr. Mukundan, speaking of tough times, I just want to borrow from what Mr. Banerjee had been talking about. He talked about how, of course, in the near term, there will be inflationary pressures. We've heard of the El Nino. We've heard of lower than expected monsoons this year. Will that add to the pressure, add to the negative spiral, Mr. Mukundan?
So firstly, I think, let me just go back to what we heard from Karthika in terms of the sudden, sporadic, localized panic buying. I think some of the states have done a very good job. I can only tell you from the state, we have an operation in Gujarat. The government has actually taken the past buying average and has allocated very clearly the quantities, and most of us haven't faced any issues at all because it's based on the past buying pattern. So I think they've done an excellent job in terms of that. In terms of fertilizer, certainly I think the government fertilizer subsidy bill is going to go up. As you know, in India, fertilizer is at a fixed price. That is not a big issue at the time of the farm consumption, but certainly government is going to have let's say, higher bill to foot in terms of the subsidy bill. In terms of the El Nino itself, it's going to come out and play. We'll have to wait for that to see. But good news is our reservoir levels are fine. I think we've got to say that we've got to get through the Kharif well. The issue will be for Rabi. I think we've got time to sort of prepare for Rabi. Kharif, I think more or less in terms of the reservoir levels and the areas. So there could be some areas where there will be some sporadic issue if El Nino does play out very, very strongly. What we are hearing is it's not going to be that strong. It's going to be a bit minor. So let's watch as it plays out. We have a playbook for this as a country, and we'll put out that playbook, I'm sure, district by district in a very micro way. We've been in this business. We know how to sort of manage this. In terms of food inflation itself, I think government is sitting on a good amount of food stock, and I think pulses is another area which Chandrajit spoke about. I think we've actually partnered with many countries to make sure those supply chains are smoothened out. So it is going to be something which India has to work as one team and deliver on that theme to how do we reduce the impact on common man, and at the same time make sure that we can move forward on our agenda to grow this country, get back to the same growth rate which we have.
Right. On that note, I'd request all of our panelists to do stay on with us. We're heading into a very short break, but we'll be back on the other side. We'll continue this conversation after this short break. Welcome back, and still with us are Mr. R. Mukundan, Chandrajit Banerjee, as well as Mr. Kartikeya Dubey. Mr. Banerjee, let me come to you on a couple of operational issues that we've been hearing about for the last few weeks now. Labor availability, let me get your thoughts on that. From your conversations with the companies, are you hearing anything about labor availability? We saw reports of of workers moving back towards the villages, citing gas prices. Is that changed? Are there any concerns, challenges that have been flagged by the companies?
There are sporadic thoughts, or rather comments which come from here and there. Yes, of course, one hears them, but if you really see the practical results on the ground, and what do we see? It's really that there are many measures that the companies are already taking, and they would do it even faster, I would imagine. That is, how do we create better logistics, or rather support in terms of transports, mobility of workers? Some of the workers may return temporarily, of course, to their home region, especially if rural employment or farm activity picks up during the monsoon season. But then that should not be, that's something that we have seen in the past, but that should not be